Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you think about Wall Street, it's easy to picture this chaotic mess, right? Flashing screens, people yelling, and everyone's just reacting to fear and greed. But what if I told you that the most successful investor of our lifetime built his entire fortune by ignoring all of that? Warren Buffett's approach is actually shockingly simple. He stopped thinking about stocks and started thinking about businesses. So today, we're going to open up his playbook and see how it works.
All right, so here's the game plan. We're going to break down his method into 4 really clear, powerful plays. This is the exact framework that can help you turn all that chaos and foolishness of the market into your greatest advantage. Okay, first up. And look, this first one is probably the most important of them all because it's a complete shift in how you see the entire game. It's all about moving from being a guy who just rents stocks to someone who actually owns a piece of a business.
See, on one hand, you've got the Wall Street mindset. It's a total roller coaster, right? Obsessed with the daily price, fueled by emotion. But the Buffett mindset, it's the total opposite. It's grounded. It's rational. It completely ignores those crazy short-term swings to focus on one thing, and one thing only: the long-term earning power of the actual business.
Let's make this super practical for a second. Imagine you're not buying a stock. Instead, someone offers to sell you the local drugstore on the corner. How would you figure out if it's a good deal? You wouldn't be refreshing a ticker symbol on your phone every 5 minutes, would you? Of course not. You'd do what any smart business owner does.
You'd ask to see the books. You'd dig in and see, okay, this little store makes a steady $20,000 a year. The owner wants $100,000 for it. Simple math, right? That's a 20% annual return on your money. Now you can make a rational decision. Is a 20% return good enough for you? That right there, that's the core of thinking like an owner.
And that's it. At the end of the day, everything, and I mean everything, boils down to these 2 questions. If you can answer these with some real confidence, you are way ahead of the game. Everything else is just noise.
Okay, so you've got the owner's mindset down. Check. But now what? What kind of business should you be looking to own? And that brings us to the second play in the book, finding companies that have a kind of unfair advantage.
Buffett realized that there are really just 2 kinds of businesses out there. First, you have commodity businesses. Think airlines, textile mills, places where they're all in a brutal, constant price war. It's a race to the bottom, and you have to spend a ton of money just to stay in the game. But then you have the consumer monopolies, and these, my friends, are the real gems.
What we're talking about here is a company that owns a little piece of real estate, right inside the customer's mind. The brand is so powerful that a store has to stock its product or customers will go somewhere else. This creates what Buffett calls an economic toll bridge. If you want to cross, you've got to pay the toll.
And this story just illustrates that power perfectly. We're not just talking about your local supermarket. We're talking about global dominance. When your brand is literally the only choice at some tiny little stand in a remote corner of the world, you have built a seriously powerful fortress around your business.
And the cool thing is, you don't need a fancy degree to find these things. You can run this simple test yourself. Just next time you're in a convenience store, look around. What products would the owner be absolutely nuts not to have on the shelf? Now ask yourself, even if I gave you $1 billion, could you launch a new company to knock that product off the shelf? If the answer is just a hard no way, then you might be looking at a consumer monopoly.
I mean, look at this list. These aren't just brand names, are they? They're cultural institutions. They have generations of customer loyalty built in. Think about it. They don't have to constantly reinvent the wheel because their products are simple, they're timeless, and they're just woven into the fabric of our lives. This is that durable competitive advantage that Buffett is always looking for.
All right, so you found this incredible business, this consumer monopoly. You're all set, right? Well, not so fast. That's only half of the equation. Because even a wonderful business bought at a terrible price can turn into a bad investment. So the third play is all about having the discipline to pay the right price.
This gets to one of the most famous ideas in all of investing, and for good reason. The market, it's bipolar. It swings wildly from euphoria, where everything seems amazing, to total despair, where the world is ending. And those moods, they often have very little to do with the actual real-world value of a business.
And here's the big secret. That irrational behavior, it's not a risk to be afraid of. It's actually your single biggest opportunity. When the market panics, when everyone else is selling, it will offer you these wonderful businesses at bargain basement prices. Your job is just to stay calm,
trust your analysis, and act rationally when everyone else is losing their minds. You know, Buffett's own teacher, the legendary Benjamin Graham, he really hit the nail on the head with this one. He pointed out a classic example of market panic. When a company gets hit with a big lawsuit, the market freaks out. It immediately assumes the absolute worst-case scenario and just hammers the stock price, often way, way below what the actual risk is. Let's look at a real-world case. RJ Nabisco, back in '88. This is a perfect example. The market was absolutely terrified of lawsuits against tobacco companies, so it priced the stock at only $45 a share. But the business itself? It was an absolute cash-generating machine. And a private equity firm, KKR, they saw the real value. They ignored the fear, and they swooped in and bought the entire company for a price that just dwarfed what the public market thought it was worth.
Or how about this one? This is just incredible. Back in 1990, you had this company, Capital Cities/ABC. A fantastic business, a consistent growth machine. Well, they announced that for one single year, their earnings were just going to be flat. Not a loss, just flat. And what did the market do? It completely freaked out and knocked the stock down by 40%. That is the kind of massive overreaction that creates a golden opportunity.
Okay, we've covered the right mindset, the right business, and the right price. That brings us to our final play. And honestly, this might be the toughest one to master. It's the discipline of doing nothing.
You know, the entire financial world, all the TV shows, they're all about action. Buy this, sell that, moving, trading, shifting. But real long-term investing success, it often comes from these long, quiet periods of inaction, broken up by these very rare moments of decisive, well-thought-out moves.
And this is where Buffett uses that famous, brilliant baseball analogy. In baseball, right, the pitcher throws, and if 3 pitches go by that are in the strike zone and you don't swing, you're out. But in the stock market, thousands of pitches can go by. Overpriced stocks, companies you don't get, the latest fads, and you don't have to swing at a single one of them. There are no called strikes. You can just stand there at the plate and wait for that one perfect pitch right in your sweet spot.
And that's exactly why waiting is so incredibly difficult, right? We feel like we have to do something with our money. It feels like it's burning a hole in our pocket. And that impatience is what sends us chasing after the hot new thing, abandoning a perfectly good strategy just for the thrill of being in the game. So, it really brings us full circle, doesn't it? This whole playbook is about one thing: replacing the mad emotional enthusiasm of the crowd with your own cool-headed, sound business judgment. You do the homework, you find the great business, you wait for the market to get scared and offer you a great price, and then you act with conviction. So, I want to leave you with this final thought. This playbook, it's not some dusty old history lesson. It's a lens you can use right now, today. The market is always throwing pitches. But here's the thing, optimism rarely serves up a bargain. It's pessimism, it's fear that creates the most profitable opportunities. So the real question for you is, can you spot the fear out there today? And maybe more importantly, do you have the discipline to wait and swing only when that one perfect pitch comes right over the plate?
When you hear the name Warren Buffett, what comes to mind? For most of us, it's just this incredible, almost unimaginable level of wealth. But what if his real secret isn't some complex formula locked away in a vault? What if it's actually a mindset, a system that you and I can learn? Well, today, we're going to crack open a book called BUFFETTOLOGY. And what makes this book so special is that it wasn't written by a journalist looking in from the outside, but by a true insider who saw it all firsthand. We're going to dive into the framework she uncovered from inside one of the most successful financial families in the world.
And you know, Fitzgerald was onto something. There's this mystique around the super wealthy, right? We kind of imagine their financial lives are governed by these hidden rules and secrets that are just way beyond the rest of us. It sets them apart, puts them on this pedestal that feels a million miles away from the everyday person trying to invest.
But here's the big idea, the one that changes everything. What if the real difference, the one that truly matters, isn't about the money at all? What if it's about the thinking behind the money? What if the secret is really a philosophy, a way of looking at the world that can actually be studied, understood, and maybe even applied by us? That's what we're going to get into today.
So first things first, you got to understand what makes this book, Buffettology, so different from all the others out there. This isn't another biography filled with cute stories about Warren drinking Coke and eating at McDonald's. Not at all. Think of it as a user's manual, a really detailed breakdown of his actual investment system. The entire point of the book is to teach this one foundational concept: business perspective investing. Now, I want you to burn that phrase into your mind because it is the key that unlocks everything we're going to talk about. It's all about a fundamental shift in how you think, from being a stock picker to becoming a business owner. So who is our guide for this? Who's the person who laid out this system? This is where the story gets really, really interesting. The author is Mary Buffett, and for 12 years, she was Warren Buffett's daughter-in-law. This gave her a front row seat, not just to the family, but to the incredible financial mind at the center of it all. I mean, just try to imagine her position. It's 1981, and she marries into this legendary family. She's at the dinner table, she's part of the private conversations, but she's also bound by this strict family code of silence. You just did not talk about Warren's investment work outside the family, period. And then, after 12 years, the marriage ends. All of a sudden, she's on the outside, but she's walking away with over a decade of priceless first-hand knowledge that was supposed to stay secret. And this put her at a fascinating crossroads. That code of silence, it didn't apply anymore. And you can bet literary agents started calling immediately. They saw a golden opportunity for a juicy, sensational tell-all book about the famously private billionaire. And as she put it, the offers were very enticing. Now, this is the critical choice she made. She had two paths. She could have written that tell-all, a lucrative exposé about the past that would have sold millions of copies, no question. Or she could write a manual for the future. She made a bet that what people really wanted wasn't the family drama. It was the answer to the real question: how did Warren Buffett actually do it? She chose to share the blueprint for creating wealth, not just gossip about it. So you might be wondering, how did she learn all this stuff? It wasn't like she sat in on board meetings or went to business school with him. A lot of her education came from just paying attention to everyday family life, like this brilliant Christmas tradition that Warren turned into a masterclass on investing. Okay, so picture this. In the early years of her marriage, Christmas was pretty straightforward. Warren would just hand out envelopes to the family, and inside each one was $10,000 in cash. I mean, a very generous gift, right? But then, one year, he made a really subtle but profound change. He stopped giving cash. Instead, he started giving everyone $10,000 worth of stock in a company he had just bought, like Coca-Cola. You see the brilliance here, don't you? The cash was passive. You just take it and spend it. But the stock was active. Suddenly, the family weren't just getting money, they were partial owners of real businesses. So annual reports started showing up in the mail. Little dividend checks started appearing. All of a sudden, the Wall Street Journal wasn't just some newspaper anymore. It was a report card for their companies. The real gift wasn't the 10 grand, it was the education. He was forcing them, gently, to start thinking like business owners. And that little Christmas story, that's not just a cute anecdote. It's basically his entire philosophy in a nutshell. He wasn't giving out stock tips. He was giving them pieces of actual businesses that he believed in for the long haul. And that reveals a mindset that is totally different from your typical Wall Street trader. Mary observed that he had almost zero interest in the day-to-day chatter of the market. You know, the Dow is up, the Dow is down, this expert says a recession is coming. He just ignored all of it. The charts, the predictions, the panic. It was like it didn't even exist in his world. His focus was always 100% on the quality of the underlying business itself. So what kind of businesses was he looking for? Well, Mary realized he was like a collector. But instead of collecting art or rare cars, he collects a very specific kind of company he calls a consumer monopoly. Basically a business with a powerful brand that people will choose over and over again. And the perfect example of this was how he taught his 8-year-old granddaughters. He had them look at Pillsbury, not as a stock, but as the company that owned things they knew and loved: Burger King and Haagen-Dazs ice cream. The lesson was so simple: invest in what you can understand. Okay, so he's a collector of these amazing businesses. But look, any serious collector will tell you that finding the masterpiece is only half the battle. The other half, and it's arguably the more important part, is not overpaying for it. And that discipline is the absolute bedrock of his entire strategy. And you really have to let this one sink in. Here's a guy who could afford to buy almost any company on the planet. But that was never the question. The only question was whether that business was being offered at a price that made sense. Price determined absolutely everything. It was the line in the sand that separated a brilliant investment from a terrible one, no matter how wonderful the company was. And this is it. After all of that, this is what his entire multi-billion-dollar philosophy boils down to. It all comes down to answering two simple but incredibly powerful questions, in the right order. First, what to buy. You do all the work to find one of those fantastic businesses you'd want to own forever. Then, and only then, do you move to the second question: at what price? You have to patiently wait for the chaotic, emotional stock market to offer you that great business at a sensible price. According to him, pretty much everything else is just noise. Answering those two questions, what to buy and what to pay, that's the whole game. So you might be thinking, great, but how do I even begin to answer them? Well, that's exactly what the book Buffettology is designed to do. It gives you the roadmap. The book is basically split right down the middle, and it perfectly mirrors those two questions. The first half is what you might call the art. It's the qualitative stuff, the theories and ideas you need to identify those excellent consumer monopoly businesses. The second half, that's the science. It's the quantitative part, full of the specific math and equations you need to figure out exactly what price is the right price to pay. It's art, then science. What to buy, then what to pay. You know, in the end, it all circles back to this powerful idea from Buffett's own mentor, the father of value investing, Benjamin Graham. He wrote, "Investment is most intelligent when it is most business-like." That's the whole thing. You're not buying a flickering ticker symbol on a screen. You're buying a piece of an actual operating business. If you can keep that one idea front and center, you are on the right track. So when you peel it all back, what Mary Buffett's insider account really shows us is that the holy grail of investing isn't a secret formula or a hot stock tip. It's a disciplined, business-focused mindset. It's a way of thinking that separates logic from emotion and true ownership from just pure speculation. The question isn't just about what you know, but how you think. And adopting that mindset, well, that's the real challenge, but it's also the real opportunity. You hear the name Warren Buffett, and you immediately think of investing success, right? I mean, the guy is a legend. But have you ever really stopped to think about how a man from Omaha, Nebraska built a literal empire just by picking stocks? Well, we're about to pull back the curtain on the core philosophy that made it all happen. Yeah, you heard that right. $20 billion. And that figure is from back when the source material for this explainer was written. Now, he didn't do it with some flashy new invention or a Silicon Valley startup. He did it by investing, a game that technically is open to every single one of us. The key word there, the one that changes everything, is solely. Look, plenty of people have gotten rich because of the stock market, but usually it was a side effect of a business they'd already built. For Buffett, investing was the business. He somehow managed to tame the chaos and the emotion of the market and turn it into a relentless wealth-building machine. So what's the secret sauce? I mean, think about it. When the rest of the world is panicking and selling everything, he's calmly buying. When everyone's high on euphoria and greed, he's sitting on the sidelines, waiting. It's totally counterintuitive, right? It feels like some kind of magic. But as we're about to see, it's not magic at all. It's discipline. All right, so here's how we're going to break it all down. First, we'll tackle the mindset that truly sets him apart. Then, we'll decode his number one tool for making decisions. After that, we'll literally walk through his playbook, rule by rule. And finally, we'll talk about how you can apply these same ideas to your own financial life. Okay, so at its very core, Buffett's entire philosophy boils down to this battle between two opposing forces: the wild, emotional foolishness of the market and his own unshakable business logic. And this really lays it all out, doesn't it? On one side, you have the herd. They're driven by emotion, pure fear when the market drops, pure greed when it soars. They speculate, they guess, they panic. But Buffett, he operates from a completely different place. He thinks like a business owner. To him, a 500-point drop in the market isn't a crisis. It's a clearance sale. He literally uses the market's fear as his greatest opportunity. And this is the secret weapon. It's this fundamental shift in thinking. He's not buying a stock ticker that bounces around on a screen. He's buying a piece of an actual, living, breathing business. Every single decision he makes is filtered through one simple question. Does this make sense from a business perspective? This one mindset is the bedrock of his entire strategy. Okay, so if you're going to think like a business owner, how in the world do you figure out what a business is actually worth? You can't just guess. Well, Buffett uses a master tool for this. It's a concept called intrinsic value. Now, let's just cut through all the Wall Street jargon for a second. Intrinsic value is really just a fancy way of answering one simple question. If I buy this business at this price today, what kind of annual return can I honestly expect to make over the long haul? That's it. It gives you one clear, objective number you can use to compare any investment to any other investment. Okay, let's make this real. Let's walk through a super simple example. Let's say you can buy a share of a company for $10.
And based on your research, you project that in 10 years, that same share is going to be worth $50. Well, if you do the math, that works out to an annual return of about 17.5%. Now you have something real, something concrete. You can compare that 17.5% to what you could get from another stock or from real estate or heck, even from a government bond. It gives you a rational way to make a decision.
Okay, but hold on a second. I know what you're thinking. Projecting a business's value 10 years from now, that sounds absolutely impossible, right? It's like trying to predict the exact weather a decade out. How can anybody possibly do that with any real certainty? And here's the genius of it all. Buffett doesn't try to solve the impossible problem. He just avoids it entirely. He knows he can't predict the future of some speculative biotech firm or a volatile new tech company, so he doesn't even try. He only invests in businesses whose earnings are incredibly boring and predictable. Companies that sell things people need and want, day after day, year after year.
Okay, so let's recap. We've got the mindset, think like a business owner. We've got the tool, calculate the intrinsic value based on predictable earnings. Now, let's get into the nitty-gritty. Let's look at the specific rules he follows to put this all into action. Welcome to the Buffett playbook. All right, secret number 1. And you got to understand, this is the big one. This is the foundation for everything else. It's the gatekeeper, the very first filter that decides if an investment is even worth his time. This is his absolute number 1 filter, his non-negotiable. If he can't look at a company and say, with a high degree of confidence, I have a pretty good idea of what this business will be earning in 10 or 15 years, he just walks away. End of story. It doesn't matter how exciting the company sounds. If the future is a question mark, the answer is always no. So that begs the question, right? What exactly makes a business predictable? How do you even spot one in the wild? Well, the next couple of rules in the playbook are all about identifying the very specific traits that Buffett looks for. These are the signs of a truly fantastic business. He's on the hunt for businesses with what he calls excellent economics. What's that mean? Well, they consistently make a high return on the money that's been put into them. Their earnings are strong and stable, not all over the place. He loves a good consumer monopoly, a brand so powerful that it's just the default choice, like Coca-Cola and soft drinks. That gives them a huge advantage. And finally, he has to trust that the people running the show are actually looking out for the shareholders, not just themselves. All right, rule number 4. Now, this one sounds so simple, so obvious, but it's amazing how many investors completely blow it when things get emotional. It's all about the price you pay. Remember that example from a minute ago? The $10 stock that went to $50? Well, what if you paid $20 for that exact same share? The company is the same, the future is the same, but your annual return just got cut in half, from over 17% down to about 9%. Same great company, totally different price, and a wildly different outcome for you as an investor. You can fall in love with a business, but if the price isn't right, it's a bad investment, period. And now for secret number 5. This is the one that really brings it all home. It's where the art of patience meets the science of valuation. It's all about waiting for that perfect moment to make your move. The book uses this analogy, and it's perfect. It's so good. See, Buffett doesn't go chasing after the most popular, overpriced stocks of the day. No. He identifies the great businesses he wants to own. That's the girl he wants to date. And then he just waits. He waits for the market to have a meltdown or for the company to hit a little rough patch, for the price to fall out of favor, for her to break up with her boyfriend. That's his signal. That's when he steps in. All right, we've walked through the philosophy, the tools, the actual playbook. But let's be real. This isn't just some academic exercise. The whole point is to understand the core principles for building real, lasting wealth. And this right here is probably the most important thing to get. Buffett's method is not a get-rich-quick scheme. It is the exact opposite. It's a get-rich slowly but surely discipline. It's all about aiming for a consistently good return, say 15% or more, year after year, and just letting the incredible power of compounding do its work over decades. That's how real fortunes are actually built. Because in the end, it really all boils down to one thing. The ideas we've talked about, they're actually pretty simple. The really hard part, the real challenge, is having the discipline to ignore all the noise, to do your homework, to wait patiently for the perfect pitch, and then to act decisively when it finally comes. That discipline, that's the real secret. That's the $20 billion difference. When you think of Warren Buffett, one name probably pops into your head right away: Benjamin Graham. The story is the stuff of legend, right? The brilliant professor takes this young kid under his wing, and that kid grows up to be the greatest investor of all time. It's a nice, neat story. But the real story, the real story is so much more complicated and honestly a whole lot more fascinating. It's not about one teacher. It's about weaving together an incredible intellectual tapestry. So let's pull on that first thread. Everything, and I mean everything, starts with this one idea. Benjamin Graham wasn't just Buffett's professor at Columbia. He was his first boss, his mentor, a lifelong friend. And he drilled this one concept into his head. Stop thinking about stocks as flashing tickers on a screen. Start thinking about them for what they are, pieces of an actual business. That concept right there, that's the bedrock the entire empire was built on. And man, what an empire he built. Get this, it all kicked off in 1957. He put together a little partnership with about $100,000 from friends and family. And by sticking to Graham's business-first approach, he spun that into a personal fortune in the tens of billions. The results are just staggering. They speak for themselves. But the method he used to get there, well, that's where the real story begins.
I mean, think about it. If it was really as easy as just reading Graham's book and following the rules, why aren't there 1,000 Warren Buffetts running around? It forces you to ask a really important question. Is Benjamin Graham the beginning and the end of the story? Or is there something else going on? Something hiding just beneath the surface?
Okay, so let's be crystal clear on what Graham gave him. It was basically 2 killer tools for his toolbox. First, that business perspective we just talked about. And second, an obsession with price. The whole game was to find a business that was trading for way less than it was actually worth. You know, the classic bargain hunt. This was the foundation, the starting block.
But here's the rub. In any competitive arena, whether it's sports or investing, this same strategy doesn't work forever. The world of the 1970s and 80s was a completely different ballgame from the post-Depression era, where Graham cooked up his theories. All the easy bargains started to dry up, and Buffett realized, he knew, that to keep winning, he couldn't just use the old map. He had to evolve.
And this quote just nails it perfectly. Think of Graham's ideas as the solid, concrete foundation of a house. It's absolutely essential. You can't build anything without it. But Buffett wasn't content to just live in the basement, you know? He built a spectacular, sprawling mansion on top of that foundation. And he used blueprints from a whole bunch of other master architects to do it.
So who were these other architects? What's in this secret recipe? Well, it's this wild, eclectic mix of thinkers. You've got legendary investors, you've got mathematicians, you've got world-famous economists, but the real magic isn't just the list of names. The genius is in how he took all their different, sometimes even conflicting ideas and wove them together into one single, powerful, and pretty much unbeatable philosophy. All right, first up in this secret recipe, Philip Fisher. Now, if Graham was the king of old-school East Coast value investing, Fisher was this revolutionary pioneer of growth investing out on the West Coast. And his way of thinking was, in a lot of ways, the complete opposite of Graham's, numbers first, bargain hunting approach. And it was about to change Buffett's entire game. Fisher's big idea was an absolute game changer. He's the guy who came up with that famous line, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He completely shifted the focus. It wasn't just how cheap is it anymore. Now it was how good is this business? And then he dropped this other bombshell. If a business is truly excellent, the best time to sell it is pretty much never. Okay, so let's add another ingredient. If Philip Fisher taught Buffett what kind of business to buy, our next guy taught him a new way to figure out what it was worth over the long haul. His name was John Burr Williams. Probably not a name you hear every day, but this guy was a super influential financial thinker back in the 1930s, and his ideas gave Buffett a whole new way to see the future.
See, Graham was always focused on the here and now. What are the assets worth today? What are the earnings right now? Williams came along and basically said, hold on a minute. The true value of a business isn't what it has in the bank today. It's the total sum of all the cash it's going to generate from now until the end of time. This just added a whole new forward-looking dimension to Buffett's thinking.
Now for our next influence, we've got a name you probably weren't expecting to see here. We all know him for his giant economic theories that literally shapes countries. But it turns out he was also a fantastic investor. We're talking about the one and only Lord John Maynard Keynes. And his big contribution to the Buffett philosophy wasn't about valuing a company. It was about how you build your whole portfolio. Keynes was a brilliant investor, and he thought the conventional wisdom about diversification was, well, kind of nonsense. His philosophy was simple. Forget spreading your money across 100 different stocks. He said, put all your eggs in just a few baskets, baskets you know inside and out, and then watch those baskets like a hawk. This idea gave Buffett the intellectual firepower to make those massive, concentrated bets that made him famous. And that brings us to the final, and maybe most important, piece of the puzzle, the catalyst. The person who helped Buffett connect all these different dots. And this wasn't some author from 100 years ago. This was his partner, his intellectual sparring partner, and his best friend, the legendary Charlie Munger.
Look, you have to understand, Munger was the one who really brought it all home. He was the guy constantly in Buffett's ear, pushing him to move past that old cigar butt style he learned from Graham. You know, the idea of finding a discarded, soggy cigar on the street that has one last free puff in it. Munger hated that. He was the one who relentlessly hammered home the point that paying a fair price for a great business isn't just okay, it's the whole secret to long-term success. Now, blending all these ideas together wasn't just some fun thought experiment for Buffett. It completely transformed how he invested his money. He didn't just tweak Graham's model. He built something entirely new, a completely different animal. And you can see just how different it is when you put him side by side with another one of Graham's star students. So on one hand, you've got Walter Schloss, an incredible investor, but a pure Graham disciple. His portfolio was huge, 100 stocks, sometimes even more. For him, price was the only thing that mattered. The second a stock hit what he thought it was worth, boom, he sold it, no emotion. Then you've got Buffett, a super concentrated portfolio. The quality of the business was just as important as the price. And his strategy, hold on forever, as long as the business stays great. They're playing two completely different sports. And this new, synthesized Buffett approach has two massive advantages. First, by holding on to these great businesses, he lets the incredible power of compounding go to work. The companies earn money, reinvest it, and the snowball just gets bigger and bigger every year. And second, and this is huge, by not constantly selling, he avoids writing a giant check to the tax man every year. That money stays in his pocket, compounding even more. It's just a profoundly smarter way to build wealth. So this brings us to the big final question, doesn't it? All these ideas are out there. You can go read the books by Fisher, Keynes, and Williams tomorrow. The information is public. So why isn't there an army of Buffett clones running around? Why is he still in a league of his own? The answer, when you think about it, is simple and absolutely brilliant. He's like a master chef. He's happy to tell you the general ingredients. Oh yes, my famous sauce has tomatoes, basil, and garlic. But is he going to give you the exact measurements, the cooking time, the secret technique his grandmother taught him? No way. Buffett shares the principles, but he knows his best, most specific ideas are proprietary. He's a teacher, but he's also a competitor. He's not giving away the whole recipe. So, when you boil it all down, the ultimate lesson from Warren Buffett's incredible career isn't about finding that one perfect mentor or that one magic formula. True genius, the kind that lasts a lifetime, comes from synthesis. It's about being curious enough to pull great ideas from different fields, from different masters, and combining them into something that's new, something that's uniquely your own. That's the real foundation of his success. And it leaves us all with a pretty big question to think about. What seemingly unrelated ideas are out there just waiting for you to bring them together? You ever stop and wonder, why do so many people, I mean smart people, just get wiped out in the stock market, even when things are supposedly going great? Well, the answer? It's probably not what you think. It's because they're playing a totally different game. And today, we're going to flip the script. We're going to talk about how to stop what is essentially gambling and start investing like you actually own the place. All right, so here's the game plan. First, we're going to pull back the curtain on what I call Wall Street's folly. You know, the usual madness. Then we'll get into the secret weapon, the discipline of no. It's all about what not to do. After that, we'll tackle the big one, the complete mindset shift you have to make. And we'll wrap it all up by looking at how this whole idea came to be, right up to the master himself, Warren Buffett. So let's start where pretty much everyone starts, in the thick of it, right? The world of conventional investing. This is the world you see on TV, the stuff peddled by the big Wall Street firms, and honestly, it's a world built on principles that for most folks just leads to a whole lot of frustration. It's all noise, it's all about guessing what's next, and it's totally focused on the short term. Okay, that sounds a little over the top, right? Financial lunar landscape. But listen, the stakes really are that high. This quote nails the biggest danger out there, following the crowd. The minute you step off a disciplined, business-first path, you're a pinball. You're just bouncing between the two emotions that run the entire show, fear and greed. And you know what that means, right? It means buying when everyone's euphoric and selling when everyone's panicking. You're always one step behind. And that right there, that's the heart of the problem. Wall Street folklore. I love that phrase. It's just perfect. It's all those myths, the little bits of wisdom that sound smart but are actually poison. Things like, oh, you gotta buy what's hot, or I'm gonna time the market perfectly, or my favorite, just buy 100 different things you know nothing about. It's a great story they sell you, but trust me, the ending is rarely a happy one. But, and this is a huge but, here's the twist. This is probably the most important thing we're going to talk about today. All that chaos, all that fear and greed, it's not just something you need to run away from. It's actually a massive opportunity. The foolishness of the crowd is exactly what creates the bargains. Their panic, their mistakes, those become your golden opportunities. Okay, so how in the world do you break out of that cycle? How do you escape the gravitational pull of fear and greed? The answer is, well, it's incredibly simple, but man, is it hard to do in practice. Think of it like this. If the sickness is feeling like you always have to do something, buy this, sell that, trade, 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 then the cure is the discipline to just sit there, to do almost nothing. It's a whole philosophy built around patient, strategic inaction. It's about harnessing the power of one little word, no. And this, right here, is the core of it all. It's one simple, profound rule to live by. You only put your money to work when it makes absolute, rock-solid business sense. I mean, it has to be so obvious that it feels like you're buying a slice of the local pizza shop that you know has a line out the door every single night. You're not buying a ticker symbol. You're not buying a blip on a screen. You're buying a piece of a real, living, breathing business. Okay, and this is where it gets really, really cool. The guy who basically invented this whole way of thinking, Benjamin Graham, the father of value investing, he called it a negative art. A negative art. I love that. Think about it like you're the bouncer at the coolest club in town. Your main job isn't finding people to let in. It's keeping almost everybody out. You're standing at the rope, and for investors, the wrong people are the lousy businesses and the ridiculously overpriced stocks. So at its very heart, this whole discipline is just a giant, powerful filter. Its number one job is to tell you what to say no to. It's your shield against bad ideas, against getting suckered into overpaying for something, and against pure speculation that's dressed up to look like a smart investment. You might look at 1,000 companies, and this filter will tell you, nope, 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 to 999 of them. And that, right there, is where all the power comes from. Now, getting this right, it's not just learning a new trick or a new technique. This requires a total rewiring of your brain, a complete and, let's be honest, sometimes really uncomfortable shift in how you see everything. Stocks, the market, even what money is. It's a fundamental change in your financial DNA. So let's just throw a question out there. Let's challenge a big one. Seriously, think about this for a sec. What is the absolute dumbest reason to buy a stock? I mean, the one you hear all the time. There it is. The number one absolute worst reason to buy a stock is simply because you think the price is going to go up. That's it. That's not investing, my friends. That's pulling the lever on a slot machine. A real investor, someone who thinks like a business owner, they couldn't care less what the price does tomorrow or next week. They care about one thing. How healthy and profitable is this business going to be for years to come? All right, here's another brain twister for you. You're scrolling through and you see a stock. Price tag is $1,500 a share. What's your gut reaction? I'll bet it's something like, whoa, no way, that's crazy expensive. But is it? Here's what the business perspective tells us. That per share price, it's pretty much the most useless number you can look at. I mean, think about it. Would you rather buy a beautiful mansion for $1 million or a rundown shack for 10 grand? The mansion, right? It's a no-brainer. It's exactly the same with stocks. That $1,500 stock might be the mansion, an absolute steal if the business is really worth $3,000 a share. And that little $2 stock, that could be the shack, a total ripoff if the business is heading for zero. The point is, you have to stop looking at the price tag and start asking, what's the value of what I'm buying? And this is where the magic really kicks in. The moment you stop chasing those fast, flashy profits and start thinking like you own the joint, your whole idea of what a good return is gets turned on its head. You're not looking for a lottery ticket anymore. You're not trying to score a quick 25% pop in 6 months. No, you're hunting for a compounding machine,
A beautiful business that just churns out steady, reliable value year after year after year. And believe me, the changes just keep coming. Your whole world flips upside down. Suddenly, you'll see a market crash, and instead of panicking, you'll be thinking, yes, it's a sale. You stop spreading your money thin and start concentrating on just a few amazing businesses you know inside and out. You'll even find yourself walking through the supermarket and getting your best investment ideas right there in the cereal oil. It changes everything. So, where did this powerful idea come from? Well, it didn't just pop into existence overnight, no. It's got a pretty amazing family tree, a rich history that was built and refined over decades by some of the absolute sharpest minds in the history of finance. It all kicks off with Benjamin Graham. He's the godfather. He literally wrote the book on the idea that investing should be businesslike. But then, other brilliant minds like Phil Fisher and the legendary Charlie Munger came along and added these crucial new layers. They said, hey, it's not just about buying cheap stuff, it's about buying great stuff. And then, of course, you have Warren Buffett, who took all those pieces, put them together, and created the absolute powerhouse approach that made him a legend. And for Buffett, there was this incredible aha moment, this conflagration of clarity. He realized his mentor, the great Ben Graham, was only telling half the story. It wasn't just about finding cigar butts on the ground with one puff left. It was about buying incredible businesses. That's when he came up with his famous line, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And that one simple idea, that's what took him from being a really good investor to being, well, the greatest. And that brings us right back to the beginning, doesn't it? Back to Graham's core idea. Investment is most intelligent when it is most businesslike. That phrase, that should be your North Star. It's the one question you have to ask yourself over and over again with every single decision you make. Is this businesslike? So, I'll leave you with this one last question, and it's the only one that really matters. The next time you're about to click that buy button, ask yourself, what am I really doing here? Am I just playing the market's game, gambling on squiggly lines on a chart? Or am I making the serious, deliberate choice to become a part owner of an actual business? Because your answer to that single question, well, it's going to determine your entire financial future.
Welcome to The Explainer. Today, we're going to cut through all the noise of the stock market. We're going to explore a really powerful investment philosophy that trades, the wild chaos of daily price swings for the simple, powerful logic of owning a piece of a real business.
And it all really starts with this one single idea from the legendary investor and teacher Benjamin Graham. I'm serious. This one sentence is the key to unlocking one of the most successful investment mindsets in history. I mean, this is the foundation that guys like Warren Buffett built their entire fortunes on.
We're so often encouraged to see the market just like this, a frantic, chaotic horse race where prices are just numbers jumping up and down on a screen. And our job is just to guess the next winner. It's exciting, sure, it's fast-paced, but is it really the smartest way to build wealth?
What if chasing those fleeting numbers is a complete and total distraction from where the real value is actually created? Today, we're going to flip that whole perspective on its head.
Okay, so here's how we're going to break it down. First, we'll reframe what the market really is. Then, we'll compare two totally opposing mindsets. After that, we'll walk through a simple, real-world test, face a critical decision, the quick gain versus long-term value, and then finally, we'll uncover what the real prize is in all of this.
All right, Section 1. Let's get right into it and start by tearing down that big Wall Street myth. The idea that the stock market is just some game to be played for its own sake. You have heard this language 1,000 times on the financial news channels, right? It's the language of the horse race. This stock is hot. You gotta get in before it's too late. It creates this sense of urgency, and frankly, it's designed to trap you in the short-term thrill of the game.
But here it is. This is the crucial mindset shift. When you buy a common stock, you are not just buying a ticker symbol. You are buying a tangible piece of an actual operating business. You're becoming a part owner of a real enterprise, one with buildings and employees, products, and customers.
So, this one fundamental difference, seeing a stock as a business, not just a blip on a screen, it leads to two completely different approaches. And it all starts with the questions you ask right from the beginning. Now, just look at how a subtle change in wording here completely reframes the entire goal. The Wall Street view focuses on the security and its price. It's a trading mentality, pure and simple. But the business owner view, that focuses on the enterprise and the terms of the deal.
That tiny little shift moves you from being a speculator to an owner.
And of course, these different questions lead to vastly different motivations. For a lot of folks on Wall Street, the pressure is just immense. The goal is the quick kill because your performance is judged quarter by quarter. A couple of bad quarters and you could be out of a job. The business owner, though, is playing a completely different game. They're aiming for the highest predictable compounding return over many, many years, with as little risk as they can possibly take on.
Okay, let's make this less abstract. We're going to use a simple analogy here to see how this business-like approach really works in the real world. This is what makes the whole concept crystal clear.
I want you to forget the stock market for just a second. Imagine someone offers you the chance to buy the entire drugstore in your neighborhood. You wouldn't be frantically checking a screen to see if its price went up yesterday, would you? Of course not. You'd act like a true business owner, and you'd do some simple, logical homework.
You would instinctively follow these 5 common sense steps, right? You'd check the books to see what it's earning. You'd analyze if those profits are consistent. You'd think about any future risks. You'd find out the total asking price. And then, most importantly, you'd calculate your potential return on that investment. So let's plug in some simple numbers to make this real. Let's say the asking price for this consistently profitable drugstore is $100,000. And when you look at the books, they show it reliably earns $20,000 a year in profit.
The math here is pretty straightforward. You just divide the $20,000 in annual earnings by the $100,000 price tag, and that gives you your return, a predictable 20% on your money year after year for as long as you own this solid business. Not bad at all.
Okay, so now you own this fantastic local business, and it's generating a solid 20% return. Life is good, but then you get an interesting offer, an offer that puts your entire mindset to the test. Someone walks in off the street and offers you $135,000 for the business you just bought for $100,000. That is a quick, easy 35% profit on your money. So what do you do? This right here is the moment of truth, and it's where those two mindsets diverge dramatically.
The Wall Street mindset says, sell immediately, right? A 35% gain is a huge win. That is the quick kill they're looking for. But the business owner, they pause. They think to themselves, hold on, a predictable 20% annual return is incredibly hard to find. Why on earth would I give up this wonderful money-making machine for a one-time payment? And the business owner's logic goes even deeper than that. First, that 35% profit gets hit by taxes, right? So it's knocked down to maybe 25% if you're lucky. But more importantly, you now have a new, much harder problem. Where on earth are you going to reinvest that cash to get another predictable 20% return? Good businesses are rare. And as the saying goes, a good businessman likes to keep a good business.
So this brings us to the final and really the most crucial takeaway from this whole philosophy, understanding what the real prize of investing truly is. See, the ultimate goal isn't that one-time, fleeting profit. It is the long-term compounding power that comes from owning the powers of production, from owning great enterprises that consistently generate value over time. That is what truly builds lasting wealth.
So, the next time you look at any investment, I want you to ask yourself this one simple but incredibly powerful question. Are you just playing the market's numbers game, hoping for a quick win? Or are you looking to become a part owner in a wonderful business? Answering that question honestly is the first and most important step toward becoming a more business-like investor. When you think about a company's profits, what's the first thing that pops into your head? For most of us, it's that dividend check, right? The one that shows up in the mail. But what if that's a completely backward way of looking at it? Today, we're diving deep into Warren Buffett's powerful and, let's be honest, pretty unorthodox view on corporate earnings. It's a perspective that literally built one of the most successful companies in the history of the world. So let's break down how he thinks. All right, so here's our game plan. We're going to tackle this in 5 parts. First, we'll look at the dividend dogma, the old school way of thinking. Then, we'll see how Buffett flips that on its head with his idea of your money, their company. After that, we'll unpack the billion-dollar test he uses for decisions, see the incredible results in the power of patience, and wrap it all up by rethinking everything with stocks are not lottery tickets.
So, let's kick things off with the conventional wisdom, the idea that's pretty much ruled investing for 100 years, the dividend dogma. It really gets to the heart of why Wall Street gets so excited about getting that check in the mail.
And this quote pretty much sums it up, doesn't it? This is the traditional view. If a company isn't handing out some of its profits to shareholders, the immediate assumption is that something's wrong. Maybe they're not confident, or even worse, maybe they don't have the cash. For a lot of folks on Wall Street, a dividend is cold, hard proof that a company is healthy. So no dividend? That's a big red flag. But where did this idea even come from?
Well, you kind of have to go back in time to get it. It's really a cultural thing. In the early days, serious investors loved bonds. They were safe, they were backed by assets, and you got that regular interest payment. That check was your proof that everything was chugging along just fine. Stocks, on the other hand, they were the Wild West. Without any real rules, accounting was a mess, and stocks were seen as super risky. Now, even after the SEC came along in the 40s and made things way safer, that deep-seated desire to get a regular check, it just stuck around. The habit remained, even after the original reasons were long gone.
Okay, so that's the old way of thinking. Now let's get to how Buffett just completely turns this whole idea upside down. He totally rejects the dividend dogma with a view that fundamentally changes what it even means to own a piece of a company.
This right here, this is the absolute heart of his philosophy. He calls it owner earnings. And the idea is that a company's profits are your profits the second they are earned. So let's say a company earns $5 a share and you own 100 shares. Well, in Buffett's world, you just made $500. Period. It doesn't matter if they mail you a check for it or not, that money, it's already yours. It's such a simple concept, but man, it changes everything.
So here's the crucial fork in the road. Once the company has your earnings, it has a choice to make. It can either send that money out to you as a dividend, which, by the way, you then have to pay taxes on, or, and this is the absolute key, it can keep your money inside the company and reinvest it for you on your behalf. See, Buffett looks at management as your employee. Their whole job is to make smart decisions with your capital to make your business more valuable.
And this brings us to the $1 million, or, in this case, the $1 billion question. If it's your money, what's the smarter play? Should you demand they give you the cash right now so you can decide what to do with it? Or should you trust the people running the show to put that money to work and grow the business for you?
Well, Buffett has a very, very clear test for this.
And this is where we get to the decision-making framework, what I like to call the $1 billion test. It's just a simple, incredibly logical filter that tells a company what it ought to do with its profits.
It's all laid out here with pure, cold logic. It starts with $1 of profit. From there, management has one critical question to answer. If we keep this dollar, can we invest it in a way that creates more than $1 of future value for our owners? It's that simple. If the answer is a clear yes, they keep the money and grow the business. If the answer is no, then their duty is to send that dollar back to you as a dividend.
And this just brilliantly highlights the most important piece of the entire puzzle, the management team. This whole philosophy is built on a foundation of trust. You absolutely need managers who are not just skilled, but who are honest agents working for you, the shareholder. Bad managers will keep the earnings just to build bigger corporate empires that make them look good, but do nothing for the actual owners. Great management, though, sees every single dollar of retained earnings as the owner's capital and works like crazy to put it to profitable use.
But, talk is cheap, right? Does this stuff actually work in the real world? Well, let's look at the ultimate proof in action. The decades-long case study of Buffett's own company, Berkshire Hathaway. Now this is where it gets really, really powerful. For decades, Buffett has proved over and over that he can pass his own test. On average, he has managed to reinvest Berkshire's earnings at a staggering 23% annual rate of return. Now think about it. If he'd paid that money out as a dividend, the shareholder would have immediately paid taxes on it, knocking their return down to less than 16%. So by keeping the money, Buffett was able to compound his shareholders' money at a much, much higher rate than they could have on their own. So what's the result of all that patience? Of all that long-term reinvestment? Well, it's pretty staggering. Back in the early 80s, a single share of Berkshire Hathaway stock was about $500. Today, that same share is worth around $45,000. And here's the absolute kicker. Berkshire Hathaway has never paid a dividend, not one. That entire explosion in value came from one thing, the profitable reinvestment of owner earnings year after year after year. It is the magic of compounding in its purest form. So, this brings us to the final and maybe the most crucial mental shift. If you really buy into this view of earnings, it forces you to stop thinking about stocks as just flashing green and red tickers on a screen. You have to start thinking about them as something much more real. Buffett simplifies this just beautifully. He says, forget the stock market for a second. Imagine you're buying the pizza place down the street.
You wouldn't be obsessing over what people thought it was worth from minute to minute. No way. You'd focus on two incredibly simple things. What's the asking price to buy it? And how much cash does this place actually make every year? That's it. Buffett argues you should apply that exact same simple logic whether you're buying the whole company or just one single share.
And this is exactly how you do it. You start treating that stock like a bond, what he calls an equity bond. The interest payment isn't some fixed number, it's the company's annual earnings. So if you pay $10 for a share and that company consistently earns $2 per share every year, your underlying rate of return on the business itself is 20%. It's not about the stock price going up or down. The price you pay is what determines your return.
And that leaves us with the one final question you really have to ask yourself. Are you playing a game of guessing which way a stock price is going to wiggle tomorrow, or are you a business owner investing in the steady, long-term earning power of an actual company? Buffett's entire philosophy, his entire success, rests on choosing the latter. It's a profound shift in perspective, and honestly, it just might change the way you look at investing forever.
All right, let's dive into one of the most powerful and, honestly, one of the simplest rules in all of investing. This isn't some crazy complex formula. Nope. This is a core principle straight from the playbook of Warren Buffett himself. And once you really get it, really get it, you will never look at buying anything, stocks, a house, you name it, the same way again.
And there it is. That's the quote. That simple sentence is the foundation that entire fortunes are built on. It sounds almost too simple, right? But believe me, the implications are absolutely massive. Buffett literally says this is the key. So let's use it. Let's unlock this idea together.
So here's our game plan. First, we're going to hammer home that one key tenet. Then we'll prove it out with a really simple thought experiment. After that, we'll see exactly how Buffett applies this very same logic to stocks, look at a real-life case where this idea made millions, and finally, we'll boil it all down to 3 key variables that you can use yourself.
Okay, section 1, the one key tenet. Let's call it the golden rule of investing. It's so important that we get a solid grip on this because every single thing we talk about from here on out is going to build right on top of this one concept. This is it. This is the mantra. You should just repeat it to yourself. Pay more, get less. Pay less, get more. It's a fundamental inverse relationship. The more you hand over for any investment, assuming everything else stays the same, the lower your future return is going to be. It's like a law of financial gravity. You just can't escape it. All right, so that's the theory. Sounds good, right? But let's actually prove it. In this next part, we're going to use a super simple hypothetical case to show you the math, to show you exactly why the price you pay is the single most important lever for your future returns. Let's make this real for a second. Imagine I come to you with a deal. It's a rock-solid guarantee. I will give you $1,100 1 year from today. The question for you is, what would you pay me for that guarantee right now? Just take a second and think of a number. There's no single right answer, but whatever number you just thought of, it says a lot about how you think about money. Okay, let's look at the numbers. The future payout is locked in. It's going to be $1,100 no matter what. The only thing that changes is what you pay today. So if you're cautious and you pay $1,050, you make $50. That's a 4.7% return. Not bad. But look what happens if you can get it for $1,000. Your profit doubles to $100 and your return more than doubles to 10%. And what if you get a real bargain at $950? Whoa. Now your return skyrockets to almost 16%. It's the exact same outcome in the future, but you get wildly different results based on one thing and one thing only, the price you paid.
Okay, so you figured out you can get a 10% return by paying $1,000. That feels pretty good. But how do you know it's good? Is 10% a little or a lot? Well, an investment never exists in a vacuum. You've always got to compare it to your other options. And this right here is the next crucial step in really thinking like an investor.
And this is that decision-making process in action. Let's say your other choice, your safest alternative, is just putting that same $1,000 in the local bank and they'll give you a 7% return. Well, now the choice becomes crystal clear, doesn't it? Why on earth would you accept 7% when 10% is right there on the table? Our deal is just objectively better. And that's it. You've just made a perfectly rational investment decision just by comparing your options.
Now, here's where it gets really interesting. That simple bit of logic we just went through, calculating a return and then comparing it to what else is out there, that is the exact same mental model that Warren Buffett uses. There's no secret sauce. He's just applying this fundamental principle to something that just seems a lot more complicated, like the shares of a business. So how does this actually work for stocks? Well, for Buffett, the return isn't the stock price going up or down. No, it's the company's yearly earnings for each share. You have to forget about the daily wiggles of the stock market. The real question is, what is this business actually earning for every piece of it that I own? So the rate of return is just those earnings divided by the price you paid. It's really that simple. Okay, let's run another scenario to make this perfectly clear. Imagine we found this fantastic, steady Eddie company. We know for a fact that it earns $5 for every single one of its shares year after year like clockwork. The earnings are constant. The only thing that's going to change is the price the market is asking us to pay.
So scenario 1, let's say the market is in a funk. Everyone's pessimistic, this company is out of fashion, and for whatever reason, you can buy a share for just $10. So you pay $10 and you get a claim on $5 of earnings every year. You do the math, that's an incredible 50% annual rate of return. At that price, it's a screaming buy.
Now, fast forward a bit, the mood changes. People are getting more optimistic. The price for the exact same share with the exact same $5 in earnings climbs to $25. Your rate of return is now 20%. Hey, that's still a fantastic return. But just notice what happened. The price more than doubled and your potential return got sliced in half. And finally, the market is just euphoric. Everybody loves this stock, they can't get enough of it, and they bid the price all the way up to $40. But remember, the business itself hasn't changed a bit. It's still just chugging along, earning $5 per share. At this new, much higher price, your return is now 12.5%. Still respectable, sure, but it is a tiny fraction of the 50% return that was available when nobody else wanted it. Same business, totally different outcomes, all because of the price. Look, this may still feel a little bit like a classroom exercise, so let's check out a real-world example. We're going to dig into a famous investment Buffett made in a company called General Foods, and you're going to see exactly how this principle played out in the real world to generate just incredible amounts of money. Okay, so here's the story. Back in 1979, Buffett starts buying up shares for around $37 a piece. Now, why then? Well, because he saw a really solid company with earnings that were growing predictably. And sure enough, as you can see, over the next few years, those earnings just kept on climbing. Eventually, the stock price started to wake up and catch up to that reality. And then came the big finale. In 1985, Philip Morris came in and just bought the entire company, paying a whopping $120 for every single share. So this is the really critical part. What did Buffett see back in 1979? He saw that at his price of $37, his initial rate of return on the company's earnings was about 13.6%. Now, at that same time, you could get a 10% return on an ultra-safe government bond. So right out of the gate, General Foods looked better. But here is the kicker, the real genius of it. The bond's return was flat. It was never going to change. But General Foods' earnings were growing at over 8% a year. He wasn't just buying a 13.6% return. He was buying a return that was growing on its own. It was a no-brainer. And what was the final result of that simple, clear-eyed decision? An average annual return of around 21%. 21%, compounding year after year. That is how you build serious wealth. Not by chasing hype, not by following the crowd, but by patiently buying predictable earnings at a sensible price. Okay, let's wrap this all up and put it into a practical toolkit for you. We've gone through the theory, we've done the math, we've looked at the real-world example. Now let's just distill this entire philosophy down to the 3 key variables you really need to focus on. It really just comes down to these 3 things. First, what are the yearly per-share earnings? That's the engine of the whole operation. Second, and this is crucial, how predictable are those earnings? Are they consistent and growing, or are they all over the place? You have to have predictability to have any confidence in what your return will be. And finally, number 3, the market price. This is the one you have no control over, but it's the one that will ultimately decide what your rate of return on those earnings is. And that really is the heart of the strategy. Your first job is to be an analyst, to find those great businesses with strong and, more importantly, predictable earnings. That's step 1. But that's not where it ends. Your second job is to be an investor, which means having the discipline and the patience to wait until the market offers you a price that gives you a really attractive rate of return. And so we end right back where we started, with that one golden rule that governs everything. It's a law of investing you can't get around. The price you pay dictates your outcome. It doesn't matter how amazing a company is. If you pay too much, your returns are going to be disappointing. Always remember, a great company can be a lousy investment if the price isn't right.
So I'll leave you with this final thought. This principle, it's not just for stocks. It applies to everything. Buying a house, buying a car, any situation where you are treating your money today for some kind of value tomorrow. It is always, always about the relationship between what you pay and what you get. You now hold the key that unlocks this powerful concept of value. So the question becomes, what price are you willing to pay?
All right, let's talk about something that a whole lot of us have, but maybe can't quite explain at a dinner party. Stocks. You know, if you've got a 401k or any kind of retirement account, chances are you're a stock owner. But what do you actually own? What is that thing? That's the big question we're going to tackle today as we break down the building blocks of our whole economy, corporations, stocks, and bonds. Let's dive in. No, seriously, think about it for a second. When you log into your brokerage account and you buy a share of, say, Ford, did you just buy a lug nut? A tiny piece of a windshield? What is it really? The truth is actually a lot simpler and, I think, way more powerful. And together we're going to get to the bottom of what it really means to be an owner. Okay, so to get a real handle on how all this modern financial stuff works, we've actually got to rewind the clock. I'm talking way back. Because long before there were skyscrapers on Wall Street, ancient merchants and traders were already wrestling with the exact same problems we have today. These ideas weren't cooked up in some lab, they evolved over thousands of years.
You know, what's so fascinating here is you can literally see human ambition growing with each step. It all starts pretty simple, right? Loaning out grain in Babylonia. Then you get a real jump with the Greeks and Phoenician who figured out, hey, let's pool our money for one big risky voyage. But the game really changes in Venice with the idea of permanent capital, a company that keeps existing. And that leads to these massive state-sponsored companies that could fund projects on a global scale. Every single step was about figuring out how to do bigger things.
Right, so the key thing to get about those early businesses is that they were temporary. It was like a pop-up shop, but for a whole trading voyage. You know, a group of guys would get together, fund a ship to go get some spices, the ship comes back, they split the profits, and poof, the company disappears. It worked, but you can never get really, really big that way.
You're gonna love this. I mean, one of the first real corporations, the Dutch West Indies Company, had let's call it a very aggressive business model. Investors would pool their money to build warships, send them out to attack Spanish fleets bringing silver back from the Americas, and then the stolen loot was paid back to the investors as dividends. It was literally state-sponsored piracy, a hostile takeover, 17th century style. So this whole history, this constant need to get bigger, more permanent, and frankly, a lot less personally risky, it all leads us right to one of the most powerful ideas humans have ever invented, the modern corporation.
I know, this looks like something you'd skim in a legal document, but trust me, this is revolutionary. The idea that a company is its own person in the eyes of the law, that it can own things and sign contracts completely separate from the people who own it, that single idea unlocks everything. It's the whole ballgame.
And this legal personhood gives it some serious superpowers. First up, limited liability. This is the big one. It means if you invest in a corporation and it goes bankrupt, you only lose the money you put in. Creditors can't come out to your house, your car, your savings. They're safe. That was a game changer. Plus, you can raise tons of money by selling off tiny little pieces of the company, and the company itself can live on forever. These three things together are what let businesses grow to the incredible size they are today.
All right, that's enough theory. Let's make this all really concrete. We're going to start a business right here, right now. Let's call it Katie's Baking Company. And we're going to use Katie's to see how all these pieces actually work in the real world.
Okay, so Katie's needs some cash to get off the ground, right? Ovens, flour, a place to sell, all that costs money. And the classic way to get that startup cash is by selling off pieces of the business. And that brings us to the star of our show, stocks. So there it is. That's the answer to the big question from the beginning. When you buy a stock, you're not buying a product, you are buying ownership. It's also called equity. Each share is just a tiny, standardized slice of the entire company pie. You own a piece of it all, the brand, the buildings, and a claim on any money it makes in the future. So let's see how this plays out for Katie's. Let's say the company needs $10,000 to start. You've got $5,000 you're willing to invest, and hey, your sister's in for $5,000 too. So the new corporation takes your $10,000, and in return, it just creates 100 shares of stock out of thin air. You get 50 shares, she gets 50 shares. Simple as that. And there you have it. You've got 50 shares out of 100 total. That means you own exactly half of Katie's Baking Company. Your sister owns the other half. You're officially business partners, co-owners of the whole shebang.
Okay, but here comes the next big step. Katie's is a huge hit. I mean, people are lining up down the block. It's time to expand. Maybe a second location, a new delivery van. And that's going to take a lot more money. So now you and your sister, the board of directors, have a big decision to make. Where do you get the cash?
Well, instead of selling off more pieces of your company, what if you could just borrow the money? This is the other side of the financial coin. It's the world of debt, and the main tool here is something called a bond.
So this slide really lays out the two roads you can take. Option A, you sell more stock. Let's say you create 50 new shares and sell them. Now, you still have your 50 shares, but the total pie is bigger, so your piece is now smaller. Your ownership has been diluted. Option B, you borrow the money. You sell a bond. Now, you still own 50% of the company, which is great, but you have a loan to pay back with interest. So do you give up ownership or do you take on debt? That's the fundamental question every growing business faces.
Yeah, really, don't let the fancy name fool you. A bond is just a formal IOU. It's a loan. When you buy a company's bond, you are essentially acting as the bank. You're lending them money, and they're giving you a legal promise to pay you back, with interest. The key thing to remember is a bondholder is a lender, not an owner. They don't get a vote in how things are run. But they do get first in line to get paid back, which makes it a lot less risky than a stock.
All right, so Katie's is doing great, but what if the dream isn't just a second shop, but a national chain? We're talking about raising millions of dollars now, and maybe your sister wants to cash out some of her shares to buy a house. For all that to happen, Katie's has to go from being a small, private company to a public one.
And this is the moment every entrepreneur dreams of. The IPO, the initial public offering. This is the big coming out party. Katie's hires some investment bankers, and for the very first time, they sell shares of the company to absolutely anyone in the general public. It can raise a massive amount of cash, and suddenly, instead of just two owners, there are thousands.
But now you've got a whole new situation, right? You've got thousands of owners all over the world, and they're all going to want to buy or sell their shares at some point. You need an organized, central place for them to do that. The company itself already got its money from the IPO. This next part is just about owners trading amongst themselves.
And that is precisely what a stock exchange is. Think of it like a giant, highly regulated auction house, but just for stocks. The New York Stock Exchange, the NASDAQ, their job is just to provide the venue and the technology for all that buying and selling to happen smoothly and fairly, millions of times a second.
So let's just follow one single trade. Imagine a seller in California decides she wants to sell 100 shares of Katie's. At the exact same second, a buyer in Florida decides he wants to buy 100 shares. They both hit a button in their brokerage app. Those orders zip across the country to the exchange. Inside a massive server farm, a system instantly matches the buyer and seller. Click. The deal is done. The ownership of 100 shares of Katie's Baking Company just moved from California to Florida in the blink of an eye. It's pretty amazing.
Okay, so if there's one thing, just one thing, you walk away with today, I want it to be this. A stock is ownership. A bond is a loan. Let's say it again. Stock is ownership, bond is a loan. As a stockholder, you're an owner. You share in all the potential profits and, yeah, all the risks. As a bondholder, you're a lender. You're the bank, and you're just looking to get paid back. That's the core difference.
So, we've done it. We've answered our first big question. A stock is a share of ownership in a company. But that just opens up a much bigger, much more fascinating question, doesn't it? If it's just a piece of a company, how in the world does everyone agree on what it's worth? What makes that price go up or down every single second? Well, that is a whole other story for another time. Thanks for joining me.
All right, let's dive right in. We're going to tackle a huge question today, one that's at the heart of all smart investing. How do you really figure out what a business is worth? You know, it's the one skill that truly separates the pros from the amateurs. And believe me, the answer isn't what you might think. So how are we going to unpack this giant topic? Well, you might find this a little strange, but it all starts with this simple question right here. I'm not kidding. The whole secret to an investing philosophy that's made people billions, it's all wrapped up in the story of one single solitary pinball machine. Okay, so let's set the scene. Our story kicks off with this 17-year-old kid from Omaha, Nebraska. He's not just any teenager, though. He's got that entrepreneurial fire in his belly, and he's itching to put his savings to work. And what's he working with? His life savings, a grand total of $35. Yeah, that's it. Money he earned from his paper route. the hard way. Now, to you and me, that might not sound like much, but to this young guy, a kid named Warren Buffett, it was the whole world. See, he already got it. He understood that the real magic, the power of compounding, it starts with that very first dollar you put in the game.
So what does he do? He takes that $35 and buys his very first asset for his new business, a pinball machine. An old one, sure, but it works. Great start, right? Well, he immediately slams into a classic business roadblock, a big one. He's got the product, but he's got no place to put it. You know, location, location, location. The obvious spot, the local pool hall, they already have their own machines, and they sure as heck don't want any competition. So, he's stuck.
But this is where things get really interesting. This is what separates the thinkers from everyone else. Instead of just throwing in the towel, he starts thinking like a true business owner. First, he thinks, who's my customer? Well, it's the guys from the pool hall, and a lot of them have those classic crew cuts. And that little observation, that sparks an idea. It leads him to the perfect spot, Sarge's barbershop. I mean, think about it. A place with 0 pinball machines, but a room full of guys just sitting around waiting, bored out of their minds. So he goes in, he strikes a deal, his very first joint venture. Warren brings the machine, Sarge provides the floor space, and they split the profits. Genius. And did it work? Oh yeah, it worked. The results were instant. At the end of day 1, he opens up the machine, and there's $10 inside. $2 go to Sarge, and a cool $8 in pure profit goes straight into his pocket. This little business isn't just working, it's a cash machine from the get-go, profitable from day 1. Okay, so we've got a profitable business. The machine is spitting out cash. But here's the real question. What is this little operation actually worth? To figure that out, we have to switch gears a bit and translate what's happening in the barbershop into the language of accounting and finance. So let's crunch some numbers.
And the main tool we're going to use for this is something called a balance sheet. Now, don't let the name scare you. Just think of it like a photograph, a financial snapshot of the business on one specific day. And it's called a balance sheet because it has to balance perfectly. On one side, you have everything the company owns. We call those assets. And on the other side, you have everything it owes, liabilities, plus whatever the owner has invested, which we call equity. So let's look at the balance sheet for this pinball empire. See over there on the left under assets, you've got the $8 in cash he just made, plus the pinball machine itself, which he paid $35 for. So total assets, $43. Simple enough. Now look at the other side. There's no debt, which is great. The equity part is just his original $35 investment. That's the paid-in capital, plus the $8 in profit, which the accountants like to call retained earnings. Add them up, and what do you get? $43. See? It balances perfectly. So if you just go by the books, the book value of this business is $43. That's what the accountants would tell you it's worth. I mean, if you walked up to him and offered $43, he'd get his money back and his first day's profit. Sounds like a pretty good deal, right? Wrong. Hold on. This is where it gets interesting, because that question, what is this business truly worth, that's the core of everything we're talking about today. You see, that $43 book value, that's just a picture of the past. It's what happened yesterday. But the real value, the true value of any business, it doesn't live in the past. It lives in the future. It's not about what the business has made. It's all about what it's going to make. So let's do a little bit of future gazing. The business is pulling in $8 a day. Let's assume Sarge keeps his barbershop open every single day of the year. That's 365 days. So 8 times 365, you're looking at $2,920 a year in profit. Now, what if that machine keeps running in that spot for, say, 10 years? Well, suddenly you're looking at $29,200 in total profit. Whoa, all of a sudden that $43 book value looks kind of silly, doesn't it? Okay, so that raises the big question. What is that future pile of cash, that $29,000? What is it worth right now, today? To answer that, we need a really important financial idea called present value. All it really means is figuring out how much future money is worth in today's money. And it's all based on a super simple idea you already know. $1 in your pocket today is worth more than a promise of $1 a year from now, right? Let's put you in the driver's seat. Imagine you're an investor. You have 2 options. Option A, you can stick your money in a pretty safe investment, something that'll earn you, let's say, 8% a year. Option B, you can buy this pinball business. The big question is, what's the absolute highest price you should pay for the pinball business so that it's a better deal than just taking that easy 8%? Whatever that price is, that's the present value of this business. But hang on, maybe 8% isn't enough for you. I mean, a pinball machine in a barbershop has some risks, right? So let's say you're a bit more demanding. You want a 10% annual return on your money. Well, common sense tells you that if you want a higher return, you have to pay a lower price for the business today. That's just how it works. So we run the numbers again with that 10% target, and boom, there's your number. To get that 10% compounded return you want, the absolute maximum price you should pay for this business is $17,163.17. For you, with your goals, that is the true value of this business. And right there, that whole way of thinking, that process of calculating value based on future earnings, that brings us to one of the biggest dividing lines in all of finance. It's the difference between being an investor and being a speculator. This really breaks it down perfectly. You've got two completely different mindsets. The investor, on the left, they look at that pinball machine and they ask one question: how much money is this thing going to earn for me? They're focused on the cash flow, the profits. But the speculator on the right, they couldn't care less about the quarters dropping into the machine. All they care about is what someone else will pay them for that machine tomorrow or next week. Their only question is, will the price go up? It's a totally different game. And look, this isn't some abstract academic idea. It's happening all around us every single day. Think about it. A cab driver who does the math on fares versus the cost of a new taxi, that person's an investor. A guy who buys a classic '62 Corvette just hoping the price goes up so he can flip it, total speculator. A bank that lends money against an office building based on how much rent it brings in, they're investing. But someone who buys a house in a crazy hot market, paying way over asking, just betting that prices will keep going up, they're speculating. See the difference? Okay, so we've got the concept down. Now let's blow this up to a massive scale. We're going to jump in a time machine back to the late 1980s and look at one of the most famous corporate takeovers in history. It's the perfect example of what happens when the fear of the speculators goes head-to-head with the cold, hard logic of the business owner. The company we're talking about is RJR Nabisco. Now, back in 1988, this company was an absolute cash cow, mostly from its tobacco brands. But Wall Street was running scared. They were terrified of all the lawsuits coming from smokers, and that fear just hammered the stock price, driving it way, way down. The market wasn't looking at the business, it was speculating on how bad these lawsuits were going to be. And this just shows you how huge that disconnect was. Look at that first bar on the left. The market, gripped by fear, was saying the company was only worth $45 a share, but the company's own management, who actually ran the business, they knew it was worth at least $75. And then this investment firm, KKR, comes along. They do their own math, looking at it just like we looked at the pinball machine, and they came back with an offer of about $109 a share. That's that big bar on the right. We're talking about a $28 billion deal, all based on business value, not market fear. So what was KKR's secret? What did they see that nobody else on Wall Street did? Well, it wasn't a secret at all. They just ignored all the panic and the noise. They looked at RJR Nabisco the same way we looked at that pinball machine. They saw a business that was predictably churning out billions of dollars in cash year after year. And they realized, hey, we can borrow money to buy this thing and then just use the company's own profits to pay off the loan. It was the ultimate example of an investor buying a dollar for 50 cents, simply because all the speculators were too scared to even bend over and pick it up. You know, this whole situation is summed up perfectly by the guy who literally wrote the book on value investing, Benjamin Graham. He had this great line: the market undervalues a litigated claim as an asset and overvalues it as a liability. What he means is, basically, the stock market panics. It way overestimates how bad a future problem, like a lawsuit, is going to be. And that panic creates these incredible opportunities for real investors, people who can shut out the noise and just focus on what the business is actually worth. The RJR Nabisco deal was a textbook case. So this brings us right back to where we started, but now with a question that you have to ask yourself with every single investment you ever make. It doesn't matter if it's a $35 pinball machine or a $28 billion corporation, the principle is exactly the same. So ask yourself, are you buying a business, focusing on the cash it's going to generate for you for years to come? Or are you just buying a stock price, crossing your fingers and hoping it goes up? Because I guarantee you, how you answer that one question, that will determine everything.
You know, when we think about investing, our minds tend to jump to all this complicated stuff. Complex algorithms, secret formulas, maybe even some kind of insider knowledge. But what if I told you that successful investing really just boils down to two questions? I mean, just 2. And if you can get your head around them, you're most of the way there.
Okay, so the first question, this is the one that gets all the limelight, right? It's what every financial news channel is screaming about 24/7. What's the next hot stock? What's the thing I need to buy right now?
And then there's the second question, the one that honestly almost everyone forgets to ask. But this is the absolute key to unlocking real long-term value. And it's simply, at what price? Let's dive into why that's so important. So here's our game plan for this explainer. We're going to kick things off with a typical Wall Street sales pitch. Then we'll shift gears and talk about thinking like a business owner. From there, we'll look at the strategies of 2 absolute masters, Benjamin Graham, the ultimate bargain hunter, and Warren Buffett, the selective shopper. And we'll wrap it all up by figuring out how you can find your own path.
All right, let's jump into our first section, the Wall Street sales pitch. And we have to start with a fundamental truth that you need to get your head around. Why your broker's goals aren't your goals. Yep, you heard that right. The person selling you a stock often wants the exact opposite of what you want.
I mean, think about it for a second. The whole system on Wall Street is pretty much built on sales commissions. So the real incentive is to get you to pay the highest price possible. They're not in the business of finding you a bargain. They're in the business of maximizing profit for them, which means you are almost guaranteed to be paying top dollar.
And this quote just hits the nail on the head. The industry gets so fixated on the what, the exciting story, the new technology, but they completely, and I mean completely, ignore the question of price. It's kind of like falling in love with a beautiful car on the showroom floor, but never bothering to ask for the sticker price. It's a bit crazy, but that's the game.
So how do they do it? Well, they sell stocks like an art gallery sells paintings. It's all about the aesthetics, the story. And here's the wild part. A broker's enthusiasm actually goes up as the price rises. You hear that stuff all the time. Hey, it's up again today. The train's leaving the station. Better get on board. It's all about following the herd. You will almost never, ever hear someone on Wall Street say, you know what? This stock is just plain too expensive. So, how in the world do you combat that kind of thinking? Well, that brings us right to our second section, thinking like an owner. This is all about a crucial shift in your perspective. It's about stopping being a stock renter and starting to act like a business owner.
Just look at this contrast here. It's completely counterintuitive, isn't it? For the broker, when the price goes up, their enthusiasm shoots through the roof. It's a great thing. But for a true investor, someone like Warren Buffett, when the price goes up, their enthusiasm goes down. Why? Because the bargain is disappearing, the sale is ending, the deal is getting worse, not better.
And this is really the key. When you start to think like you own the place, the day-to-day zigs and zags of the stock price just become noise. The only question that really matters, the one that should keep you up at night, is this. Is the actual business I own a piece of going to make money? Once you've got an answer to that, then you can look at the price and decide if it makes any sense.
Now, this whole business-first perspective was really pioneered by the great Benjamin Graham, who you probably know as Warren Buffett's mentor. And that brings us to Section 3. We're going to meet Graham, the ultimate bargain hunter. For this guy, price was king. Graham's entire philosophy was built on this powerful concept he called the margin of safety. And it's a beautifully simple idea. First, you do your homework and figure out what a business is actually worth, its intrinsic value. Then you simply refuse to buy it unless the market is selling it for a huge discount to that value. That discount, that gap, that's your margin of safety. It's your buffer in case you messed up your math or just got unlucky.
So for Graham, the price was so important that it basically answered the what to buy question for him. He really didn't care if the company made cars or batteries or insurance policies. If the price was cheap enough, if that margin of safety was wide enough, that's what made it a good investment. In his mind, a price that's low enough can make up for just about anything, even a mediocre business.
There's this great analogy that perfectly captures his mindset. Okay, picture this. You're walking through a department store and you see a huge pile of brand new snowblowers. The original price tag is still on them, $259, but they've been marked down with a big red sticker to just $25.
Now here's the punchline. You live in Florida. You will probably never ever use a snowblower, but the price is so absurdly low, the bargain is so undeniable that you buy one anyway. That, in a nutshell, is the pure price-driven world of Benjamin Graham.
Now let's talk about his most famous student, Warren Buffett, which brings us to Section 4. Buffett took Graham's core ideas and he evolved them. He became less of a pure bargain hunter and more of a selective shopper, where the quality of the business comes first and foremost.
And this is the huge shift in thinking. Remember how for Graham, the price pretty much dictated the what? Well, Buffett's brilliant insight was to completely separate the two questions. He starts by focusing entirely on the business itself, long before he even glances at the price tag.
So Buffett's method is elegantly simple. First, he makes a shopping list. He identifies a handful of truly excellent businesses that he understands inside and out and will be perfectly happy to own forever. Then comes the hard part. He waits. He just sits there patiently, sometimes for years, until the market goes a little crazy and offers him one of those fantastic businesses at a price that actually makes sense.
Okay, so this brings us to our final section, price versus business. We've looked at three totally different approaches, haven't we? The Wall Street salesman, the bargain hunter, and the selective shopper. Let's line them up and see what that tells us about finding your own winning way.
This table really lays it all out pretty clearly. Wall Street is asking, will the price go up? They're driven by hype. Graham, the bargain hunter, is asking, is the price low enough? He's driven by the discount. But look at Buffett. He starts with a completely different question. Is this a great business? His deciding factor is quality. You see, they're not even playing the same game. Which brings us to what I think is the single most important takeaway from all this. It doesn't really matter if you lean more toward Graham or more toward Buffett. The winning strategy, for both of them, requires a disciplined separation. You must analyze the business first as a totally separate activity from looking at its stock price. Do that homework first and only then decide if the price is right. So I'll leave you with this final question. The next time you're about to put your money into something, just stop for a second and ask yourself, am I buying a stock or am I buying a business? I think you'll find your answer changes everything.
When you hear the name Warren Buffett, you probably think of a genius investor, right? A guy who can pick stocks like nobody else. But what if I told you that behind all the complicated analysis, behind every legendary deal, there's one incredibly simple, almost shockingly powerful idea? An idea that is, without a doubt, his greatest secret weapon.
That's a quote from Buffett's longtime partner, the brilliant Charlie Munger. And listen to what he's saying. He's not just talking about money here. What he's really getting at is a fundamental principle, a law of the universe that Buffett didn't just learn, he mastered. This isn't some Wall Street trick. It's a way of thinking that changes, well, pretty much everything.
So, here's what we're going to cover today. We'll start with a little story I call The Penny That Grew. Then we'll dig into the power of time itself. After that, we'll uncover Buffett's incredible tax-free engine. This is the real core of it. We'll talk about the price of entry and why it matters so much, and we'll wrap up with something called the billion-dollar car. Sound good? Let's get started.
All right, so let's jump right in with a classic thought experiment that really just illustrates this whole idea perfectly. We're not even going to talk about stocks or bonds yet. We're just talking about a single, solitary penny.
The idea is super simple. You start with 1 cent. That's it. And every single year for 27 years, its value doubles. So what do you think you'd end up with? A couple of bucks? Maybe 100? Let's actually see what happens.
So for the first few years, it's pretty underwhelming, to be honest. After year 1, you've got 2 cents. After 3 years, just 4 cents. I mean, even after 8 full years of this doubling magic, you're at $1.28. You can't even buy a coffee. And this slow, boring start is exactly where most people would lose interest. But this is also where the magic is quietly getting ready to ignite. But if you just stick with it, the growth becomes absolutely explosive. By year 27, that one little penny has transformed into over $1.3 million. Now that is the power of compounding. The growth isn't a straight line that just plods along. It's an exponential curve that feels like it does nothing for a long time, and then it just shoots for the moon.
Okay, so the penny example is really cool, but let's bring this into the real world of investing. In this world, the two magic ingredients are your annual rate of return and, maybe even more importantly, the amount of time you can just leave it alone and stay in the game.
Now take a look at this table. Let's say we're starting with $100,000. After 10 years, yeah, you can see the differences between the returns. They're noticeable. But now look at what happens after 30 years. The gap between a 5% return and a 20% return isn't 4 times bigger. It's more than 50 times bigger. Time is the ultimate amplifier. It takes small differences and turns them into gigantic ones.
And this visual just drives the point home, doesn't it? That bar on the left, that's your result from a 5% return over 30 years. It's respectable, sure. But then you look at the right,
That's the 20% return. It's not just a bigger bar, it's a skyscraper. And that enormous difference, that huge chasm of wealth, was created by just a few percentage points working their magic relentlessly, year after year after year. But there's a big catch in all of these perfect little examples. We're kind of assuming all this growth is happening in a tax-free paradise. And in the real world, you know who always wants their cut? The tax man. And taxes create friction. They slow the whole process down. So the question is, how did Buffett build a compounding machine that manages to keep the tax man away for decades at a time? This, right here, is the real secret weapon.
You see, Buffett's true genius wasn't just finding companies that could grow. Lots of people can do that. It was in finding a structure that allowed that growth to happen completely uninterrupted. He figured out how to create his own tax-deferred engine right inside the public stock market.
Now, to really get Buffett's solution, we first have to understand the problem. So think about a regular standard bond. It pays you interest, right? Which sounds great. But every single year, the IRS shows up and takes a slice of those earnings as income tax. This creates something called tax track. It's like, imagine you're trying to build a snowball by rolling it downhill, but every 10 feet, someone comes along and shaves off a layer. Your snowball just can't grow as fast. And this slide just lays it out perfectly. On the left, with the bond, taxes eat into your earnings every single year, leaving you with less money to reinvest. Your snowball is constantly being shaved down. But on the right, that's the Buffett approach. He looks for companies that retain their earnings to grow the business, instead of paying them out as dividends. This keeps the full $80 inside the company working for you and compounding without that annual tax interruption.
The process is it's so simple and so profound. A good company earns money. Then, instead of sending you a dividend check, it retains that money to reinvest and grow. This makes the value of your stock go up and your personal wealth compounds year after year, completely sheltered from annual income tax. The only time you face taxes is when you finally sell, and that's a capital gains tax. For Buffett, when I sell might be, well, never. He effectively turns a regular public stock into his own private tax-deferred compounding machine.
Okay, so you've found a fantastic company. It retains its earnings. You've basically got your compounding machine all ready to go. But there's one more critical piece to this puzzle, a lever that you control that can dramatically change your results. And that's the price you pay to get in the door.
Let's use a real-world case study here. Picture it. The year is 1987. You're looking at buying stock in Philip Morris, which was a phenomenal business at the time. And you've got $100,000 ready to invest for the next 10 years.
Now, over the course of that year, the stock price had its ups and downs. If you were disciplined, if you were patient, and you bought near the low at $6.07 a share, your investment would go on to compound at a stunning 21.9% per year for a decade. But if you got impatient, maybe a little greedy, and you bought near the high at $10.36, your rate of return for the exact same company plummets to 15.56%. That is a huge, huge difference.
And what does that actually mean in terms of dollars in your pocket? Well, after those 10 years, the patient investor who bought low turned their $100,000 into more than $724,000. The investor who paid the higher price, they ended up with about $424,000. We're talking about a massive gap in wealth, created only by the initial price that was paid.
So the crucial point is this. That number right there, almost $300,000, that's the penalty for overpaying. The whole idea that you can pay any price for a wonderful business is just flat out wrong. Your purchase price is the anchor. It sets the entire compounding rate for your future.
Now here's the thing. Once you truly, deeply internalize these lessons, it stops being just an investment strategy. It becomes a whole new mindset. It's a lens that changes how you view every single financial decision you make, just like it did for Buffett.
So let me ask you a question. We all know Buffett is famous for being frugal, right? Driving older cars, living in the same house. Is it just because he doesn't like nice things? No. It's because he asks this question. What is the true cost of, say, a $20,000 car?
To you and me, the car costs $20,000. That's the price tag. But to Warren Buffett, that 20 grand isn't just 20 grand. It's what it could become. It's the almost $1.3 million it could be in 20 years, or the nearly $10 million it could be worth in 30 years, all compounding away inside his financial engine. So all of a sudden, it's not a $20,000 car, it's a $10 million car. And for him, no car is worth that much. That is seeing the world through the powerful lens of opportunity cost.
So let's just recap the big takeaways here. Compounding is the engine of wealth. Small differences in your rate of return create massive differences down the line. Tax deferral is the secret fuel that makes that engine run hotter and faster. The price you pay when you buy, that sets your potential top speed. And finally, every spending decision you make has a huge, often invisible opportunity cost attached to it.
You know, Buffett famously said that life is like a snowball. The important thing is finding wet snow and a really long hill. Well, after today, you understand the physics of that snowball. You understand the power of compounding, the importance of that long hill, and the secret fuel of tax deferral. So the only question that's really left is, how will you choose to build yours?
All right, let's get right into it. Today, we're taking a deep dive into the mind of an absolute legend, Warren Buffett. But we're not just going to talk about his success. We're going to pinpoint the single most important shift in his entire career. That moment he went from being a guy who just hunted for bargains to someone who thought like a true business owner. And let me tell you, that one pivot changed everything. But before we trace his journey, it all starts with this one question. This is the question Buffett learned he had to answer first, way before he even thought about the price tag. Just ask yourself, what kind of business do you really want to own? Keep that question in your head, because it is the key to this whole thing. So here's our game plan for today. We'll start with that ultimate question. Then we'll look at the philosophy he learned from his first mentor, find the huge crack in that system, meet the two guys who completely changed his mind, and finally, we'll see the Buffett pivot in action. Okay, let's kick things off. For the Warren Buffett that we all know today, the quality of the business, the what, is everything. The price? Well, that's a secondary concern. But you know, it took him a long time to get to that simple but incredibly powerful idea. Buffett has actually said that figuring out the right kind of business to own is a mind-challenging event. It's not simple math, it's a real intellectual workout. And it was this exact challenge that actually caused him to kind of rebel against his first mentor, a man who taught him a system that was all about the numbers and almost nothing about the business itself. So who was this mentor? Well, it was the father of value investing himself, Benjamin Graham. Now, Graham gave Buffett this incredibly powerful, numbers-driven way to look at the stock market. His world was all about finding a bargain, no matter what the company actually made or sold. And the cornerstone of Graham's entire system was this concept of intrinsic value. He didn't think a company was worth, exactly $52.37. No, he saw it as a range of value. Your only job as an investor was to buy that stock for a price way below that range. And I love the analogy Graham used for this. He'd say, if a man is fat, you don't need to know his exact weight in pounds to know that he's fat. It makes total sense, right? But here's the problem. Fat, just like value, can be totally subjective. I mean, what one person sees as a great, chunky, valuable company, another person might see as bloated and risky. Graham's system really didn't have a good way to deal with that. So, to get around that problem, Graham created these incredibly strict, almost robotic rules. You see them here. Buy stocks for less than what's left over if they sold all their current assets and paid off all their debts. Pay less than 7 times what they earned last year, and this is the big one, buy a ton of them, like 100 or more. The quality of any single business didn't matter, because he figured as a group they'd get the job done. But this otherwise brilliant system had this one nagging central flaw. It created this huge dilemma that Buffett really wrestled with for years. What on earth do you do when you buy a cheap company and it just stays cheap? Let's use a real example to make this super clear. Let's say Graham runs his numbers and figures a company's true value is somewhere around $62.50 a share. But hey, look at that. It's trading for only $50. That seems like a no-brainer, right? A clean 25% profit just waiting for you. So you buy it, and then you wait. And this chart just shows the problem so perfectly. Look, if that stock pops up to its target price in the first year, great, fantastic. You just made a 25% return. But watch what happens. If it takes 2 years to get there, your yearly return gets cut in half to less than 12%. And if it takes 5 years, well, now you're making just 4.5% a year. You probably could have done better in a boring old savings account. This actually has a name. It's called the realization of value problem. The whole strategy depends on one thing. The market has to eventually agree with you and push that price up. If the market just shrugs its shoulders and ignores your bargain forever, all that smart analysis you did gets you a big fat zero. Now, Graham was a genius. He knew about this problem. His solutions were, first, to demand a huge potential return up front. That's his famous margin of safety. Second, to diversify like crazy so the duds wouldn't sink the whole portfolio.
But look at that third point. He had a rule to just sell the stock if it didn't work out in 2 or 3 years. This literally forced him to be a short-term investor. So for a young Warren Buffett trying to make his mark, this created 2 giant headaches. First, he was constantly buying these junky, mediocre businesses just because the numbers looked cheap. And second, and this is a huge deal, every single time the strategy worked and he sold a stock for a profit, he had to immediately turn around and write a big check to the government for taxes. That constant churn was just killing his ability to compound his wealth. And that frustration is what pushed Buffett to find a better way. And he found his answer in the ideas of 2 other incredible investors, his soon-to-be partner, Charlie Munger, and an investor out on the West Coast named Philip Fisher. And they gave him a totally new way of looking at the world. And their entire philosophy really can be boiled down to this one beautiful, game-changing idea. They said forget about looking for so-so businesses at a bargain price. Instead, you should invest only in excellent businesses, the kind of businesses whose actual value is growing and expanding over time. And this is it. This is the moments we've been building up to, the Buffett pivot. It's where he brilliantly stitched together the best of Graham's numbers-based discipline with the profound business wisdom of Munger and Fisher. He went from buying good bargains to owning great businesses. I mean, this table just lays it all out perfectly. Graham, he was focused on price. Munger and Fisher, business quality. Graham bought mediocre companies cheap. They bought excellent companies at a fair price. Graham had to be a short-term player. They could hold on forever. Graham's goal was to make money when the market price finally caught up to a fixed value. Their goal was totally different, to make money as the business itself just got more and more valuable, year after year. So you see, this new way of thinking just completely solved that old realization of value problem. If you own a company whose intrinsic value is always growing, who cares if the market gets it right this year or next year? Suddenly, time is your best friend, not your enemy. The longer you wait, the richer you get. And that leads to the masterstroke, the real secret sauce. If the business just keeps getting more valuable, you never have a reason to sell it. And if you don't sell, you don't pay capital gains taxes. You get to let your money compound, year after year, decade after decade, without the taxman taking his cut along the way. That, right there, was the key that unlocked those mind-boggling long-term returns for Buffett.
Which brings us right back to where we started, but now hopefully it all makes a lot more sense. When you look at an investment, are you thinking like the old Buffett, just digging around for a statistical bargain? Or are you thinking like the Buffett we know today, asking yourself that deeper, more important question, am I hunting for true, durable, long-term greatness?
All right, let's dive into a story that literally changed the face of modern investing. We're going to unpack how a young Warren Buffett went from being a by-the-book bargain hunter to the legend we know today. And it all came down to a single, powerful shift in thinking, the theory of an expanding intrinsic value. This is how he did it. You see, this quote from Buffett's own mentor, the great Benjamin Graham, this is the key that unlocks the whole thing. The idea is simple but profound. In the short run, stocks go up and down based on popularity. It's a voting machine. But if you stick around long enough, the market becomes a weighing machine. What really matters in the end is the true fundamental worth, the weight of the business. Buffett's entire career has been a masterclass in learning how to use that weighing machine.
So where did Buffett start his journey? Well, he started with the rules he was taught, with the classic Benjamin Graham playbook. And the goal was really straightforward. Find a bargain. Find some company that's been beaten up, that nobody loves, and that's trading for way, way less than it's actually worth. This whole strategy had a very memorable name.
And Graham had this incredible, kind of gross, but perfect analogy for it. He said it was like walking down the street and finding a soggy, discarded cigar butt on the ground. You know, one that has just one good puff left in it. You pick it up, you take that final puff for free, and then you toss it away. In investing, that meant buying a really troubled company for a steal, waiting for the price to pop just a little bit, and then selling for a quick, tidy, but small profit. It's a clever way to get something for almost nothing, but as Warren was about to find out, almost nothing was too often exactly what he got.
See, after doing this for years, Buffett started to see a huge, fundamental flaw in this approach. He was buying cheap companies, sure, but they were almost always mediocre businesses. And he realized that a bargain price can't fix a broken business. He kept falling into the same trap over and over again.
And you can imagine his frustration.
The earnings from these companies, totally unpredictable, and they almost never grew, which meant the stock price just went nowhere. It just treaded water. And let's say he did get lucky and the price went up to what he thought it was worth. The profit was still tiny. And to even get that tiny profit, he had to sell the stock, which immediately triggered capital gains taxes, eating into his already small win. But the worst part? The worst part was that the big event, the big turnaround he was betting on, it usually never even happened.
This metaphor just nails the feeling, doesn't it? Buffett realized that owning these mediocre businesses was like being stuck on a boat with no engine and no sails. Yeah, you're floating, but you're not actually going anywhere, you're just adrift. He knew he needed a totally new kind of vehicle, one that had its own engine.
Okay, so this is it. This is the moment everything changes. The big aha moment. It came from the influence of other brilliant minds, like Philip Fisher, who was all about buying fantastic, innovative companies. And of course, his longtime partner Charlie Munger, who hammered home the importance of a great business with a durable competitive advantage. And the revelation was this. What if, instead of buying a terrible business at a wonderful price, he could buy a wonderful business at a fair price? A business whose own value was the engine.
And his investment in General Foods is the perfect example. Now, I know what you're thinking. This table looks like a lot of numbers. You got earnings, selling price, government yields, and that IV column, which is just short for intrinsic value, an estimate of what the business is really worth. But stick with me, because the secret to Buffett's entire breakthrough is hiding right in these numbers. It has nothing to do with the daily stock price. It's all about the engine inside the business.
So let's just cut through the noise and look at the one thing that truly mattered. The company's earnings per share. Look at that. It went from $5.12 in '79 all the way up to almost $7 just 5 years later. This was the engine. The business itself was just getting more profitable, more valuable, year after year, no matter what the crazy stock market was doing that day.
And here's where the light bulb really goes off. You got to see this. When Buffett bought the stock for $28, the business was actually earning $5.12 per share for him. You do the simple math on that, that's a real underlying business return of 18% on his money. He didn't have to care if the market recognized that tomorrow, next week, or next year. He knew, fundamentally, that he owned a piece of a business that was churning out an incredible return for him.
And suddenly, you had this huge split in thinking. It was like two totally different religions of investing. The old way, the Graham way, was to sell the second the stock hit your price target. Take the small win, get out, and find the next cigar butt. But the new way, the Fisher and Munger way, it was revolutionary. It said, why on earth would you sell a business that is becoming more valuable every single year? If the intrinsic value is growing, the stock price will eventually have to catch up. And here's the real kicker. By not selling, you don't pay capital gains taxes. You let the whole thing grow and compound, year after year. The goal wasn't to sell. The goal was to hold on for dear life.
Look, a theory is one thing, but does it actually work in the real world? Well, the proof of this whole expanding value idea is what turned it from a smart concept into an absolute legend. The results are, well, they're just astonishing.
Let's start with maybe his most famous investment, the Washington Post. This was back in 1973. The market was in a total panic. Everyone was selling. And Buffett saw this incredible business being sold at a perfectly fair price. So he bought a massive chunk of it.
He put in just under $10 million. And yeah, that's a lot of money, for sure, but it's not the starting number that's the amazing part of this story. It's what that number became. By just holding on, by letting that excellent business do its thing for 24 years, his initial stake grew to be worth around $600 million. No, that is not a typo. $600 million. He didn't trade it, he didn't time the market, he just let the expanding value of the business do all the heavy lifting for him.
And this chart shows you the engine behind that insane growth. The Washington Post investment compounded at nearly 19% a year. Can you imagine a savings account that paid you 19% every single year for over 2 decades? It's just incredible. And as you can see here, this wasn't some one-time lucky shot.
Let's look at another one, just to really hammer the point home. This time, it's the insurance giant Geico, a business Buffett knew better than anyone.
Now, the stakes were even higher here. He invested a much bigger amount, about $45.7 million, again during those brutal market years in the early 70s when most people were running for the hills.
By 1995, that investment had exploded to more than $1.7 billion. Billion with a B. The principal was exactly the same, just scaled up.
Find a truly fantastic business, buy it when the price is fair, and then let the magic of compounding work for decades.
So after all this, what's the one huge lesson we can take away from his entire journey? It all comes down to how you think about a single crucial factor: time. The question completely changes from, is this stock cheap, to something much, much deeper.
And this quote, this just says it all. For a great business, time is your best friend. It allows that value to grow, to compound, to build on itself. But for a mediocre business, one of those old cigar butts, time is a curse. It just slowly exposes the flaws and erodes whatever little value was there to begin with. Time is either your greatest ally or your worst enemy. It all depends on the quality of the company you own.
And that really brings us to the present day. And it leaves us with one final big question. I want you to think about this. As you look around at the companies that are shaping our world right now, try to use this same lens. Forget the daily chatter from the market's voting machine, and instead, ask yourself, which of these businesses are the truly great ones? Which of them are the true friends of time?
You know, when you think about Warren Buffett, you probably think he's the greatest investor of all time, and you'd probably be right. But here's the thing. While everyone's busy studying the stocks he buys, his real genius might just be in the ones he avoids. See, he has this incredibly simple, yet just powerful way of looking at businesses. It's a mental model that cuts right through all the noise, and I'm telling you, once you see it, you're going to start seeing it everywhere. So let's break it down.
So here's how Buffett sees the world. For him, the entire business landscape, every company out there, fits into just two buckets. That's it, just two. In one bucket, you've got the treasure chest, what he calls an excellent business, but in the other, you've got this leaky bucket, the mediocre or commodity-type business. And Buffett figured out that the absolute most important thing you can do as an investor is learn how to spot that leaky bucket from a mile away. It really is the foundation of everything.
All right, so here's our game plan. We're going to start by defining what this commodity trap actually is. Then we'll dive right into the vicious economic cycle that keeps these companies stuck. After that, we're going to look at a pretty brutal 21-year case study that shows the real-world damage this can do. And finally, we'll wrap it all up with a practical checklist that you can use to spot these traps for yourself. Okay, let's get into it. The commodity business trap. What on earth does that actually mean? Well, at its core, it's about spotting a business that's just fundamentally designed for mediocrity. A business where it doesn't matter how smart the managers are or how hard everyone works, it just can't seem to get ahead in the long run.
So what is the one single feature of a commodity business? It's actually shockingly simple. It's any company where customers make their buying decision based on one thing and one thing only: price. That's it. It's not about the cool brand, it's not the special features, it's not the great customer service. It all just comes down to who's the cheapest. And if that's the game a company is forced to play, it's already caught in the trap. And you really don't have to look very far to find these businesses. They are literally everywhere. I mean, think about it. When was the last time you bought lumber for a project or filled up your car with gas? Did you go out of your way to find a special brand of 2x4? Or did you just pull into the gas station that had the lowest price on the sign? For almost all of us, in those situations, price is the only thing that matters. And that, right there, is the essence of a commodity. And this leads us to the one brutal, unbreakable rule of these industries. When the product itself is basically identical, one company's steel is the same as the next company's steel, the only way you can possibly compete is on cost. The company that can make its stuff and sell it for the absolute lowest price is the only one that has any power at all. Everybody else is just stuck following them down in this relentless race to the bottom.
So why is this race to the bottom so bad, so destructive? Well, it's because it traps these companies in a truly vicious economic cycle. It's this self-defeating loop, and it's the reason they can never really seem to build any lasting momentum. Let's take a look at how it works.
This diagram just lays out the trap perfectly. Let's walk through it. So it starts with a smart move, right? Company A gets clever and figures out a way to lower its production costs. So what do? They lower their price to try and grab some market share. And for a minute, it works. Their rivals, companies B, C, and D, start losing customers. But here's the problem. In a commodity industry, there are no secrets. The rivals just copy the innovation, they match the lower price, and just like that, poof, the advantage is gone. Everybody is right back where they started, only now the entire industry is making less money. Now, I know what you're probably thinking, but wait, surely these industries have good years, right? And yeah, they do.
They have boom times. You take something like a major hurricane, for example. The price of plywood can go through the roof, and the producers make a fortune. But that very success, those big profits, that's what gets them into trouble. It attracts new competition, and it encourages everyone already in the business to make more. And before you know it, you've got a glut, way too much supply, which leads to overcapacity, and prices come crashing right back down. The boom itself plants the seeds of the next bust. It's inevitable. To really see just how devastating this cycle can be over the long haul, we have to look at a real-world example. This is one of Warren Buffett's all-time favorite cautionary tales, and it's a really powerful lesson in how good money can be thrown after bad. So, the company we're talking about is Burlington Industries. They were a huge player in the textile business, and textiles, they're a classic commodity. One bolt of fabric is pretty much the same as the next, and the competition is just absolutely fierce. So they were constantly fighting that battle to be the low-cost producer. And believe me, they fought that battle with everything they had. Between 1964 and 1985, this company reinvested, get this, $3 billion. That's billion with a B. All of that money, shareholder money, was poured right back into new factories, new machines, all of it in a desperate attempt to get some kind of edge on efficiency and cost. And this wasn't just a short-term project. They kept this up for 21 years. Just think about that for a second. More than 2 decades of constantly reinvesting, constantly fighting, constantly pouring every single spare dollar back into the business just to try and stay ahead of the competition. So, after all of that, after 21 years of hard work and $3 billion of capital, what was the grand result for the people who owned the stock? The share price went up by a mere $4. $4. All that time, all that money, all that effort was almost completely vaporized. And it wasn't because of bad management, it was because of the terrible economics of the business itself. And this whole story just perfectly illustrates one of Buffett's most famous and wisest quotes. It wasn't that the managers at Burlington were bad at their jobs. In fact, they were some of the best in the entire industry. The problem was the business. Like Buffett says, when management with an excellent reputation meets a business with a poor reputation, it is usually the business's reputation that remains intact. In the end, the bad business almost always wins. Okay, so this is the crucial part, right? How can we, as investors, spot these traps before we fall into them? Well, luckily, there's a checklist of telltale signs to look for. Think of this as your field guide for identifying these mediocre businesses out in the wild. So here are the red flags you need to watch out for. First, you're gonna see consistently low profit margins. And that makes sense, right? It's a direct result of those constant price wars. Next, look at the return on equity. That's basically how much profit the company makes for every dollar shareholders have invested. In these businesses, it's often stuck below the corporate average of about 12%. And of course, you'll see pretty much zero brand loyalty, and the industry will be just packed with tons of competitors, all with way too much capacity to make the product. You put it all together, and it is a recipe for long-term pain. But out of all of these signs, one of the easiest ones to spot is the pattern of their earnings over time. You see, a really great business tends to have pretty smooth, predictable profit growth. A commodity business, on the other hand, well, it's a total roller coaster. And this is exactly what that roller coaster looks like on paper. You get a great year, a boom year, followed by a total bust where they might even lose money. The earnings are just all over the map. This wild, unpredictable boom and bust pattern, that is the absolute fingerprint of a commodity business. It's the sign of a company that is completely at the mercy of outside forces, with no real control over its own destiny. All right, we've gone through the theory, we've looked at the cycle, we've gone through the checklist, but this all really boils down to one simple golden rule. If you don't remember anything else from this, remember this one thing. It really all just comes down to this one powerful question. When a customer is buying the product, is price the number one reason they're buying it? If the answer to that question is yes, then you are almost certainly looking at a commodity-type business. And it will most likely deliver, at best, mediocre results over the long term. So I want to leave you with a final thought here. This framework, it's not just for picking stocks. It's really a new lens for seeing the economic world around you more clearly. Now that you know what you're looking for, how many of these commodity traps do you see in your daily life? I think the answer might just surprise you. You know, when you think about Warren Buffett's incredible success, you might imagine some complex hidden formula.
But the truth is, it's not about that at all. It's about a way of looking at businesses that honestly anyone can learn. He's looking for one specific, incredibly powerful quality. And that's what we're going to dig into today, what that quality is and how you can start seeing it everywhere.
So, what is it? What's the one thing that separates a business that's here today, gone tomorrow, from a company that can just churn out cash for decades and decades? I mean, if you can answer this one question, you've basically cracked the code to his entire investment philosophy. All right, so here's our game plan. First up, we're going to uncover Warren's secret investment key. Then, we'll get into exactly what this thing called a consumer monopoly is. After that, we'll walk through Buffett's simple billion-dollar test to spot one. We'll look at some real-world, bomb-proof examples, see why they are so darn profitable, and then, finally, we'll talk about how you can find these disguised monopolies out in the wild. For Buffett, the whole game is about one word: predictability. He's not chasing the latest hot trend or making these wild, risky bets. No, he is on the hunt for businesses that have what he calls, great economics. And he figured out that the truly great ones, the best of the best, all share this one single powerful characteristic. And that characteristic, that's the big one, is what he calls a consumer monopoly. Now hold on, this isn't what you might think. We're not talking about a monopoly in the legal sense, like your local power company. This is something much more subtle, and, from an investor's point of view, a whole lot more powerful. This right here is the core idea. Okay, so what is a consumer monopoly really? The best way to get your head around it isn't some boring, dry definition. It's actually a pretty simple analogy that just makes the whole concept click into place. At its core, a consumer monopoly exists right up here, in the mind of the customer. It's when a brand becomes so ingrained, so trusted, or just so desirable that the company has this incredible freedom. It means they can raise prices without sending customers running for the hills, because for those people, there really is no substitute. Think about it like this. It's a great mental picture. Imagine you own the only toll bridge across a major river. You've got a monopoly, right? Drivers have to pay your price if they want to get across. Now, imagine you sell something generic, like wheat. If you raise your price by just a penny, your customers will just go down the road to the next farm. One has all the power, the other is completely at the mercy of the market. And, this isn't some new idea that Buffett just cooked up. This goes way back. I mean, all the way back in 1938, there was this paper talking about the investment value of goodwill, which is really just a fancy way of saying the value of a customer's emotional attachment to a brand. It recognized that this connection was a real, tangible economic asset. So, okay, we know what they are, but how do you actually find one of these companies in the real world? Well, Buffett came up with this simple, just brilliant thought experiment. And it has nothing to do with spreadsheets or financial models. It's a pure test of a company's real, underlying power. Here's how the test goes. Imagine I just handed you a blank check, billions and billions of dollars. And you can hire anyone you want, the smartest, most brilliant minds in business. Now ask yourself this simple question. With all those resources, all that money and talent, could you launch a competitor and seriously hurt this company's business? If your gut answer is a hard no way, boom, you've just found a consumer monopoly. And just think about how deep that goes. It's not just about whether you could compete and turn a profit. The real test is whether a competitor with unlimited cash, someone who is willing to lose money hand over fist, could they even make a dent? For the strongest monopolies, the answer is still a resounding no. Let's put this test into action right now. You've got your billions. Do you think you could start a new chewing gum company and actually take down Wrigley? People have tried and they have failed spectacularly. Or what about launching a new chocolate bar to be Hershey's? Good luck with that. The moats around these businesses are just too wide to cross. So let's get even more specific. Let's look at a few of these, what Buffett would call bomb-proof businesses. Companies whose brands are so dominant, they seem pretty much indestructible.
This story just says it all. Picture this. A traveler is way up in the high mountains of Indonesia, like as remote as you can possibly get. And at this tiny little roadside stand, what's the one and only soda they have for sale? You guessed it, Coca-Cola. That, my friends, is the definition of a global consumer monopoly. I mean, its dominance is it's absolute. It's everywhere. But here's the real kicker, the source of its power.
It's not just that stores want to stock it. They have to stock it. Let me say that again. They have to carry it. Because if they don't, customers will literally go somewhere else to buy it. Now that is true power over your distribution chain. Or take this example. The power here isn't built on distribution. It's built on deep-seated habit and personal identity. The brand loyalty is so unbelievably intense that it creates this nearly unbreakable monopoly, not because of superior taste or anything like that, but purely because of consumer psychology. So, okay, we figured out what these companies are, we know how to spot them, but so what? Why does this all matter so much? Well, let's look at the numbers. Let's see what this incredible market power actually translates to on the balance sheet. This is where it gets really interesting. Just check out the kind of business model this creates. It's beautiful. The company's real value, its wealth, isn't tied up in giant, expensive factories that need constant, costly upgrades. Nope. It's in the brand name, the secret formula, the customer's habit. This creates an absolute gusher of predictable cash flow, and it does it without needing massive debt or tons of expensive R&D. It's a perfect recipe for profit. And this comparison just makes it crystal clear, right? On one hand, you've got a company like Wrigley. They can use the same machines for decades to crank out gum. The product barely changes. But then you look at a car company like General Motors. It's a totally different world. That's a brutal, capital-intensive commodity business. They have to spend billions, with a B, every few years just to retool their plants and stay competitive. One model gushes cash, the other just eats it. Okay, so we've defined the concept, we've seen the powerful examples, we understand the incredible financial advantages, so the big question now is, how can you take this mental model and start using it to analyze the businesses you see around you every single day? And this brings us to one last really powerful way to think about all of this. See, your local water company is an obvious monopoly, right? Everybody knows it. That's why the government regulates its prices. The real investing genius, the trick, is to find a disguised water company, a business that has that same kind of monopoly power, but because it's based on a brand or habit, it just flies under the radar. The goal is to find one before everyone else catches on. And that brings us right to the end and to a final thought for you to chew on. Now that you have this new lens, this new way of looking at the world, start paying attention. Think about the products you buy without even thinking, the services you use automatically. Which ones pass Buffett's billion-dollar test? What disguised monopoly is hiding in plain sight, right there in your daily routine? The answer might just surprise you.
Welcome to The Explainer. Today, we are going on a quest. A hunt, really. We're stalking a very specific kind of creature, the truly excellent business. Our guide for this whole adventure is the philosophy of Warren Buffett. And our map? Well, it's a set of 9 incredibly powerful questions. These are the questions designed to help us tell the difference between a truly spectacular, lifelong business partner and just a fleeting, short-term fling. And this quote, man, it really frames everything we're about to talk about. The whole point is, we're not here to speed date stocks, chasing a quick buck. We're looking for a partner, a business we can really commit to for the long, long haul. Because when you think that way, when you adopt that mindset, you get incredibly selective. You make absolutely sure the one you choose is worth keeping for life. Okay, so here's our game plan. First, we're going to get our heads in the right space, the right mindset. Then we'll start the hunt by learning how to spot something called a consumer monopoly. After that, it's time for a full financial health check, and then we're going to look at what really drives growth. We'll wrap it all up with 2 final tests and a checklist you can take with you.
All right, let's get into it. And we're starting with the most foundational idea of all. Before we even look at a single number, we have to completely reframe how we think about this whole game. This is all about making a huge shift in perspective, from just playing the market to actually owning a piece of a living, breathing business.
And this right here, this is the whole shebang. When you buy a stock, you're not just buying a little ticker symbol that wiggles up and down on a screen. You are taking your hard-earned capital and becoming a part owner of an actual company. That mindset changes everything. It forces you to ask the same serious, tough questions you'd ask if you were buying the entire company outright. It's a real commitment.
So now that we're thinking like owners, not speculators, let's get to our very first question. This is where the real detective work begins. We are officially on the hunt for a company's single most important feature, its unique and, hopefully, very durable advantage in the marketplace. So what does that mean, a consumer monopoly? Well, think of it like this. Does the company own a kind of financial toll bridge?
Is it selling something that people feel they absolutely need or at least really, really want and that competitors find it almost impossible to copy or replace? This, my friends, is the bedrock of a truly excellent business.
And you know what? These things are hiding in plain sight. You see them every single day if you just know how to look. Just walk into any store and ask yourself, what products would the manager be absolutely insane not to stock on the shelves? The brand name is so powerful, so burned into our brains that having it there is totally non-negotiable. That is the mark of a consumer monopoly.
But, and this is a huge but, let's not get ahead of ourselves. This is a critical warning. Finding a company with a great product, with that monopoly power, that's just step one. It's the ticket that gets you into the dance. It is absolutely no guarantee of success. A brilliant competitive advantage can be completely squandered by bad management, which is why our investigation has to go much, much deeper. All right, so we think we've spotted one. We've got a potential monopoly in our sights. Fantastic. Now it's time to pop the hood and really check the engine. We need to run a serious financial health check, and we're going to do that with our next 3 questions to see if the business itself is as strong as its brand.
You see, what we're not looking for is a company whose profits look like a seismograph during an earthquake, just all over the place. That's a huge red flag for instability. What we want to see is a consistent, predictable, steady climb in its per-share earnings year after year after year. It shows us that management is doing its job, turning that monopoly power into real, growing value for the owners.
And this chart, wow, it just lays it out so clearly, doesn't it? Look at Company I. That's what we want. It's that beautiful, steady staircase of growth we're looking for, climbing from about $1 up to over $2.60. Then you look at Company 2, and it's a complete roller coaster. I mean, it's all over the place, and it even ends in a loss. You have no idea where that business is headed. The choice here is a no-brainer. An excellent business looks like Company I. All right, next up on our health check, debt. A truly excellent business, one with a powerful consumer monopoly, it should be a cash printing machine. It ought to be spinning off so much cash that it has very little, if any, need for long-term debt. Piles of debt can be a real sign of weakness, or that the company is out there buying other businesses that just aren't as good as its main one. Okay, this next one might sound a little technical, but stick with me, because it is absolutely one of the most powerful questions you can ask. Return on equity, or ROE. Shareholders' equity is just a fancy term for the company's net worth. It's what would be left for the owners if you sold everything and paid off all the debts. So ROE tells us how much profit the managers are generating for every single dollar of the owner's own capital. It's a direct report card on how well they're using your money to make more money.
And this bar chart just drives the point home. It's incredible. You can see the average U.S. corporation is kind of chugging along, earning about 12% on its equity. That's fine. That's our baseline. But now, look at the kind of businesses we're actually hunting for. Coca-Cola is cranking out 33%. Philip Morris, over 30%. They're not just a little bit better, they are playing in a completely different league. These are the wealth creation superstars.
Okay, let's take a breath. So far, we've found a company with a killer monopoly, rock-solid earnings, almost no debt, and an incredible return on equity. It's making a ton of money. But here, this is where the story gets really interesting, because what the business does with that money is the true engine of creating extraordinary long-term wealth.
So this is kind of a 2-for-1 question, and it gets right to the core of what makes a business truly great. First, does the company actually get to keep its profits, or does it have to pay them all out just to keep shareholders happy? And second, for the money it does keep, how much of it has to be spent just to keep the lights on? On replacing old factories and outdated equipment. A great business keeps most of its cash and spends very little of it just on maintenance.
And this tale of 2 companies here is the perfect example. On the one hand, you've got a capital-hungry business. It's like a machine that has to constantly eat money just to keep running and stay competitive. It can only grow by taking in new money from the outside. But on the other side, you've got the cash cow. It builds its operations once, and then it just sits there and gushes cash, which it can then use to buy more cash-gushing assets. One consumes capital, the other produces it.
And if you need a horror story to really hammer this point home, my gosh, look at what happened with General Motors during this decade. The numbers are just devastating. Over 10 years, they earned about $18 a share, but they spent, get this, over $102 a share on capital improvements. They even took on $33 billion in new debt to pay for it all. And the result? After a full decade of all that spending and all that work, the stock price went absolutely nowhere. It was a massive machine for destroying capital, and it created zero value for its owners.
And that brings us to what might be, well, what I think is the most important question of the whole bunch. The company is keeping its cash, and it doesn't need to spend it all on maintenance. So what does it do with that big pile of money? Can the people in charge, can management, take those profits and intelligently reinvest them back into the business to earn that same high rate of return we saw earlier? This is the secret sauce to compounding wealth.
And this is where the real magic happens. The power of compounding. It's mind-blowing when you see the numbers like this. Let's say you invest $10,000 a year for 20 years. If you just stick it in a drawer, you've got 200 grand. Okay. Put it in a 5% savings account, it's better. You've got about 350,000. But if you give it to a great company that can reinvest it at 23%, you end up with over $3.3 million. It's unbelievable. That is what separates a good business from a life-changing investment.
All right, we're on the home stretch now. We've found this incredible cash-generating machine run by smart people who know how to reinvest it. Now we just have two final checks. Think of them as the final litmus tests to make sure what we've found is the real deal, a business that can truly last.
So here they are, our last two hurdles. Number 1, inflation. Can the company just raise its prices to keep up with rising costs without anyone blinking an eye or customers running for the exits? That is a true test of its monopoly power. And finally, number 9. As the company gets richer and richer on paper, as it retains all these earnings and builds its real economic value, does the stock market actually notice? Over the long term, will the stock price go up to reflect that value? For the truly excellent businesses, the answer is a big, resounding yes. Whew, we have covered a ton of ground here, walking through this whole framework for finding a truly excellent business. It's been quite a journey. So let's boil it all down now into one simple, practical checklist that you can actually take with you and use. And there you have it, your 9-point inspection. Seriously, print this thing out, stick it on your wall. Before you even think about buying into a company, run it through these 9 questions. It forces you to stop speculating, to stop listening to the hype, and to start focusing on what really truly matters, the underlying quality and economics of the business itself.
And in the end, it all comes down to this one last question, the one you have to ask yourself. Are you just playing chips at the market's casino, hoping for a lucky spin, getting caught up in all the short-term fear and greed? Or are you looking for a true partner, an extraordinary business you can commit to for a lifetime? This whole framework, it's your map to finding that partner. So, which game are you really playing?
All right, let's dive into a question that I think is on the mind of anyone interested in business or investing. I mean, you look out there and there are thousands, literally thousands of companies. How in the world do you start to sift through all that noise to find the truly great ones? It feels impossible sometimes. But what if there was a mental model, a kind of map that could point you right to them? See, this is the real challenge, right? We're not looking for some flash in the pan, some company that's hot for a year and then gone. No, we're hunting for businesses with what you'd call a durable competitive advantage, a kind of economic moat that all but guarantees their success for a long, long time. And the secret really is learning to spot a very particular kind of business. And here it is. We're going to call it the conceptual toll bridge. I absolutely love this analogy. Just picture it. There's a huge river that everyone needs to cross, and you own the only bridge. Well, you're in a fantastic spot, right? You get to charge a small toll to every single person who passes. In the business world, it's the same idea. It's a company that has such a unique, protected position that other businesses have to pay them to get where they're going. Now, these toll bridges, they don't all look alike. In fact, they really come in 3 main flavors, so let's break them down, one by one. Okay, so our first type of toll bridge is probably the one that's easiest to get your head around. It's all about products. But listen, not just any products. We are talking about specific brand name products that get used up fast, and this is the key, that store owners feel like they have absolutely no choice but to keep on their shelves. So what's so fascinating here is the power dynamic that gets created. You know, a typical grocery store, they've got hundreds of suppliers begging to get on their shelves. The store holds all the power. But what happens when customers start demanding a specific product by name and only one company makes it? The power completely flips. It's like a seesaw. Suddenly, the manufacturer has all the pricing power and these fantastic profit margins, while the poor merchant is stuck competing with the store down the street, which just squeezes their profits. And this is the bottom line, right here. A customer walks into a store asking for a specific brand. To make that sale, and, just as important, to keep that customer coming back, the merchant has to have that brand. And where do they get it? from one place, the manufacturer. That's the toll bridge in action. The store has to pay the manufacturer's price. They have to pay the toll to cross the bridge. Okay, let's make this super practical. Just imagine for a second you're walking into a 7-Eleven or any convenience store. Just stop and think. What are the brands you absolutely 100% expect to see on the shelves? I mean, what products, if they were missing, would make you just turn around and walk right out? Yeah, I bet a few names popped right into your head, didn't they? Coca-Cola, Marlboro, Hershey's, Wrigley's Gum. These are not just popular brands. They are what we'd call non-negotiable inventory. A store just can't function without them. If you don't have Coke, your customer is going to the guy next door who does. And here's the real kicker. The companies that own these brands, Coca-Cola, Philip Morris, PepsiCo, they all earn consistently incredible returns on their capital. Why? Because they own the toll bridge. And once you see this pattern, you see it everywhere. It's not just convenience stores. Walk into a pharmacy. They've got to have Crest toothpaste. They've got to have Advil. They've got to have Listerine. Go to a clothing store. They need Hanes underwear. They need Levi's jeans. Even your local hardware store. You can bet they have WD-40 and GE light bulbs. Every single one of them is a little brand name toll bridge, collecting a tiny fee on the transactions of everyday life. Now, let's talk about a really special version of this product toll bridge. Think about a patented, life-saving drug that people desperately need, and only one company holds that patent. Well, you've just created maybe the most powerful, most profitable toll bridge on the planet. I mean, companies like Merck and Eli Lilly have built legendary businesses on this very foundation. Now, of course, the big risk is what's called the patent cliff. When that patent expires, the bridge can fall apart, but man, while it's standing, it's an absolute fortress. All right, let's switch gears. Our second type of toll bridge isn't about making a physical thing at all. It's about controlling something that's maybe even more valuable: the channels of communication between a company and its customers. These are the gatekeepers of information. You know, think about it. Hershey's can make the best chocolate bar in the world, but if nobody knows about it, what good is it? They have to get the word out. They have to advertise. And to do that, well, they've got to pay a toll to the folks who own our eyeballs and our ears, the TV networks, the local newspapers, the big advertising agencies. It's just a required toll for doing business on a large scale. This is such a great classic example. On one side, you've got a town with two newspapers. They are in a constant bloody war for advertisers, always cutting their rates, which just kills their profits. It's a tough, tough business. But on the other side, a town with only one newspaper, suddenly that paper becomes a monopoly toll bridge. Every local business that wanted to advertise in print had to go through them. They could basically name their price, and they became unbelievably profitable. The danger today, of course, is that new bridges get built, like Google and Facebook, and people just stop using the old one. And you know, this whole idea, it scales up globally. I mean, think of a massive company like Coca-Cola. They sell their products everywhere. There's no way they can manage ad campaigns in 150 different countries. They need a guide, someone to handle it for them. And that's where these giant advertising agencies like Interpublic come in. They become the essential toll bridge that these huge global brands have to cross to reach their customers all over the world. Okay, on to our third and final category, and this one might be the most fascinating of all. These companies, they don't sell a product you can touch. They don't control the media, but they sell a repetitive, absolutely essential services that people and other businesses need day in and day out, year after year. And from a business perspective, oh man, the model is just beautiful. Think about it. You don't need to build huge, expensive factories. Your product, the service, can never go out of style like last year's smartphone. You often have a really flexible workforce. It is just a lean, mean, capital-efficient way to build a toll bridge that lasts. So let's look at some real-world examples, and I guarantee you know these names. Every single April, what do millions of people have to do? Their taxes. Boom, that's H&R Block's toll bridge. You got bugs or termites? That's a constant problem. That's the toll bridge owned by Rollins, who owns Orkin. And people and businesses will always, always need cleaning services and lawn care. That's ServiceMaster. See, these aren't flashy tech companies, but boy, are they steady, consistent moneymakers. And here's another perfect example, probably sitting in your wallet right now, a credit card. A company like American Express, every single time you swipe that card, they get a tiny little piece of the action from the merchant. It's a minuscule toll, right? Pennies. But you multiply that by millions and millions and millions of transactions happening every day all over the world, and it becomes a staggering river of cash flow.
You gotta love this quote because it just perfectly captures how durable these service businesses are. The problems they solve are, well, they're constants of human civilization. Pests aren't going away, crime isn't going away, and taxes, well, we know those aren't going away. As long as these things exist, these companies will be right there collecting their tolls. So let's just quickly pull all this together. We've seen that these incredibly powerful business models, these toll bridges, they really fall into three buckets. First, you've got the makers of must-have products. Second, the communication gatekeepers who control access to the customer. And third, the providers of those boring but beautiful essential services that we'll always need.
So that's the whole theory. But the big question is, how do you actually use this? How do you take this mental model and turn it into a tool you can use to go out and find these companies for yourself? Well, the good news is, it's a lot simpler than you'd think.
Here's a wonderfully simple, totally actionable little exercise for you. It's called the supermarket test. You don't need some fancy financial software. All you have to do is just stand in front of a store, any store, and ask yourself a simple question. What brands absolutely have to be inside that store for it to even be in business? Just make a list. Those names, that's your starting point.
And this is so important. This way of thinking is active, not passive. You're starting from the real world, from a real competitive advantage that you can see and understand. That is so much more powerful than just passively flipping through financial magazines, hoping some great idea just jumps off the page and finds you. You're hunting for it deliberately. So at the end of the day, this is what I want you to take away. You now have a map. You have 3 main territories to go exploring in your search for these incredible businesses. You're looking for indispensable products, you're looking for dominant communication channels, and you're looking for those repetitive essential services. That's where you focus your attention. So I'm going to leave you with this question. As you go about your life tomorrow, when you're at the grocery store, when you're at work, when you're just watching TV, start looking for these patterns. What companies are collecting these little tolls that you've never even noticed before? Because I promise you, once you start seeing the world through this toll bridge lens, you'll start to see them absolutely everywhere. Now, go find them. Thanks for listening. All right, let's talk about one of the toughest parts of investing. Where do you even start? How do you find those great companies? Well, forget all that complicated stuff you see on TV. The secret weapon we're going to talk about today isn't on Wall Street. Believe it or not, it's probably sitting in your kitchen right now. So let's get into it. You know, this quote, it just nails it. As long as they keep making children, they'll be baking Oreos. I mean, think about that. An Oreo. It's not some flashy tech that's going to be obsolete in 6 months. It's simple. It's timeless. Your grandparents probably ate them. You eat them. Your kids will eat them. That's the kind of business we're hunting for. Something durable. Something that's just part of our lives. Okay, so that's the million-dollar question, right? It's one thing to say, hey, I love Oreos, but it's a whole other thing to figure out if the company making them is a solid investment. How do you actually connect those dots? Well, that's the puzzle we're going to solve today, piece by piece. And here's the big idea. Your best investment leads aren't coming from some Wall Street guru. They're literally in your shopping cart. Think about it. The stuff in your fridge, the soap you use, the coffee you drink. Every single one of those is a potential lead. And you know what? You've got a massive head start because you're already a customer. You understand this stuff in a way some analysts staring at a screen never will. Just picture it. You're walking down the aisle at the grocery store. You see Coca-Cola, Hershey's, Campbell's Soup. I mean, these names are legendary. They're not just cans and boxes on a shelf. They're absolute powerhouses that have been making money for investors for longer than most of us have been alive. Their brands are just rock solid. That's the kind of company we're looking for. Okay, first rule of investing. This is the big one, straight from the master, Warren Buffett. Before you do anything else, you have to follow this one simple rule. Invest in what you know. You absolutely have to understand the business. If you don't get this part right, nothing else matters. So this leads to a really powerful idea called the circle of competence. Look, this isn't about being a genius who knows everything. It's the exact opposite. It's about knowing what you don't know. It's about drawing a little circle around the things you truly understand. Even Buffett says a company like Microsoft is outside his circle. Why? Because he can't comfortably predict where it'll be in 10 years. So what's in your circle? Maybe you're a teacher or a plumber or a software developer. That's your home turf. That's where you have the advantage. Stick to what you know. All right, detective, you've got your list of companies, the ones inside your circle. Now the real investigation starts. And the first thing we got to do is figure out what kind of suspect we're dealing with. Is it just a run-of-the-mill commodity business? Or is it something special, a consumer monopoly? And believe me, this difference is everything. A commodity business, that's something where the product is basically all the same, and the only thing that matters is price. Like gasoline. You don't care who made it, you just want the cheapest pump, right? But then you have a consumer monopoly. Think Chanel No. 5 perfume. Nobody, and I mean nobody, buys that because it's on sale. They buy it because it's Chanel. That brand gives them the power to charge a premium, and people will happily pay it. That, my friends, is the kind of business that can make you rich. So once you know what to look for, that special brand power, it's time to build your case file. And the best part is, you don't need a fancy private investigator's license or some expensive database to do it. You just need to know where to look. Seriously, this is so simple, you're gonna love it. Let's stick with our Oreo example. Grab the box, flip it over, find the manufacturer's name. Then you just call them up. Ask for the shareholder relations department. Just say, "Hi, I'm interested in your company and I'd love a copy of your annual report." And you know what? They'll mail you one for free. That report, it's like the company's report card. It's a starting point for all your intel. Oh, and a quick heads up. Sometimes you'll find a fantastic company like Chanel, but you'll hit a wall because they're privately owned. That just means you can't buy their stock on the open market. No big deal. Don't let it throw you off. Just cross it off your list and move on to the next lead. There are plenty of fish in the sea. Now, here's a pro tip that feels almost like a cheat code. Your local library. I'm not kidding. It's a treasure chest of top-tier financial info, and it's all completely free. You can pull up magazines like Fortune or Business Week, but the real gold is stuff like the Value Line Investment Survey. This is a tool that even Buffett uses. It's got everything you need, all the key data going back years. The pros pay a ton of money for this stuff, and you can get it for free with a library card. Okay, so you've read the reports, you've done your homework, you're feeling good. Now it's time to take it to the next level. We're moving beyond the paperwork and into the real world. This is a technique that another investing legend, Philip Fisher, called the scuttlebutt method. This is where you go from being an analyst to a full-on detective. So what in the world is scuttlebutt? Well, think of it as good old-fashioned pavement pounding. It's about getting the real scoop, the stuff that's not in the glossy annual report. You actually go out and talk to people, customers, suppliers, even competitors. One of my favorite analogies for it is, it's like having coffee with the ex-boyfriend of someone you're about to date. You're gonna find out the real story, warts and all. And if you want to know just how powerful this can be, let me tell you the ultimate scuttlebutt story. This is about a young Warren Buffett, way back before anyone knew his name. He was just a student. And one day he finds out his professor, the great Ben Graham, is the chairman of some obscure insurance company. So what does this kid do? He doesn't just write a paper on it, no. He gets on a train and heads to Washington, D.C. on a Saturday morning. He gets to the company headquarters, a company called Geico, and it's locked. End of story, right? Not for Buffett. He starts banging on the door, just pounding on it, until finally a janitor opens up. The janitor tells him there's only one other guy in the whole building, an executive named Lorimer Davidson. So Buffett finds this guy, and for the next 4 hours, Davidson lays out the entire business model for him. By the time Buffett walked out of that building, he understood that company better than pretty much any analyst on Wall Street. And the punchline to that story, that one Saturday of hustle? Well, Buffett's company, Berkshire Hathaway, eventually made, get this, over $1.7 billion from its investment in Geico. $1 billion. With a B. That is the power of scuttlebutt. Now look, I'm not telling you to go bang on a CEO's door. You don't have to be that extreme. Scuttlebutt can be way simpler. Next time you're buying a soda, just ask the guy behind the counter, "Hey, what's selling better these days, Coke or Pepsi?" Or if you're in a clothing store, ask the manager how that new brand is doing. That's it. That's scuttlebutt. It's just simple, on-the-ground research. So let's wrap this up. We've gone from your shopping cart to the library and even on onto the street. We've followed a trail of clues, gathering intel every step of the way. You see, it's a pretty straightforward process, and it's something anyone can do. And I think that's the real takeaway here. This stuff isn't just for Wall Street guys in fancy suits. You don't need a special degree. You have everything you need to find great companies and make smart decisions. All it really takes is a little bit of curiosity and the willingness to do a bit of homework. Let me leave you with one final thought, and it's a bit harsh, but it's 100% true. At the end of the day, it's your money. Nobody will ever care about it as much as you do. So why would you outsource the most important decisions? Take control. Do the work. It's the only real way to win.
So here's my challenge to you. For the rest of this week, just pay attention. Look at the world a little differently. What brands are in your cupboards? What services can't you live without? Your next great investment is out there, probably hiding in plain sight. The case is open. Your investigation starts right now.
So, here's a thought. We're always told to bet on the jockey, not just the horse, right? I mean, you see these superstar CEOs splashed across magazine covers, and it's easy to think, yep, that's it. That's the secret sauce. But what if that's not the whole picture? What if even the most brilliant manager on the planet can't actually save a sinking ship?
You know, Warren Buffett has this perfect way to putting it. A simple analogy. Just picture a race, okay? In one boat, you've got a world-class, super experienced captain, but they're stuck in a tiny little dinghy. And in the other boat, you've got a total rookie, first day on the job, but you put him behind the wheel of a monster speedboat. Now, who wins that race? Every single time. Yeah, this single idea, this is really at the core of what we're going to get into today.
So let's dive in and really unpack this, because honestly, getting this one distinction right, the difference between the company itself and the person running it, it might just be one of the most critical and yet most overlooked keys to being a successful long-term investor.
All right, here's how we're going to break it down. We'll start by busting that superstar CEO myth. Then, we'll talk about why you have to look at the business first, management second. After that, we'll nail down the one trait that is absolutely essential for any manager and what it really means for them to think like an owner. We'll even look at a fantastic real-world example of this, and then we'll wrap it all up with how you, the investor, can put all this into practice.
Okay, first up, let's really dig into this popular idea. You know, the one where a brilliant manager can just swoop in and magically fix any broken company out there. Look, the hard truth is, some businesses are just tough. I mean, fundamentally tough. They're stuck with paper-thin margins, they're in a brutal, cutthroat industry, or maybe the whole industry is just dying out. These are the dinghies we were talking about. And it doesn't matter how hard that captain rows, the boat just wasn't built for speed. The problem isn't the person in charge, it's the very bones of the business itself.
So that leads to a really critical shift in how you have to look at things. If the business itself is that important, where do you even start your analysis? I'll give you a hint. It's not by reading the CEO's resume.
You've got to start by finding a great business, a company that has what investors call an economic moat. This is your speedboat. What's a moat? Well, it could be a brand that everyone knows and trusts, maybe a powerful network effect, a huge cost advantage. It's something baked into the business that keeps competitors at bay. That's the engine, you know? The thing that drives value over the long haul, no matter who's steering the ship for a little while.
And, I mean, listen to how bluntly Buffett puts it. It's really striking. He's not looking for a business that needs a genius to keep it afloat. No, he wants a business that's so strong, so well protected by that moat, that it could survive even so-so management and still be profitable. Now that is the ultimate stress test for a business.
Okay, so let's say you've done it. You found that incredible speedboat business. Now you can finally turn your attention to the captain. But what are you looking for? What's the number one quality that matters more than anything else? Is it raw intelligence? A crazy work ethic?
Well, look, of course you want all three of those things. A manager who's smart and hardworking. But, and this is a big but, there is a strict hierarchy here. The order of these traits is totally non-negotiable, and there's a very, very good reason for that. Honesty has to come first, period.
And here's why that's so crucial. Just think about it for a second. A manager who is incredibly smart and works like a machine, but has no integrity, that person becomes a huge danger to you. They'll use all that brainpower and all that energy to figure out ways to enrich themselves at your expense as a shareholder. See, honesty isn't just some nice bonus feature. It's the foundation. It's what makes the other two traits an asset instead of a massive threat. Okay, so how do you actually spot this honesty? What does it look like in the real world? Well, you look for managers who act less like hired help trying to build a personal empire and more like true owners of the business. Because at the end of the day, they're managing your piece of the company. It all comes down to their actions. What are they doing with the company's cash? Are they making smart, disciplined investments? Or are they just chasing these flashy acquisitions that sound good but actually destroy value? Are they focused on returns for you, the shareholder? And here's a big one. What do they do when the company is flush with cash, more than it can reasonably reinvest? That's when you really see their true colors.
Their focus should always be on making your investment grow over the long term.
All right, let's look at our perfect example of this owner mindset in action. We're going to go back to the early 90s and the management team at a company called Capital Cities. What they did was a total masterclass.
So here's the setup. It's the late 80s, rolling into the early 90s. Capital Cities is in the broadcasting business. Now, if they wanted to grow by buying up other broadcasting companies, the prices were super high. The private market was expensive. But at the very same time, they looked at their own company stock trading on the public market, and they realized, hey, our stock is on sale. It's selling for a big discount.
So what did they do? Over the next few years, they took a huge pile of the shareholders' cash. We're talking around $400 million. And instead of going out and overpaying for some other company, they did something way smarter.
Their choice was just simple, rational, common sense. Why would we go buy another company at an inflated price when the single best broadcasting business we can buy is our own, and it's selling at a bargain price? That right there is the absolute definition of thinking like an owner. So what was the result for the shareholders who stuck around? Well, think about it. Every single share the company bought back and retired was one less share in existence. That meant that every remaining shareholder's piece of the pie automatically got bigger. Your ownership stake in the business just grew and your wealth increased without you having to lift a finger. Pretty great, right?
Now, hold on. This doesn't mean management is unimportant. Not at all. Once you've found that great business, that speedboat, the quality of the captain becomes absolutely critical for what happens next. The legendary investor Bernard Bruch put it perfectly. He said, poor managers can wreck even a great situation. You need good management to steer that ship toward future growth.
And that brings us to the final piece of the puzzle. And honestly, it's the most empowering part. Your role in all this. Because as a shareholder, you are not just a passenger along for the ride. You are an owner. And you should never, ever forget that. When you buy a share of stock, you are literally handing your hard-earned money over to that management team. You're trusting them to be good stewards of your capital, to make smart decisions on your behalf. And if you don't like what they're doing, if you see them acting more like empire builders than careful owners, well, you basically have two choices. You can try to vote them out, elect a new board of directors. Or you can do what most investors do. You vote with your feet. You sell your stock and find a better place for your money.
So here's the takeaway. The next time you're looking at a potential investment, please don't just get dazzled by the charismatic CEO on the magazine cover. Step back and ask yourself the really important question. Am I betting on the captain or am I investing in the ship? Am I counting on the temporary brilliance of one person or am I buying a piece of a business so strong, so powerful that it can sail through almost any storm? Because remember, a great ship can often survive a mediocre captain, but not even the best captain in the world can save a sinking ship.
What if I told you that the absolute best time to invest in a great company isn't when everything's going great? What if it's when that company is in the middle of a full-blown crisis? I know, it sounds completely backward. It goes against every single gut instinct we have. But as we're about to see, this one counterintuitive idea is the secret behind some of the greatest investment fortunes ever made.
So let me just ask you directly. Imagine you found a fantastic business, a real long-term winner. When is the perfect moment, the absolute best time to buy in? Is it when the headlines are all glowing and the profits are just soaring through the roof? Or is there maybe a better time, a more opportune moment that almost everyone else misses?
Well, here's the answer, and it's something that masters like Warren Buffett have figured out. The real golden opportunity often shows up when that great company is weathering a massive storm, when its future looks so bleak that everybody else is literally running for the hills. See, this is the moment when fear rips open this huge gap between a company's stock price and its actual long-term value. Okay, so how does this actually work in the real world? Well, first we're going to expose the market's biggest psychological flaw, the mistake that creates these chances in the first place. Then we'll dive into two classic scenarios where this plays out. First, widespread industry recessions, and second, those embarrassing company-specific screw-ups. And finally, we'll pull all these lessons together into a really powerful playbook for any long-term investor. So why do these incredible buying opportunities even exist? Honestly, it all boils down to a fundamental mismatch in how people look at time. The stock market as a whole is just obsessed with the next few months, maybe the next year if you're lucky. This short-sightedness, it creates a massive blind spot, a huge opening for anyone who's willing to play the long game.
Just think about where the market puts all its energy. Something like 90% of all the effort that goes into valuing a company is focused on what's happening right now. A company could have a 30-year track record of incredible success, but if it has one bad quarter, just one, the market can punish its stock as if that one quarter defines its entire future. That emotional overreaction, that is the key.
Let's make this a little more concrete with a simple analogy. Imagine you own a ski resort. It's a great business, and you've had it for 30 years. Most years, you make a really solid profit. On years with incredible snow, you make an absolute killing. And, every once in a while, a warm winter comes along and you barely break even. It happens. And this is the crucial difference. As the owner, your perspective is shaped by 3 decades of history. You know a bad snow year is just a normal, predictable part of the business cycle. Your personal valuation of that resort doesn't change one bit. But if your resort were a public stock, the market would see it totally differently. It would fixate on the zero profit from that one bad year and just crush the stock price, acting as if it's literally never going to snow again. That collective panic, that is the opportunity. All right, so let's take that ski resort analogy and apply it to the real world, starting with our first type of opportunity, when an entire industry or even the whole economy hits a bad patch of weather. In a recession, fear just spreads like wildfire. And even the strongest, best-run companies can see their stocks get unfairly buried in the avalanche. A perfect example of this is Capital Cities/ABC way back in 1990. A recession was coming, and that meant companies were slashing their ad budgets. Now, Capital Cities was a media giant, and they were used to growing their earnings by a massive 27% a year. But because of the slowing economy, they announced that for 1990, profits would just be flat, same as the year before. Not a loss, just no growth. So how did the market react to the news that this fantastic company was simply going to make the same huge amount of money as it did the year before? It had a complete meltdown. In just 6 months, the stock was driven down from over $63 a share to just $38. That's a 40% collapse in value, all because 1 year's growth wasn't going to be off the charts spectacular. And what happened to the investors who ignored all that panic and focused on the long-term value? Well, by 1995, Capital Cities merged with Disney, and the stock was valued at $125 a share. For anyone who bought in at that low of $38, that translated to an incredible 26% annual compounded rate of return, a spectacular result, created entirely by short-term fear.
Now, that same recession created an even more dramatic opportunity. The real estate market was in an absolute freefall, and banks were getting terrified. Wells Fargo, one of the best-run and most conservative banks in the entire country, did the responsible thing. It set aside a massive $1.3 billion to cover potential future losses on its real estate loans. Now, it's really important to understand this. Setting aside money for potential losses is just an accounting move, a precaution. It doesn't mean those losses have actually happened yet. But Wall Street treated it like a death sentence. The stock got hammered, plummeting from $86 a share down to about $41, a staggering 52% loss in market value. The market priced Wells Fargo as if it was about to go bankrupt. But Warren Buffett, he saw something completely different. He understood that the bank's core business was basically indestructible. It was a toll bridge for the economy. People and businesses will always need banking services. He saw one of the nation's strongest financial institutions being sold at a fire sale price because of a temporary industry-wide panic. So he backed up the truck, investing heavily. And by 1997, that very same stock was worth around $270 a share. So that's what happens in an industry-wide storm. But the second type of opportunity is even more specific. This is when a fantastic company does something, well, uniquely stupid. A major, but, and this is key, a fixable mistake. Okay, take Geico in the mid-70s. For decades, their genius was simple. Only insure the safest, most preferred drivers at a low cost. It was a money-printing machine. But then, new management got greedy for growth, and they basically threw the playbook out the window. They started insuring almost anyone, and the result was predictable. A flood of high-risk drivers, a surge in accidents, and a catastrophic $126 million loss in 1975 that pushed the company to the very edge of bankruptcy. Now listen, here's the crucial point. Buffett didn't just buy because the stock was cheap. The company was in genuine, serious trouble.
He only invested after he got on the phone with a new CEO, a guy named Jack Byrne, and confirmed one critical thing. Was the plan to go back to the original, time-tested, profitable strategy? Byrne said that was exactly the plan. The mistake was correctable. That was the green light.
An even more bizarre example is American Express and the great salad oil scandal of the 1960s. I mean, this is a truly wild story. A subsidiary of Amex was responsible for verifying collateral for loans, specifically these huge tanks that were supposedly filled with salad oil. The problem? The tanks were mostly filled with water, with just a thin layer of oil floating on top. When the fraud was exposed, American Express was on the hook for $60 million, a loss that wiped out most of the company's net worth.
Wall Street panicked and the stock was just annihilated. But Buffett's logic was simple. This scandal, as embarrassing and expensive as it was, had zero impact on the company's two golden geese, the traveler's truck and the credit card businesses. People weren't going to stop using their Amex cards because of some salad oil. He famously invested 40% of his entire partnership's capital into the stock. Just 2 years later, he sold for a $20 million profit. All right. We've seen the theory and some pretty dramatic case studies. Now let's pull all of this together into a clear framework, a playbook, for how you can actually gain an edge when everyone else is running for the exits.
And this brings us to the central paradox of downturns. These temporary problems, whether they come from a recession or a company screw-up, are actually good for the strongest companies. They test the entire system. Weaker competitors that were just barely hanging on, they get wiped out. So when the storm passes, the strong survivors emerge into a much less crowded field, ready to capture an even bigger piece of the pie.
So here it is, the 4-step playbook. First, you have to do your homework ahead of time and identify a truly excellent business with advantages that can last for decades. Second, you wait. You have to be patient and wait for that great business to hit a temporary solvable problem. Third, and this is the most important step, you absolutely must verify that the core strengths of the business are still intact and that the problem hasn't caused any permanent damage. And finally, you act. You invest precisely at the moment of maximum fear, when the market is in a full-blown panic. So we'll end with this thought. This isn't just a history lesson. It's a fundamental, recurring feature of how markets work. There will always be another crisis, there will always be panic, and the market will always struggle to tell the difference between a temporary stumble and a fatal blow. The real challenge, and the ultimate opportunity for you as an investor, is to train yourself to calmly see that difference when everyone else is blinded by fear. Thanks for joining us for This Explainer. Welcome to The Explainer. Today, we're going to unpack a really fascinating and, honestly, often misunderstood phenomenon, the market panic. We're going to explore how the market's own plumbing, its own internal mechanics, can just go completely haywire, creating both total chaos and, believe it or not, incredible opportunity. So let's start with a pretty wild idea. What if this system itself, the actual pipes and wires of the market, can cause a full-blown meltdown, even if the economy is fine and businesses are healthy? It's a strange thought, right? But it's a hidden flaw that has caused absolute chaos before, and you can bet it's going to happen again.
To really get our heads around this, you have to understand that there are two totally different games being played in the market at all times. On one side, you've got investing. That's focused on the long-term value of a business. But on the other side, you have trading, playing the market, which is all about making a quick buck on short-term price swings. Most of the time, they get along just fine, but when that plumbing breaks, the traders can accidentally take over in a really dangerous way.
All right, so here's our roadmap for today. We're going to start with this hidden flaw in the market. Then we'll travel back to 2 massive historical panics to see it in action. We'll break down the vicious cycle that actually drives these things, and then, at the end, we'll uncover the opportunity that's hiding inside all that chaos. Okay, let's dive right in. Look, most of the time stock prices move because of news, earnings reports, a cool new product, what the Fed is doing. But every once in a while, the infrastructure of the market, the literal way stocks are bought and sold, takes over, and that starts driving the action. And this is where things get really scary. A stock stops being treated as a piece of a real business, and it just becomes a thing, a commodity to be dumped at any price. The selling isn't driven by logic, it's driven by sheer downward momentum and panic. That's what leads to a liquidity crisis, that terrifying moment where everybody is frantically trying to sell, and absolutely no one is buying. For our first case study, we're going to hop in a time machine and go all the way back to 1901. This was the era of railroad barons and just brutal corporate warfare. This is a story about a secret takeover, a single solitary stock, and a mechanical flaw that brought the entire market to its knees.
So the battle for the Northern Pacific Railroad just escalated incredibly fast, over a matter of days. You've got these two titans, Hill and Harriman, secretly fighting for control, and all they're buying is pushing the stock price way up. Well, a bunch of traders who weren't in on the secret saw that rising price and thought, that's a bubble, it's gotta pop. So they bet heavily against it. They were about to learn a very, very painful lesson about market mechanics.
Now, to really understand the insane risk these traders took, we gotta break down short selling. It literally means you are selling something you don't actually own. You borrow a share from somebody, you sell it on the market, and you promise to give that share back later. It's a fantastic strategy if the price goes down. But what happens if the price goes up and you can't find a single share to buy back?
And that was the trap. The two guys fighting for control had bought up every single available share of Northern Pacific. The short sellers were legally on the hook. They had to buy shares to return to their lenders, but there was literally no stock for sale anywhere. They were caught in what's called a short squeeze.
With no shares available and a legal gun to their head, just pure animal panic took over. The trapped short sellers started bidding against each other, just screaming any price to get their hands on a share so they could stop the bleeding. By noon on Thursday, May 9th, they had bid the price up to an almost unbelievable $1,000 a share. And this is the crucial point. To get the cash to pay for this one disastrous $1,000 stock, they had to sell everything else they owned. They started dumping shares of perfectly good, totally unrelated companies, which caused the entire rest of the market to just nosedive. The plumbing problem in one tiny corner of the market was now flooding the entire system.
An investor named Bernard Baruch, he was actually there on the floor of the exchange, and he saw it all happen with his own two eyes. He got it. He understood that this massive sell-off had absolutely nothing to do with the value of other companies. It was pure, mechanics-driven fear. A plumbing problem in one stock was threatening to burn the whole house down.
Okay, now let's jump forward 86 years to 1987. The players changed from titans to algorithms, and the speed went from days to minutes. But the underlying mechanical failure? Eerily similar. This time, a ghost in the machine was about to cause the panic.
The scale of this was just mind-boggling. In a single day, the market lost almost a quarter of its value, $1 trillion, just gone. It was a drop that dwarfed almost anything that came before it, and it wasn't triggered by a war or depression, but by a brand new set of automated players.
Yeah, the key players this time weren't tycoons. They were two new, sophisticated, computer-driven strategies. First, you had something called portfolio insurance, which was basically designed to automatically sell as the market fell to protect you from losses. Second, you had index arbitrage, a super high-speed strategy that took advantage of tiny price differences between two related markets. Now, neither of these was evil on its own, but put them together and, well, they were explosive.
So how in the world did these two automated strategies end up creating a financial black hole? I mean, it wasn't a conspiracy. It was just a deadly, completely unintended feedback loop. Let's break down exactly how it happened. Okay, so this was the death spiral. It started with a normal, small dip in the market. That dip automatically triggered the portfolio insurance computers to sell a bunch of futures contracts. All that selling created a weird price gap between the futures market and the actual stock market. And that's when the second set of computers, the indexed arbitrage guys, saw that gap and pounced. They instantly sold huge volumes of actual stocks to make a risk-free profit on that difference. But all that selling drove the stock market down even further, which, you guessed it, triggered even more selling from the portfolio insurance computers. It was a vicious, self-reinforcing cycle, spinning faster and faster with absolutely no human brakes. And here's the crucial point again. Just like in 1901, the actual health of individual businesses became completely irrelevant. The computers didn't know or care if Coca-Cola was having a great year. They were just executing a command based on price movement. It was a purely mechanical collapse driven by the plumbing, not the fundamentals. So we've looked at two unbelievable disasters driven by the same hidden flaw in the market's plumbing. So now we can see the pattern, and more importantly, the incredibly powerful lesson this holds for any long-term investor. This right here, this is the core of the whole thing. It's the same story, playing out 86 years apart.
You have different triggers, you have different technology, but the exact same kind of mechanical flaw led to the exact same result: irrational, market-wide panic selling. And on the other side of that trade, you see the same opportunities seized by a rational investor, Baruch in 1901, and Warren Buffett in 1987, who both stepped in to buy amazing companies at a massive discount. And this quote just nails it, doesn't it? When the market's mechanics cause this kind of irrational panic, when fear completely shoves reason out the door, it creates this incredible field of opportunity for the investor who can stay calm and focused on the actual business, not the flickering price on the screen. So the biggest takeaway from all of this is really a new way to look at market volatility. You have to understand that sometimes a crash isn't about the economy. It's just about the plumbing. And when that plumbing breaks, it creates a temporary, insane gap between a company's price and its actual value. For the patient investor, that's not a bug, it's a feature. And believe me, this will happen again. And that leaves us with one final and really crucial question. The technology and the triggers will be totally different next time. Maybe it'll be high-frequency trading or some social media-fueled mania. But the human emotion of fear and the potential for these mechanical failures, that'll be exactly the same. So when that day comes and fear has totally replaced reason, are you going to see it as a crisis to run away from or as the opportunity of a lifetime? All right, welcome to The Explainer. Today, we are diving into something that is constantly, quietly working in the background of your life: inflation. It's really the secret story of the money in your wallet, and it's the reason that money seems to buy a little bit less each year. You know, it's a question we all ask ourselves, right? How come a candy bar that was a nickel when I was a kid is now $1.50? Why do house prices just seem to be on this rocket ship that never comes down? Well, to get to the real answer, we've got to go way back. We have to unpack the story of money itself. So here's how we're going to break it down. We'll start with how we went from trading chickens to using gold. Then we'll see how big wars gave us paper money. We'll cover the moment we said goodbye to gold for good, look under the hood of the inflation machine itself, and wrap up with why politicians are kind of stuck with it.
Okay, so picture a world with no money. None at all. If you were a farmer and you needed a new plow, you had to find a blacksmith who hopefully needed a pig. I mean, can you imagine the hassle? It was messy, it was inefficient, it just didn't work very well. So pretty quickly, we realized we needed something better. We started using things that everyone agreed had value, like salt, or even camels in some places. But that was still kind of clunky. Eventually, we landed on gold and silver, which was a huge leap forward, leading to the first real coins, like the ones the Romans used.
So why gold? What was so special about it? Well, for a few thousand years, it was pretty much the perfect money. Think about it. It's rare enough to be valuable, you can divide it up without losing value, it's easy to carry around, and it doesn't rust or rot. It just worked. It solved all the problems that bartering had. And that system, based on real physical gold, it was pretty stable for a long, long time. But it was about to get completely turned on its head by one of humanity's oldest and most expensive activities: going to war. The sheer cost of modern warfare was about to change what money even meant. And I mean, just think about the scale here. It's one thing to buy swords and muskets for your army. It's a whole other thing to pay for entire fleets of battleships and, for the first time, airplanes. The money required was just astronomical, way more than a government could ever hope to collect just by taxing people's gold coins. They needed a new trick up their sleeve. Now, this switch to paper money didn't just happen overnight. It was a really smart, gradual process. First, government said, hey, give us your heavy gold, and we'll give you this convenient paper certificate, this IOU. And people loved it. Paper is so much easier to carry. Over time, we got so used to using the paper that we kind of forgot it was really just a claim check for the actual money, the gold, sitting in a vault somewhere. And that comfort level, that public acceptance of paper, is what opened the door for one of the biggest changes in modern economic history. The moment governments decided, you know what, we're just going to cut the link between this paper in your hand and the gold it's supposed to represent. And you can see it happen in a few key steps. Back in 1933, the US government basically told its citizens, you have to turn in your gold for paper dollars. Then, after World War II, other countries started running out of gold and had to drop the standard. And then, the final nail in the coffin was in the early 70s, when President Nixon announced to the world that the US dollar would no longer be redeemable for gold, period. And would you just look at that number? With the stroke of a pen, the US government nationalized all the private gold, and its own wealth just exploded overnight. This gave it an unbelievable amount of financial firepower, especially with another massive war, World War II, right around the corner.
This, right here, is the moment everything changed. Let that sink in. For the first time, there was no physical limit to how much money a government could create. The value of a dollar wasn't tied to a rare heavy metal anymore. It was now tied to, well, the government's promise and its ability to fire up the printing presses.
So, what happens when a government can literally create money out of thin air? Well, you get a very interesting result. It turns out you're not actually creating more wealth for everybody. What you're really creating is inflation. So yeah, that's the textbook definition. An increase in the money supply causes prices to go up. But let's make that real. We're going to use a super simple example to show how this inflation machine actually works, because this is where it all clicks into place. Okay, imagine we're on a tiny island. The entire economy has $100 million. And on this island, a dozen eggs cost exactly $1. Simple enough. But then the island government prints another $100 million and just puts it into circulation. All of a sudden, you have twice as much money chasing the exact same amount of eggs. What happens? Well, eventually, the price of those eggs is going to double. It has to. But why? How does more money actually push prices up? It's not some kind of magic. It's really just about human behavior. And the best way to visualize this is to imagine that you and I are at an auction. All right, first scenario. You and I walk into this auction and we each have $50 in our pocket. We both want the same thing. What's the absolute maximum price that item can sell for? $50, right? Because as soon as I bid 50, you can't go any higher. The bidding stops. Okay, now scenario 2. Right before the auction, somebody comes and hands both of us an extra $50. We walk in with $100 each, bidding on the exact same item. What happens now? Well, we can just keep bidding against each other until the price hits $100. See the point? More money didn't create a second item to buy. It just made the one that was already there twice as expensive. And this is what I like to call the great illusion of inflation. Sure, your salary might go up over the years. That house you bought a long time ago is probably worth a lot more on paper. You feel richer. But your purchasing power, what your money can actually go out and buy, has probably stayed about the same. Because as you can see here, the cost of everything, from burgers to ski tickets, has gone up right along with it. So you have to ask, right? If inflation is basically this sneaky hidden tax that eats away at our savings, why on earth do governments keep doing it? Well, the answer comes down to a really tough choice, a politician's dilemma. I mean, just look at the two options from a politician's perspective. On the one side, you have inflation. Yeah, it hurts savers, but home prices go up, stocks go up, people feel like they're getting wealthier. It's kind of a slow, dull pain. The alternative, deflation, is an absolute economic nightmare. Prices fall, but so do salaries. Your mortgage payment is suddenly impossible. Banks collapse. You get mass unemployment. That's how you get depressions and millions of very, very angry voters. So which one do you think they're going to pick? No politician in their right mind wants to oversee an economic depression. That's a one-way ticket out of a job. So they'll always choose the path that creates the illusion of wealth, even if it means our money is worth a little less every single year. And that brings us to maybe the biggest takeaway from all of this. Inflation is not a mistake. It's not an accident. In our modern financial system, it is a feature, not a bug. And that means for all of us, as we save money, as we invest, as we plan for retirement, we just have to accept that the default setting is for our money to slowly but surely lose its value over time. You know, that old saying really sums it up perfectly. Fool me once, shame on you. Fool me twice, shame on me. The system fooled everyone once by swapping real gold for paper promises. Now, that same game just continues in a different form, the slow, steady bleed of inflation. And that leaves all of us with a really big question. Now that we see how the game is played, how are we going to choose to play it? Let's talk about inflation. You know, for most of us, it feels like this silent tax, right? Something that just slowly eats away at our savings and investments. It feels like an enemy you just can't beat. But what if I told you there's a way to flip the script entirely, to turn that enemy into your single greatest financial ally? Well, that's exactly what we're going to dive into today, a completely counterintuitive investment idea from Warren Buffett that shows you how to do just that. So, here's the roadmap for our journey. First, we're going to establish the villain of our story, inflation, the common enemy. Then we'll get to the good part, Buffett's wild theory. We'll see it play out with a real-world tale of two very different businesses. We'll put them through what I'm calling an inflation stress test and see who comes out on top. Then we'll uncover the magic trick that makes it all possible, and we'll finish up with a really important takeaway you can use in your own thinking.
Okay, so let's just start on the same page. The thing we all know, the conventional wisdom, is that inflation is bad. It's just bad for investors, full stop. It's this constant grinding pressure that makes every dollar you have today worth just a little bit less tomorrow.
And hey, you're in pretty good company thinking that way. For the longest time, even Warren Buffett himself saw inflation as public enemy number one. And let's be clear, for the average investor, especially one holding something like a long-term bond, it is an absolute wealth destroyer. It's a guarantee that the money you get paid back in the future will buy you less stuff. And this is where the theory hits reality, hard. Imagine this. Back in the 1960s, you buy a $4,000 bond from GM. Back then, that was enough to buy a shiny new car right off the lot. Now, fast forward a few decades to the 90s, GM pays you back your $4,000, just like they promised. The problem? That same $4,000 can now barely buy you a quarter of a new car. The number of dollars is the same, but its actual power, what you can do with it, has been absolutely crushed. That is the brutal hidden tax of inflation. But then, something changed. In 1983, Buffett had this light bulb moment, a fundamental pivot in his thinking that turned this whole idea completely on its head. He discovered a crack in the rule, a very specific scenario where inflation wasn't the enemy at all. And here is the core of his radical idea. He realized that for a very specific kind of business, inflation doesn't just hurt less, it can actually be a tailwind. It can actively work in your favor as an owner of that business. It can literally make you wealthier. So, the billion-dollar question is, what kind of company is this? Buffett gave it a name, the consumer monopoly. Now hold on, we're not talking about your local utility company, a government-regulated monopoly. No, this is something different. This is a business whose competitive advantage comes from having an incredibly powerful brand. It has such a deep connection with its customers that it needs very little physical stuff, factories, heavy equipment, tons of inventory, to make a whole lot of money. Its most valuable asset is the real estate it owns inside its customers' minds. Okay, theory's great. But to really get this, we need a real-world example. And Buffett gave us the perfect one from his own portfolio. We're going to compare two businesses that, on the surface, looked surprisingly alike. Let's wind the clock all the way back to 1972.
All right, take a look at this. On one side, you've got See's Candy, on the other, a generic steel manufacturer. Now, the first thing I want you to look at is that middle column, net earnings. See that? They both earned the exact same amount of money, $2 million. So it's a tie, right? Well, not so fast. Now slide your eyes over to that column on the right, net tangible assets. This is where the story really starts. See's only needed $8 million worth of physical assets to make its profit. The steel mill? It needed a whopping $18 million in furnaces and equipment to make the very same $2 million. And this bar chart just makes that difference pop right off the screen. See's Candy was an economic machine, generating an incredible 25% return on its tangible assets. For every dollar tied up in physical stuff, it was spitting out 25 cents in profit. The steel manufacturer was way less efficient, chugging along at just over 11%. Let's just park on that number for a second. $8 million. That's it. That's the entire physical footprint See's needed to generate $2 million in earnings. It's what we call a capital-light business. It's lean. It's efficient. Now contrast that with the steel mill. To get that exact same $2 million profit, it needed more than double the investment, a staggering $18 million locked up in assets that rust and break down and get old. This is a capital-intensive business. Now, at this point, See's is clearly the better business, but you could argue they're both still making money. Okay, and now for the main event. Let's bring in our villain, inflation. Let's fast forward a decade, a period where prices for absolutely everything have doubled. Let's see how our two businesses hold up under the stress. So, 10 years go by, and at first glance, everything looks great for both of them. The price of candy doubled, the price of steel doubled, and guess what? Their earnings both doubled to $4 million each. So, it looks like a tie, right? Everybody wins?
Not so fast. This is where the hidden trap of inflation finally springs shut. Because those giant, expensive factories and all that heavy machinery, they don't last forever. They wear out, they need to be replaced, and you have to replace them at the new, much, much higher prices. And this right here is the punchline to the whole story. To just stay in business, to maintain its existing operations, See's Candy has to come up with $16 million to replace its assets as they wear out. But the steel manufacturer, its original $18 million asset base, now costs an eye-watering $36 million to replace. That is a massive amount of cash that has to be poured back into the business just to keep from falling behind.
So let me ask you, now that you see the true cost of doing business in an inflationary world, which company would you rather own? The one that needs to find $16 million, or the one that has to find a staggering $36 million, all to generate the exact same $4 million in earnings? Yeah, the choice becomes pretty obvious, doesn't it?
And what we just witnessed is what Buffett calls the magic trick. It's the fundamental economic advantage that a consumer monopoly has when prices are rising all around it. So let's break down exactly what makes this trick work. The businesses that win during inflation, they all share these key qualities. They have that amazing brand power we talked about, that consumer monopoly. They have a very low need for physical assets. And because of that, they naturally generate a super high return on whatever capital they do need to employ. And this is the big one. Their brand is so strong that they can raise their prices to keep up with inflation, and their customers barely even blink. And you know what? The stock market eventually figures this stuff out. It understands that $1 of earnings from a company like See's Candy is just higher quality. It's more valuable because you, the owner, get to keep more of it. It isn't being constantly eaten up by maintenance. And so the market rewards these incredibly efficient businesses with a higher valuation, a higher PE ratio, than their capital-hungry peers.
So let's bring it all home. What does this all mean for you when you're looking at investments? The whole point here is to give you a powerful new mental model, a new lens that you can use anytime you're analyzing a business.
You can basically boil it down to this simple 3-step test. First, ask yourself, does this company have a brand that people are just fanatical about? A true consumer monopoly. Second, look at the balance sheet. Does it need a ton of expensive stuff to operate, or is it capital light? And third, does it have pricing power? Can it raise its prices a little bit year after year and customers just happily pay it? And that brings us full circle, right back to Buffett's core insight, which is so important it's worth hearing again. While inflation is absolute poison for most companies, it can actually be a powerful tailwind for that small, special group of businesses that have this consumer monopoly DNA. For them, inflation becomes a friend, not an enemy. So I'll leave you with this final thought to chew on. Look around at the economy today, at the big companies in tech, software, consumer goods, you name it. Which ones look like See's Candy? The ones with powerful brands that don't need giant, expensive factories to grow? And which ones look more like the steel mills? Because finding the answer to that question, well, that might just be the secret to turning an economic enemy into your greatest ally. All right, let's dive into a topic that for most people is probably the most boring part of investing. But here's the thing. For the really successful investors, it's where they start. We're talking about taxes. Because, it's never about what you make. It's always about what you get to keep. Understanding that one simple truth is what separates the amateur from the pro. So let's get into it. This quote just nails it, doesn't it? It's a huge blind spot for so many of us. We get all excited about a stock, we watch it climb, we celebrate the gains, and then, way down the line, we get a nasty surprise from the tax man. Well, today, we're going to flip that script entirely. We're putting taxes right where they belong, front and center, just like the legendary investors do before they even think about putting a dollar to work. So here's our roadmap. First, we'll look at exactly why taxes are such a common blind spot. Then, we're going to follow a single dollar of profit on its entire journey. We'll explore that critical choice between a company paying you a dividend or keeping the cash. We'll see how different investments are taxed completely differently, uncover a pretty wild advantage that corporations have, and then wrap it all up with the one reality that never changes. Okay, so let's start with this core idea. For a serious investor, thinking about taxes isn't some chore you put off until tax season. No way. It's a fundamental piece of the puzzle. The tax rules can totally change which company you invest in, and maybe even more importantly, how long you plan to stay invested. It's all about moving taxes from an afterthought to a forethought. To really get the impact of taxes, you have to go back, way back to where the money actually begins its life.
And that's as corporate profit. Before you, the shareholder, ever see a penny, that money has already had its first encounter with a tax collector. So, picture this. A company has a fantastic quarter. They make a profit. That's step one. But immediately, and I mean before anything else can happen, the government steps in and takes its slice. That's the corporate income tax. Step two. And only what's left after that is what's called net income. This is the first big tax hurdle that money has to clear. And that brings us to a term you probably heard a million times, EPS, or earnings per share. It's so easy to just assume that this is a pre-tax number, but it's not. The EPS number that you read about in financial news has already had the corporate taxes taken out. The government's already taken its first cut. So, to make this all crystal clear, let's follow a real number. Let's imagine a company we've invested in just announced that after paying all its corporate taxes, it earned exactly $10 per share. This $10 is the real after-tax profit. The big question is, what happens to it now? And this is where we come to a fork in the road. The company's management team has to decide what to do with that $10 of profit. And they basically have two main choices, two paths they can take. And whichever path they choose has massive tax consequences for you, the investor. So the two options are pretty simple. On one side, they can pay a dividend. That means they literally send the cash to your brokerage account. On the other side, they can retain those earnings. That means they keep the cash in the company's bank account to reinvest in the business. Build a new factory, develop a new product, that kind of thing. Let's see how the tax man looks at each of these choices. Okay, let's take path number one. The company decides, you know what, we're going to take that full $10 of profit and send it out as a dividend. So for every share you own, $10 is heading your way. And on the surface, that sounds pretty great, right? And there it is. The $10 dividend shows up in your account. The full amount. But here's the thing you absolutely have to remember. This money's journey through the tax system is not over. Not by a long shot. In fact, it's about to get hit with another tax. This is the crucial part. That $10 dividend is now considered your personal income. So even though the corporation already paid tax on that profit, you now have to list it on your tax return, and the government gets to take a second bite out of the very same dollar. This is what people mean when they talk about double taxation. So let's just use the example from our source material here. If you're in a 31% personal income tax bracket, the tax you'll owe on that $10 dividend is $3.10. That money doesn't go to you. It goes right to the government. So after that second round of taxes, this is what's actually left. From that original $10 of profit, what you can actually spend is just $6.90. A pretty big chunk of it has just vanished. This chart really shows it plain as day. Of that $10 that came your way, you only get to keep 69% of it. The other 31% is gone, paid in personal income tax. And don't forget, this is on top of the corporate taxes that were already paid. You can see just how much taxes can eat away at your returns. Okay, so now let's hit the rewind button and check out the other path. What if the company decided not to pay you that dividend, but instead to retain that $10 of profit inside the business? Well, this leads to a completely different tax situation for you. This is the absolute game changer. When the company keeps the money, the value of the business goes up. For every share, there's now $10 extra of value in the company. But here's the key. For you, the shareholder, there is no immediate tax bill. You didn't get any cash, so you have no income to report. That $10 is still working for you, but you've just neatly sidestepped that whole second layer of personal tax. And this whole difference between dividends and retained earnings, it opens up a much bigger conversation. Because the truth is, the tax code treats different kinds of investment profits very, very differently. It is not a level playing field, and if you know the rules, you have a massive advantage. So think about it. If a company retains its earnings year after year and uses that money to grow, what should happen? The value of your stock should go up. And when you finally decide to sell that stock for more than you paid for it, that profit is subject to a completely different tax, the capital gains tax. And the best part? You only pay it when you decide to sell. You're in control. I mean, just look at this comparison. It's night and day. The profit you make from selling a stock you've held for a while is a capital gain, taxed at a max federal rate of 20%. But dividends, bond interest, that's treated as regular income, with a tax rate that can shoot up to almost 40%. The tax code is practically shouting at you that it prefers long-term growth over immediate income.
But it gets even more interesting. Just when you think you've got it all figured out, there's another wrinkle in the tax code. See, all the rules we've been talking about apply to individual investors, people like you and me. But what happens if the investor is another corporation? Well, the rules change completely. This chart says it all. As an individual, you could pay a federal tax rate of nearly 40% on the dividends you receive. But if one corporation owns stock in another and receives a dividend, its tax rate is way down around 14%. This is a huge structural advantage for holding companies like Berkshire Hathaway. It lets them receive dividend income way more efficiently than you or I ever could. So, as we pull all this together, what's the big lesson here? Look, tax rates will go up, they'll go down, the rules will get tweaked. But one thing is constant. One thing never changes. In every single investment you ever make, you have a silent partner. And that partner is the government. This is the fundamental truth you have to accept. Ignoring taxes is like trying to plan a road trip without looking at a map. Sure, you might end up somewhere interesting, but you're leaving so much potential on the table. Once you accept that the government is always going to get its cut, you can start planning around it, you can structure things more efficiently, and you can maximize what you actually get to keep. So I'll leave you with this question. The next time you're sizing up a potential investment, are you just going to look at its growth prospects? Or are you also going to ask, how is my return going to be taxed? Is it going to be a highly taxed dividend, or is it going to be a more favorably taxed capital gain? Because asking that question, making taxes part of your primary analysis, that's not just smart, it's essential. Thanks for joining me.
Hello and welcome. Today, we're going to pull back the curtain on something that is absolutely critical to investing, but it's something a lot of people just don't think about. We're going to talk about the hidden forces that are constantly, quietly chipping away at your investment returns. And we're going to see why a master investor like Warren Buffett aims so incredibly high with his own investments. Okay, let's just jump right in with a question. Let's say you put your money in a pretty solid corporate bond, and it's paying you an 8% return every year. You'd probably be feeling pretty good about that, right? I mean, 8% sounds like a nice, healthy gain. But what if I told you that when all is said and done, after the real world gets its hands on that return, your actual gain, the real increase in your wealth, is closer to 0.5%? Sounds crazy, I know, but stick with me and you'll see exactly how this math works out.
So where does all that value disappear to? Well, our first culprit is the most persistent one out there: inflation. People call it the silent thief for a reason. It's the force that guarantees that just holding on to cash is a losing proposition over the long run. And to really get why, we need to talk about something called purchasing power.
Purchasing power sounds kinda technical, but it's really simple. It's just what your money can actually buy. It's not about the number printed on the bill, right? It's about how many cups of coffee or tanks of gas or whatever it is you want, how much of that stuff your money can actually get you. And that is exactly what inflation attacks.
So let's put a number on it to make it real. If inflation for the year is running at 5%, that means the cash you have sitting in a savings account or, tucked away somewhere safe has effectively lost 5% of its power, its purchasing power, in just 1 year. The number of dollars is the same, but they buy you less. Let me paint a picture for you. That crisp $100 bill you had last year, today it's still a $100 bill, but it can only buy what $95 could have bought you a year ago. That's a $5 loss in what you can actually do with your money, and it just poof, vanished into thin air because of inflation. And of course, this is exactly why we invest our money in the first place. We have to put it to work to try and outrun inflation and hopefully actually grow our wealth. But this is where so many people fall into a trap. It's a major illusion. The thinking goes, hey, if I can just earn a return that matches inflation, I'm doing great. But are you really? Let's just walk through the simple logic of it. Okay. So inflation is eating away 5% of your money's value. Step 1. So you go out and you find an investment that earns you a 5% return. Step 2. Great, you've canceled it out, you're back to even. But that's just it. You're just even.
Your real growth in purchasing power is a big fat zero. You've essentially been running on a financial treadmill. You're putting in the effort, you're taking on investment risk, all just to stay in the exact same place. You haven't actually gotten any wealthier. And, believe it or not, the story actually gets worse from here, because there's another player we haven't even talked about yet. And now we introduce the second force that's coming for your returns: taxes. Because right when you think you've managed to fight inflation to a standstill, you have to remember, Uncle Sam wants his cut. Investment gains are taxable, and this is where the math gets really, really painful. Now, here is the absolute kicker. This is the detail that trips almost everyone up.
The government doesn't care that the first 5% you earned was just you trying to keep your head above water with inflation. Nope, it taxes you on your entire nominal gain. That whole 5% you made, it's all considered taxable income.
Let's look at the brutal numbers. So you earn your 5% return. Let's say you're in a 31% tax bracket. Instantly, 1.55% of your return is gone. It goes to the government. So now your after-tax return is only 3.45%. Now we subtract that 5% from inflation we were fighting against, and look at that. You're not at zero. You've actually gone backwards. You have a real loss of purchasing power of over 1.5%. You invested your money, and you ended up poorer.
So if a 5% return actually makes you poorer, what return do you need just to stay afloat? This brings us to the real aha moment in all of this. We need to figure out what the real break-even point is. The minimum you have to earn just to stop from losing ground.
Let's go back to our example from the very beginning of this explainer, that seemingly attractive 8% return from a corporate bond. It's well above our 5% inflation rate. This has to be enough to generate some real growth, right? Well, let's break it down and find out.
Okay, here's the play-by-play of what happens to that 8%. You start with 8. The taxman takes his 31% cut. That's 2.48%. Gone, just like that. That leaves you with an after-tax return of 5.52%. Now, we subtract the 5% for inflation's silent tax, and what are you actually left with? What's the real, tangible increase in your wealth? Just 0.52%, 0.5%.
This chart just says it all, doesn't it? You start with that big, beautiful bar on the left, your 8% gross return. Then taxes come in and take a slice right off the top. Then inflation comes along and takes another huge bite. And you, the investor, are left with that tiny little sliver at the end. It's a pretty sobering picture when you see it laid out like that. So you know what this means? In this specific world, with 5% inflation and a 31% tax rate, your actual break-even point isn't 5%, it's 7.2%. You need to earn 7.2% before taxes just to have a real return of zero. Anything less than that, and you are actively losing purchasing power year after year. Now, this is not a new problem. This isn't some new discovery. The greatest investors in history, the real legends, have built their entire strategies around this exact challenge. And this brings us straight to the thinking of people like Warren Buffett and his incredible mentor, Benjamin Graham.
I mean, just listen to this quote. This is from Benjamin Graham, writing way back in 1951. He already saw that inflation wasn't a temporary thing, it was a permanent feature of the economic landscape. And he understood that while nothing gives you perfect protection, owning a piece of a business, a common stock, gives you a much better fighting chance than holding bonds or, God forbid, cash.
And this principle has been proven right time and time again. Graham was sounding the alarm in the 50s. Then came the 1970s, this brutal period of high inflation and high taxes, and it just hammered this lesson home for an entire generation. And today, the exact numbers change, but those twin forces, those twin headwinds of inflation and taxation, they are just as real and just as important for all of us to deal with.
So let's actually look at that 1970s environment, because this is where the famous 15% rule really comes from. Imagine a world where inflation is raging at 9% and the tax rate is 40%. Just do the math. To get a real return of zero, just to break even, you would have needed to find an investment that returned a staggering 15% before tax. At 15%, the taxman takes 6%, leaving you with 9%. Then inflation eats that 9%, and what are you left with? Zero.
So why does a guy like Buffett aim for at least 15%? Well, it's because he's operating on a few core beliefs about how the world works. He basically believes that politicians, for all sorts of reasons, will always be tempted to inflate the economy. And, over the long haul, they'll always be tempted to raise taxes. So if you assume those two powerful forces are always working against you, you have to set a really high bar for yourself just to be sure you're actually getting ahead.
That 15% isn't just some random number he pulled out of the air. It is a deliberately, incredibly high-performance benchmark. It's a standard that's designed to be high enough to take the hit from inflation, take the hit from taxes, and still have a meaningful, real return left over for the investor at the end of the day.
And that, right there, is the single most important thing to take away from all of this. It's not about your headline return. It's not even just about beating inflation. To truly get ahead, to genuinely increase your family's purchasing power over time, your investment returns must be high enough to clear both hurdles: the silent tax of inflation and the very real taxes on your gains.
So I'll leave you with this to think about.
Don't get hung up on the number 15%, but think about the principle. Look at your own goals, your own tax situation, and the economy we're living in right now. After you account for inflation and taxes, what is the real return you need to be making to ensure you're not just running in place, but you're actually moving forward? That's the question we all need to answer for ourselves. Thanks for joining me.
All right, today we are going to tackle an idea that is so fundamental to investing, it's pretty much the first thing anybody ever learns. We're going to dive into a powerful and yet, for a lot of people, a pretty controversial strategy that some of the greatest financial minds have used to build just absolute fortunes. It's a strategy that makes us ask a really tough question. Is the safest advice you've always heard actually the riskiest? We've all heard this a million times, right? It's the kind of wisdom your grandma would give you, and it is the absolute bedrock of modern investing theory. It feels like common sense. Spreading your risk is smart, it's safe. But what if this whole idea, as well-intentioned as it is actually built on a shaky foundation? What if it's not a path to wealth, but really just protection from ignorance?
And boom, there it is, a direct shot from the Oracle of Omaha himself, Warren Buffett. He's not just questioning the strategy here. He's basically calling it a safety net for people who haven't done their homework. You know, this one sentence just flips the entire conversation on its head. It forces us to wonder, is spreading your money all over the place a sign of wisdom, or is it just admitting that you don't really know what you're doing?
To really get our heads around this, we have to look at two completely different ways of thinking, and these were championed by some of the sharpest investors of the 20th century. This isn't just some, technical squabble. It's a real philosophical battle between owning a huge collection of everything and carefully choosing just a handful of masterpieces. So this first philosophy, it actually comes from Warren Buffett's own mentor, the father of value investing himself, Benjamin Graham. Now, Graham's whole approach, it was a numbers game, pure and simple. He said you should have at least 100 stocks, not because he thought they were all amazing, but to create a kind of statistical shield. He knew some were going to fail, that was a given. But his belief was that if you just bought enough cheap companies, the winners would totally overwhelm the losers. He wasn't trying to be an expert on any single business, he was just playing the odds on a massive scale. And this is where Buffett eventually had his big aha moment, where he really started to move away from his mentor's thinking. I mean, think about it. Imagine you're the zookeeper for 100 different animals. Can you honestly give each one the specialized care and deep attention it really needs? Or are you just constantly running around, making sure they're all fed and nobody's escaped? Buffett felt this zoo approach made it impossible to get the deep knowledge you need to make truly incredible, life-changing investments. So here it is in a nutshell. On one side, you've got Graham's zoo. Tons of diversification, hundreds of stocks, and really it's all about hedging against what you don't know. And on the other side, you've got the philosophy of Philip Fisher and Charlie Munger, the guys who really pulled Buffett in a totally new direction. Theirs is the few. It's a concentrated portfolio, just a small number of carefully picked businesses, and it's built not on statistics, but on a deep, almost obsessive level of understanding.
Philip Fisher was especially tough on what he called over-diversification. He basically argued that by trying to watch too many baskets, there's no way you can keep a close eye on all your eggs. You can't. So you end up owning a bunch of stuff you know almost nothing about, which he would say is the real definition of risk. Fisher thought the whole idea was so popular for one simple reason. It was an easy thing for any stockbroker to sell.
And this brings us right to the heart of the argument for concentration. Look, this is not about being reckless or gambling your money away. It's about completely changing your definition of what risk even is. The radical idea here is that true safety, it doesn't come from spreading your bets all over the place. It comes from profoundly, deeply understanding the few, carefully chosen bets you decide to make.
So what do we really mean when we say a concentrated portfolio? Well, it's a small collection of investments, and that's on purpose. But the magic isn't just in the small number. It's in those other words, truly understands and long period of time. This isn't about jumping on trends or chasing the hot tip of the week, no. It's about becoming a genuine, world-class expert in a few exceptional businesses and then committing to them for the long haul. And here's the really powerful psychological shift that happens when you think this way. If you know you can only make a few big moves in your life, you stop treating them casually. Every single choice to invest your money becomes a monumental event. You do more research, you think harder, you question every single assumption, and you demand an incredibly high standard for every dollar you put to work. And listen, this isn't just some Buffett idea. The brilliant economist John Maynard Keynes, who, by the way, was an incredible investor himself, he said the exact same thing decades earlier. He revealed that the vast majority of his own fortune came from just a handful of investments in businesses he knew inside and out. So this idea, it has a deep and proven history with some of the best minds out there. And here's another legend, the famed speculator and presidential advisor Bernard Baruch, just hammering home the exact same point. He frames it as a simple, undeniable fact of being human. I mean, you can become a world-class expert on a few things, right? But it's physically and mentally impossible to be an expert on everything. In investing, just like in life, spreading yourself too thin is pretty much a guarantee of being mediocre. And it's worth pointing out, this was not just a theory for Baruch. His philosophy of focused knowledge paid off, big time. He didn't just talk the talk, he walked the walk. His immense, long-lived wealth was a direct result of the real-world power of concentrated, knowledgeable investing. Okay, so this is the crucial, counterintuitive twist. Buffett sees concentration not as adding risk, but as the ultimate way to get rid of it. So how is that even possible? Well, first, you commit to focus. Second, you set an impossibly high bar. Only truly exceptional businesses even get a look. Third, you're absolutely ruthless about the price you're willing to pay. And maybe most important of all, the sheer seriousness and the tough thinking this approach forces on you, that's what systematically strips the risk right out of the equation. All right, let's take this whole idea out of the world of billionaire investors for a second and make it real. Let's make it personal. How can we actually apply this powerful way of thinking to our own lives and our own big decisions, whether they're about money or anything else? 10. That's it. It feels small, doesn't it? Almost painfully small. It's a number that just forces you to stop and think. But as we're about to see, inside that tight limit lies an incredible clarifying power. This is Buffett's famous thought experiment. So I want you to imagine this. At birth, you get a punch card with only 10 spots on it. Every time you make a big investment, you gotta punch a hole. Once all 10 are punched, that's it, you're done. No more for the rest of your life. How would that completely change the way you behave? I mean, of course you would. You'd treat every single decision like it was the most important one of your life. Because, well, it would be. In investing, you can stand at the plate and watch thousands of pitches go by, and there's no penalty. But with only 10 punches on your card, you wouldn't swing at every mediocre opportunity. You'd wait patiently for that one perfect, slow pitch right down the middle, the one you know, with every fiber of your being, you can hit out of the park. This thought experiment really shines a light on a strange, kind of irrational disconnect in how we all act sometimes. Think about it. If your neighbor asked you for 10 grand to invest in their new local restaurant, you would spend weeks grilling them. You'd want to see the business plan, taste the food, meet the chef, the whole shebang. But then some expert on TV mentions a hot stock in a field you know nothing about, and that same money can just fly out the door with barely a question asked. Why do we have that double standard? So when it all comes down to it, the core lesson here is a complete redefinition of risk. True financial safety doesn't come from owning a tiny piece of everything. It comes from knowing everything about the few great things you choose to own. Your greatest assets aren't some complex algorithm or secret tip. They are patience, focus, and the discipline to treat every major decision with the immense gravity it actually deserves. So I'll leave you with this final thought, because this idea goes way beyond any stock portfolio. Think about your career, your most important relationships, the skills you're trying to learn. Where are you concentrating your precious time and energy to build real mastery and deep, lasting value? And where are you just diversifying, spreading yourself thin as a hedge against the hard work of truly choosing and committing? It's a powerful question, and the answer might just change how you approach everything. Thanks for joining me. All right, let's jump right in. We're going to tackle what is, without a doubt, one of the toughest questions every single one of us investors has to face. I don't care if you're just starting out or you've been doing this for decades. When is the right time to sell? It sounds so simple, right? But honestly, getting this one thing right, well, that's the difference between making a decent profit and building truly life-changing wealth. I'm sure you've heard this old saying from Wall Street. No one ever went broke by selling at a profit. And you know what? It's comforting. It really is. It feels safe. It feels prudent. You're locking in your gains, protecting what you've made. You live to fight another day. It just makes sense on a gut level. But, and this is a big but, as someone like Warren Buffett would probably ask, yeah, you won't go broke, but will it make you super rich? And that, right there, is the billion-dollar question, isn't it?
It gets right to the heart of what we're talking about today. Because while you're not going to lose your shirt taking a nice, handsome profit, you're also probably never going to get outrageously, fantastically wealthy that way either. And that's the central tension we're going to dig into.
Okay, so here's our game plan. We'll start with the selling dilemma itself and look at Benjamin Graham's original rule. Then we're going to poke some holes in it and see where the formula breaks down. From there, we'll see how Buffett and Munger completely evolved the idea. We'll talk about ignoring all that market noise, and finally we'll wrap up with what I like to call the outrageous profit mindset.
All right, let's dive in. To really understand where Buffett ended up, you have to understand where he started, and that means going back to his mentor, the granddaddy of value investing himself, Benjamin Graham. Graham's whole approach was super logical, very disciplined, and it was all built around one single, powerful idea.
And that core concept is what's called intrinsic value. Now, for Graham, this wasn't some fuzzy, vague feeling about a company. Nope. It was a hard number you could actually calculate. It was the real underlying value of the business, totally separate from whatever crazy price the market was slapping on it that day. The stock price could be all over the place, but intrinsic value, that was your anchor to reality.
So Graham's rule for selling, it was beautifully, elegantly simple. Let's say you do the math and figure out a company's true worth, its intrinsic value, is $30 a share, and you manage to buy it for 15. According to Graham, the moment that stock price hits 30, you sell. That's it. Why? Well, in his mind, once the price matches the real value, all the easy profit has been made. The upside is gone. Time to cash in your chips and go find the next deal. But, and this is really interesting, there's a mathematical problem hiding inside this strategy. Just look at these numbers. So, you buy a stock, hoping for a 50% gain, right? If that happens in just 1 year, amazing! You've made a 50% annual return. But what if it takes 2 years? Well, now your annual return drops to about 22%. What if it takes 5 years? You're down to just over 8%. The longer it takes for the stock to reach its true value, the worse your actual year-over-year return gets. Time is literally eating away at your profits.
Now, Graham was a genius, so of course he had a couple of safety nets for this problem. First, his most famous concept, the margin of safety. The idea was to buy the stock so ridiculously cheap that even if it took a few years to pay off, your return would still be pretty darn good. And second, he had a time limit, a 2-year rule basically. If a stock just sat there doing nothing for 2 or 3 years, he'd sell it, cut it loose and move that money somewhere with more potential.
Okay, so this all sounds pretty solid, right? But this is where the theory crashes into reality. Because a young Warren Buffett, who was a disciple of Graham and using these exact methods, started to notice some very expensive flaws in the system. He began to realize that as smart as the strategy was, it just wasn't going to be the thing that made him truly rich.
So here was the first big problem he ran into. By selling the stocks that hit their target in a couple of years, he was basically getting rid of his decent performers. But what was he left with? The dogs of the portfolio, the companies that were cheap for a reason and just never went up. His portfolio was slowly but surely getting clogged up with these underperforming duds.
And then there was the second flaw, and this one is even sneakier. Every single time he had a win and sold a stock for a profit, guess who came knocking? Yep, the tax man. And he'd take his cut. So the pile of cash Buffett had to go find the next great investment was now smaller. It's like trying to run a race where you have to take a step back every time you make progress. This constant tax bill was a huge, huge drag on the magic of compounding.
This is where everything changes. This is the pivot point in the story. Because thanks to the influence of his partner, the brilliant Charlie Munger, and another investing giant named Philip Fisher, Buffett's whole way of thinking about selling started to morph into something totally radically different.
And here it is, the big idea, the revolutionary concept, in a single sentence. Munger and Fisher basically said, look, if you can find and buy a truly excellent business, not just a statistically cheap one, but a genuinely wonderful company, then the right time to sell it is almost never. This was a complete 180. The entire focus shifted. Instead of buying based on price, like Graham did, the new focus was on business quality. It wasn't just about finding a margin of safety in the numbers. It was about finding great companies, maybe even consumer monopolies, with amazing management teams you could trust. The goal wasn't to constantly be on the hunt for the next thing. It was to buy something incredible and just hold on. I love this quote because it paints such a perfect picture of the new mindset.
Think about your portfolio like it's a garden. The old Graham method was kind of like planting a flower, and the second it bloomed, you'd rip it out of the ground to go find a new spot to plant another seed. The Buffett-Munger philosophy says that's just crazy. You pull the weeds, the businesses that aren't working out, but you let your beautiful flowers, the ones that are growing and bearing fruit, just keep on growing for years, maybe even for decades. You know, once you really adopt this new mindset, thinking like a long-term business owner instead of a stock trader, it has this amazing side effect. It completely changes how you see all the crazy day-to-day noise of the stock market. Suddenly, you're free from that terrible trap of trying to guess what the market's going to do next.
I've seen so many people get stuck in this vicious, self-defeating cycle. It always starts with fear, right? The news starts talking about a crash, so you panic, and you sell a great company. Bam, step one. You've just guaranteed a loss to taxes and fees. Then what happens? Usually, the market keeps going up. And there you are, sitting on the sidelines in cash, just watching everyone else make money. And here's the kicker. Even if you're right and the market does drop, that same fear that made you sell in the first place makes you too terrified to buy back in. It is a no-win game.
You know, the old Wall Street legend Bernard Baruch had a much more direct way of putting it. He said, "Don't try to buy at the bottom and sell at the top. This can't be done except by liars." It doesn't get much clearer than that, does it? It's a fool's errand.
So what's Buffett's answer to all this? He just ignores it. He calls it bear and bull market twaddle. For him, a market crash isn't a signal to sell, it's the exact opposite. It's a giant for sale sign. He sees widespread fear and panic as the best possible opportunity to buy more of the amazing companies he loves, but now at a huge discount. I mean, think about it. When the market absolutely tanked back in 1987, was he selling? No way. He was out there buying $1 billion of Coca-Cola stock.
So as we've walked through this whole evolution of thinking, from Graham's super disciplined selling rules to Buffett's incredible patience, you start to see what it all boils down to. It's a fundamental choice. It's really about deciding what kind of investor you truly want to be and what your ultimate goal really is.
And what's the payoff for this new way of thinking? Well, look at this number, 17%. That's the annual compounding return Buffett got by holding on to great businesses like the Washington Post and Geico through every crash and every boom for more than 20 years. That, right there, is the incredible power of letting your winners run. That's how you build real, serious wealth.
And really, this is what it all comes down to. What game are you playing? Are you investing for a handsome profit? You know, selling for a quick gain, taking your money off the table, a nice short-term win? Or are you investing for an outrageous profit? The kind of profit that only comes from letting your money compound, untouched by taxes, for decades. The kind of wealth that can change your family's future. So the final question you really need to ask yourself is this. Are you in this for a handsome profit or an outrageous one? Because at the end of the day, your answer to that question is going to define your entire strategy, your whole philosophy as an investor. Something to think about. Thanks for joining me. You know, when most people think of Warren Buffett, they get this picture in their head, right? The guy who buys a huge stake in a company like Coca-Cola or American Express and then just holds on to it forever. He's the icon of long-term stock picking. But that's really only one side of the coin. So what happens in between those legendary investments? What does the most famous long-term investor on the planet do with billions and billions of dollars when he looks around and just can't find a single great business to buy at the right price? Well, the answer reveals a whole different side to his genius, a much more pragmatic side. And that's exactly what we're going to dive into. You see, Buffett is famous for his patience, for waiting for what he calls the fat pitch. But he doesn't just let all that cash sit in a checking account collecting dust. No way. He puts that capital to work in 4 other major categories. Think of them as his go-to moves for the big waiting game. So here they are, the 4 main types of investments he uses as, well, let's call them high-yield parking lots for his cash. You've got long-term and medium-term fixed income, short-term cash equivalents, and even some arbitrage plays. Now, I know what you're thinking. Long-term bonds? That doesn't sound like Buffett at all. And you're right, on the surface, it seems to go against everything he preaches. But stick with me, because each one of these plays a crucial role in his grand strategy. Let's be perfectly clear about something. These are not his favorite things to buy. The goal here isn't to find the next See's candies. Not at all. The real goal is to solve a very specific problem. What to do with billions of dollars of idle cash. He's looking for a profitable, but more importantly, a safe place to park that money until one of his real fat pitches comes flying over the plate. All right, let's kick things off with the first one, which is absolutely fascinating because it shows how Buffett applies his core business buying philosophy to something he normally can't stand: long-term bonds. As a rule, Warren Buffett pretty much despises long-term bonds. He thinks the returns are just pitiful, and he's always worried that inflation is just going to chew up their value over the long haul. So for him to even consider buying them, something has to be, well, completely out of whack in the market. And back in 1983, that's exactly what happened. So the market was in an absolute panic over this entity called the Washington Public Power Supply System, or WPPS for short. They had just defaulted on a staggering $2.2 billion in bonds tied to 2 nuclear power plants they'd given up on. And that chaos, that fear, created a massive opportunity because terrified investors started dumping the bonds for WPPS's other 3 projects that were actually perfectly fine. So here's where the Buffett genius kicks in. He didn't look at this like a typical bond trader would. He looked at it like he was buying a business. Just look at the math here. He figured out that to get about $23 million a year in after-tax earnings from a regular company, he'd have to spend around $250 million. But with these discounted WPPS bonds, he could get the exact same $23 million a year, tax-free, by the way, for only $139 million. It was literally the same profit for almost half the price. And this is the key. He came up with what the source material brilliantly calls the sub-theory of the bond as a business. He wasn't just buying a piece of paper with a yield. He was buying a predictable stream of cash flow, the earnings of a business that was on sale for a ridiculously deep discount. What an incredible way to reframe the entire situation. Okay, so let's move on to the next category of these other investments. This is where he finds those more flexible, medium-term solutions for parking huge amounts of money, and often in ways that left Wall Street totally baffled. So in the late 1980s, Buffett starts making a series of investments that had all the analysts on Wall Street just scratching their heads. He was pouring hundreds of millions, even billions, into something called convertible preferred stocks. And honestly, these just didn't look like anything he would normally buy. And the companies themselves? They were even more surprising. We're talking about Champion International, the investment bank Salomon Brothers, even US Air. I mean, by Buffett's own incredibly high standards, these were just average businesses. They didn't have those deep competitive moats or the fantastic economics of his classic home run investments. The mystery just got deeper. Which brings us to the big question, right? Why on earth would the greatest investor of our time, a man who built his entire reputation on buying wonderful companies, deliberately sink billions of dollars into merely average ones? Well, the answer lies in this brilliant little detail that most people completely missed, and it's a total masterclass in finding and exploiting structural advantages that nobody else is paying attention to. Let's really break down the Salomon Brothers deal to see the genius at work here. Okay, so on the surface, the deal looked pretty straightforward. Berkshire Hathaway put up $700 million. In return, they got a special preferred stock that paid out a 9% annual dividend. Now, 9% is a pretty solid return, don't get me wrong, but that's not the whole story. It's not even close. Here's where the magic happens. See, if you or I, as regular individual investors, got that 9% dividend, we'd owe about 31% in taxes on it. That would knock our actual take-home yield down to about 6.2%. But, and this is a huge but, because Berkshire Hathaway is a corporation receiving a dividend from another corporation, it qualified for a massive tax break. Its effective tax rate was only around 14%, and that simple difference boosted its after-tax yield all the way up to 7.7%. So let's put this back into Buffett's favorite language, the language of buying a business. To get that same 7.7% after-tax return from a normal business he might buy, Berkshire would have to find one that was earning a pre-tax return of almost 12%. All of a sudden, this average investment in Salomon Brothers starts to look like a really, really solid business deal. And at the end of the day, that's all it was meant to be. As the source material puts it so perfectly, it was simply a profitable place to park large amounts of capital until something else comes along. It was the ultimate high-yield waiting room. So we've covered his playbook for the long and medium term. But what about the really short term? This brings us to the final two tools in his kit for mastering the art of patience, making sure that every single dollar is ready to be deployed at a moment's notice.
First up, you have the simplest tool in the box, short-term cash equivalents. We're talking things like US government notes. He'll often hold billions this way, and in his own words, he calls it short-term parking. Yeah, it's not very profitable, but it's a heck of a lot better than stuffing the money under a mattress. The whole point here isn't profit. It's about 100% safety and liquidity. He needs to know he can get that cash instantly when a true bargain finally shows up.
The other tool he uses is a bit more specialized, short-term arbitrage. Now, in simple terms, this is basically profiting from announced corporate takeovers. He'll buy the stock of the company being acquired to capture the small but very predictable gap between its current price and the final buyout price. It's a game of picking up nickels, but it's a way to generate small, safe, and really quick returns on cash while he waits for those much bigger home run opportunities. So if we boil all this down, what do we get? You get a really clear philosophy for how to wait productively. First, apply business logic to absolutely everything, even a boring old bond. Second, you have to find those profitable parking spots by exploiting unique advantages, whether it's a market panic or a quirk in the tax code. Third, keep your capital productive. Never, ever let it be truly idle. And finally, the whole reason for all of this is to be 100% ready to swing for the fences when that perfect pitch finally comes your way. And this, I think, is the most important thing to take away from all this. These other investments, the bonds, the preferred stocks, the arbitrage, they aren't a distraction from his core philosophy of buying great businesses. Far from it, they are the enabler of that philosophy. This disciplined, patient, and profitable waiting game is exactly what gives him the financial firepower to act decisively when everyone else is running for the hills. It really makes you think, doesn't it? Maybe Warren Buffett's greatest skill isn't actually his eye for buying the right company. Maybe his true genius lies in how he waits. And that's a powerful question to ask ourselves. Just how patient and how productive are you with your own capital while you wait for your big opportunities to arrive?
So let's ask a really fundamental question. How do you figure out what a business is truly worth? I'm not talking about its stock price on any given Tuesday, but its real, deep down, intrinsic value. You know, this single question basically splits the entire world of finance into two camps. One camp is obsessed with the next few months, while the other is trying to peer years, even decades into the future. In this explainer, we are going to get right into that difference, because really understanding it, well, it can completely change how you think about investing.
All right, here's our game plan. First, we're going to talk about what I call Wall Street's myopia, its short-sightedness. Then, we'll dive into the legendary Benjamin Graham's quest for something real, something tangible. We'll see how Warren Buffett took that idea and just ran with it. After that, we are going to nail down a crystal-clear definition of earning power, and finally, we'll pull it all together and talk about what this means for you in your role as an analyst.
Okay, first up, let's tackle the way things are usually done on Wall Street. It's the standard playbook, right? But as you're about to see, it has some pretty serious limitations when you're trying to figure out what something is worth for the long haul.
Now this slide, this lays it all out on the table. It's the core conflict right here. On one side, you've got Wall Street, and they are laser-focused on the next 4 quarters. That's their entire universe. But on the other side, you've got the school of Graham and Buffett. They're asking a totally different question. They couldn't care less about next quarter. They want to know about the enduring, sustainable profitability of a business for years to come. I mean, it's a night and day difference in perspective, and it leads to completely different decisions.
So you might be asking, why the short-term focus? What's the logic there? Well, if you ask a typical analyst, they'll tell you it's just about being practical. They'll argue that trying to predict a company's earnings more than a year out, well, it's a fool's errand. It's too unreliable. So they just stop. They cap all their serious number crunching at the 12-month mark.
And here's the kicker. Once that 12-month forecast is locked in, the hard math kind of goes out the window. The analysis shifts from spreadsheets and calculations to something a lot fuzzier. It becomes this descriptive, qualitative opinion about the company. And you know, that's exactly where personal bias and that classic herd mentality can sneak right in. And this brings us right to the central problem. And who better to say it than the father of value investing himself, Benjamin Graham? He gets it. He says, look, short-term earnings matter, sure, but then he drops the hammer. You simply cannot build a sound investment case on such a shaky, short-term foundation. It's just not possible.
Okay, so if the conventional way of doing things is flawed, what's the alternative? This is where Benjamin Graham's work becomes so important, so revolutionary. He wasn't just sitting back and criticizing. He was building a whole new framework for thinking about value.
Graham came along and asked a question that, honestly, it changed the game. He basically asked, is there a way we can figure out what a business is actually worth, completely separate from the crazy, emotional, up-and-down noise of the stock market?
And here's his answer. He argued that the mark of a true professional, a dependable analyst, is the ability to calculate some kind of objective value, something real, something you can hold in your hand and compare the market price against, so you can say with confidence, yeah, this is cheap, or no way, that's way too expensive.
So this idea of objective value is absolutely crucial. What does he mean by that? Well, for Graham, it has nothing to do with next quarter's earnings report. It's all about what the business can reliably earn over a much longer stretch of time. This indicative, long-term earning power, that is the bedrock of his whole philosophy. If you can get this right, then what the stock market does day to day, it just becomes background noise. Now, a powerful philosophy is one thing, but turning it into a repeatable, world-beating strategy, that's another thing entirely. You see, Graham laid the foundation. He drew the blueprint, but it was his star student, a guy you might have heard of named Warren Buffett, who came along and built the skyscraper.
See, Buffett wasn't just a copycat. He was an innovator. He took Graham's core principle, find that objective value, and then he added his own genius to it. He developed this super rigorous set of criteria to pinpoint the specific kinds of businesses where you could actually predict that long-term earning power with some confidence. He figured out how to do what Graham said what to do. And the result of this? Wow. It gave him an incredible edge. It was like he had a pair of glasses that let him see a dimension of value that the typical, short-sighted analyst on Wall Street was completely blind to. He was playing a different game entirely. All right, we've been throwing this term around a lot, earning power. It is the absolute heart of this whole approach. So let's just pause for a second and really nail down exactly what we mean when we say that. Let's define what we're trying to find.
Okay, here it is, and I want you to pay close attention to two words here, ascertainable and predictable. That's the whole game. The goal isn't to be a psychic and guess the future of just any company. No. The goal is to find those few, special businesses whose fundamental economics make their future a lot easier to figure out. We're looking for predictability over many years, not just the next one.
But here's the thing. This isn't just about having a good feeling about a company. Ascertaining that earning power, it requires real work. It means rolling up your sleeves and using a specific set of tools. You're not just looking at one number. You're using a whole toolkit of calculations to really understand the economic engine of the business. You're asking tough questions with math to get the answers.
And the whole point of doing all that math is to cut through the hype, the stories, and all the noise you see on the financial news. These calculations, they're designed to give you a clear, cold, sober picture of the company's real economic situation. They help you figure out a reasonable range of what it might earn, which then lets you estimate your potential return. And maybe most importantly, this whole process works like a filter. If the numbers are a mess and no clear picture emerges, that tells you something crucial. This company's future is probably too murky to bet on, so you move on.
So, we've journeyed through these two competing philosophies, Wall Street versus the value investors, and we've defined our most important term. So, let's bring it all home. What on earth does all this mean for you, sitting there, as an analyst, as an investor? If you decide to go down this path, what's your actual job description? I'll tell you what it's not. It's not about predicting where the S&P 500 will be next month. It's something much deeper, much more fundamental than that.
Here it is. This is your mandate, plain and simple. First, your job is to be a business detective. You're out there hunting for those rare companies with durable, long-term earning power. Second, you have to do the work. Do the math to calculate the potential return. Third, you've got to dig deeper and understand why the numbers are what they are, the real economics of the business. And finally, after all that work, you simply decide, is that return good enough for my money? Yes or no? You know, at the end of the day, everything we've just talked about, it really boils down to this one final question. It's a question you have to ask yourself, and it forces you to choose your philosophy, to pick your team. Your answer is going to define the kind of analyst, the kind of investor you're going to be. So, what is it? Are you analyzing for the next quarter or for the next decade? All right, when you think about investing, what's the first thing that pops into your head? For a lot of people, it's probably spreadsheets, right? Complex formulas, calculators just working overtime.
It really feels like this whole world is dominated by pure mathematics. But here's a thought. What if the most important tools in your investment kit aren't mathematical at all?
I mean, it's a pretty natural assumption to make, isn't it? That if you could just get the formulas right, if you could just master the math, you could master the market. But the truth? Well, the truth is a whole lot more nuanced, and honestly, a lot more interesting than that. The numbers, you see, they only ever tell you part of the story.
And this quote, this gets right to the absolute heart of it. It's telling us that the real work, the foundational analysis that's going to determine whether you win or lose, that all happens long before you even think about plugging a single number into a formula. It's all about understanding, not just calculating.
So, in this explainer, we're going to really break down this idea that investing is purely a math problem. We'll kick things off with what I'm calling the math myth. Then, we'll get into why you have to put the business first and the numbers later. We'll talk about the crucial management test. Then we've got a fantastic story about the Coca-Cola comeback. And finally, we'll pull it all together and redefine what your most valuable investment tools really are.
Okay, first things first. Let's put math in its proper place. The actual calculations you need to do to value a business are, believe it or not, pretty simple. They're the final step in a long process. They're a tool you use to confirm a price, not to determine the quality of the business itself. Thinking that math comes first, that is one of the biggest and most common traps an investor can fall into.
And that brings us right to our next point. Before you do any calculations, you have to answer a really fundamental question. What kind of business am I actually looking at here? And I'm not talking about its stock price. I'm talking about its soul. What does it sell? Who are its customers? And how does it defend its turf in the marketplace? You know, the whole goal of digging into the business is to figure out one thing: the predictability of its future earnings. Can you, with a reasonable amount of confidence, actually see this company making good money 5, 10, maybe even 20 years from now? Because if you can't, then any mathematical valuation you try to do is basically just a guess, a shot in the dark.
Now this slide breaks it down perfectly. You've basically got two kinds of businesses you're going to encounter. On one side, you have the consumer monopoly. Think of a brand so powerful you'll pay a premium for it without a second thought. It's got those predictable earnings and a strong defense, what we call an economic moat. And then on the other side, you've got the commodity-type business. Here, it's a dogfight. Price is everything. Competition is absolutely brutal. And the long-term results, well, they're pretty much doomed to be just average. Your first job is to figure out which of these two you're looking at.
So let's say you've done your homework. You've found what looks like a great business. You're not done yet. The next crucial, non-mathematical step is to look at who's on the bridge. Who is steering this ship? The quality of the management team can literally be the difference between a good business and a great investment. And when you're evaluating them, it really just comes down to these three things. First, are they honest and are they competent? It sounds so basic, I know, but it is absolutely vital. Second, are they working for the shareholders, for you, the owners, or are they just working for themselves? You have to see that their interests are aligned with yours. And third, and this is a big one, are they smart about how they reinvest the company's profits?
This is such a critical point to understand. A truly fantastic business, a consumer monopoly, it can actually survive mediocre management. But, and this is a huge but, for you, the investor, to actually profit from that business, you need leadership that is actively working to increase the value of your shares. Poor management can just let a great business sit there, treading water, going absolutely nowhere for years on end.
And there is no better example of this principle in action than the story of Coca-Cola. It's just a perfect case study of how a simple change in leadership can unlock the massive, dormant potential of a world-class business. So all through the 1970s, Coca-Cola was this undisputed consumer monopoly. Everybody knew it. Yet the business was just sort of drifting along. The management at the time seemed really unsure of how to grow its value for shareholders. Then, boom, 1980. A man named Roberto Goizueta takes the helm, and he immediately starts making these smart, decisive moves, what the source material calls running for touchdown after touchdown, and every single one of them was aimed at boosting per-share earnings. And the result was just dramatic. You can see it right here. The business itself was always great, but the performance of the investment, what you as an owner would have experienced, it completely transformed under new leadership. It's like the engine was always there, this massive V8, but Goizueta was the one who finally put his foot on the gas. And this right here brilliantly illustrates the outcome. When you combine a fantastic business with truly shareholder-focused management, the financial results can be explosive. The underlying value that was always there was finally unlocked, and the stock price followed in a huge way. Notice something? The math didn't change the business, the management did.
So, this brings us all the way back to our central idea. If the most important factors are the nature of the business and the quality of its management, then your most powerful tools, well, they aren't on your calculator. They're a series of questions, a qualitative checklist you have to go through first.
This is your real work. This is the heavy lifting. Before you ever get to the question, what's the price? You have to be able to answer these questions. Is it a great business or is it just average? Are its earnings predictable? And is it being run by honest, competent people who are on my side? And that's the final piece of the puzzle. This qualitative analysis, that's what tells you what it is you're buying. It determines the intrinsic quality, the real value of the asset. The math, the calculator, that just comes in at the very, very end to help you figure out if the price tag on offer today is a fair deal for that quality. So I'll just leave you with this thought to chew on. The numbers, they feel safe, don't they? They feel certain. But the real foundation of a great investment is built on understanding the business and its people. So the next time you're tempted to jump straight into that spreadsheet, just pause for a second. Take a step back and ask the more important questions first.
You know, what if I told you that there's a super simple, 30-second test that some of the greatest investors in the world use to just toss out maybe 90% of companies right off the bat? It's their first move, their most critical filter. And the best part? No complicated math, no spreadsheets. Just a knack for spotting a simple pattern. Today, we're going to break that exact test down. All right, to really get a feel for this, let's put it into practice. We're going to start with a really simple choice. I want you to imagine you're the investor here. All the noise, all the headlines, it's all gone. All you have is one clean, straightforward decision to make. So here's the deal. You have to pick one of two companies to invest in. But here's the catch. The only thing you get to see is their earnings history. That's it, just a list of numbers. Based only on that, which one do you choose? Which one gets your hard-earned money? Think about it for a second. What would you look for? Okay, let's look at the numbers. Here they are, side by side. On the left, you've got Company I. Just look at that trend. It's beautiful, right? It just climbs nice and steady from about $1 up to almost $2.50. Yeah, there's one tiny little dip in there, but overall, it's a smooth ride up. Now, look at Company 2 over on the right. Whoa, it's a totally different beast. It's up, it's down. There's a year where they lost money, then it's back up, and then another loss. I mean, it's just all over the place. Pure chaos. So when you see those two charts, the choice is, well, it's pretty clear, isn't it? I mean, one looks like a nice, calm staircase. The other one looks like a heart attack on a spreadsheet. All right, so if you looked at that and immediately thought, yeah, Company I is the one for me, then congratulations. You've just, without even knowing it, used the exact same first test that the pros use. Your gut was spot on. But the real magic isn't just picking the right one. It's understanding why it was such an easy choice. So what's the secret sauce here? What does Company I have that Company 2 is so clearly missing? It's not just that it made money. It's how it made the money. It's all about the pattern, the story those numbers tell over time. And that, right there, is the heart of this whole thing. Okay, so what we've just been looking at, this core idea, it's really the foundation of this entire way of thinking about investing. And it all comes down to one simple, powerful word: predictability. Let's put a name to it. Earnings predictability. It's the first test an investment has to pass. And all it's doing is asking a really simple question. When you look at the company's past earnings, can you make a decent guess about its future? Or does it just jump around like a wild roller coaster, where you have no idea if the next turn is a huge drop or a loop-the-loop? So let's bring it back to our two companies. Company I, well, it has strong, predictable earnings. You can look at that chart and feel pretty good about where it's headed. You can forecast its future with some level of comfort. But Company I, it's a total mystery, a complete black box. Its past gives you zero confidence about its future. Investing in that company isn't investing, it's just gambling. You know, this idea isn't new. In fact, the father of value investing himself, the guy who taught Warren Buffett almost everything he knows, Benjamin Graham, he had this great saying that just nails this idea. And what he meant by that is, don't make things harder than they need to be. When a trend is staring you right in the face, you don't need to run a bunch of complicated calculations to understand it. That steady, upward climb of company I's earnings, it's obvious. It speaks for itself. But, and this is where the story gets really interesting, even though Buffett was Graham's star pupil, their paths actually split on this very point. It created this fascinating difference in philosophy between the master and the student. See, Graham was what you'd call a cigar butt investor, a deep, deep bargain hunter. He might have looked at our chaotic company too and thought, because this thing is such a mess and everyone hates it, maybe it's selling for dirt cheap. He was willing to sift through the garbage to find a treasure. But Buffett, he changed his thinking over time. The modern Buffett would glance at company two and just toss it aside, instantly. Why? Because if he can't predict its future with confidence, he's just not interested, period. So for the purpose of this first simple test, we are 100% in the Buffett camp. We're following his method. If that earnings history isn't predictable, if it isn't consistent, if it isn't trending up, we're done. We move on. We don't waste another second on it. Okay, enough with the theory. Let's see how this plays out in the real world with a massive, iconic company. We're going to look at how Warren Buffett used this exact test on one of his most legendary investments ever. Yeah, we're talking about Coca-Cola. And believe me, this is not just some textbook exercise. This is a real-world tool that was the foundation for a decision worth billions of dollars. So let's step into his shoes and look at the numbers he would have been looking at. Let's time travel for a second. The date is August 8th, 1994. Warren Buffett is at his desk, and he's about to pull the trigger on buying even more shares of Coke. So what's he looking at? This is the earnings picture he would have been reviewing. And there it is. I mean, look at that. This is the poster child for what we're talking about. Just follow the numbers. Starting back in '83 at 17 cents a share, and then it just marches up. 22 cents, 26, 36. It's like a perfect staircase heading for this guy. There are no big shocks, no scary years where they lost money. It is the absolute definition of a predictable, wonderful business. So by the time he's making that purchase in '94, the earnings for that year are clocking in at around 98 cents. And that number wasn't some wild guess pulled out of thin air. No, it was just the next logical step in this incredibly powerful, decade-long trend that was plain for anyone to see. So what was the verdict? It was a slam dunk. The earnings were consistent, they were strong, and they were growing at a wonderfully steady pace. Coca-Cola didn't just pass the test, it aced it with flying colors. All right, so this is all great, but how do you actually use this? How do you take this incredibly powerful but simple idea and make it a part of your own toolkit? Let's talk about turning this into your personal first filter. Really, you should think of this as the bouncer at the door of your portfolio. Before you waste your time reading analyst reports or getting lost in the weeds on any company, you apply this quick, at-a-glance check. It instantly separates the predictable, understandable businesses from the chaotic, messy ones. It'll save you an unbelievable amount of time and, let's be honest, a lot of headaches. So, let's boil this whole thing down to a simple, 3-step process you can use anytime. Step 1, get the data. Just pull up the last 7, maybe 10 years of per-share earnings. Step 2, look at it. Seriously, just look at the numbers. Is there a clear, consistent trend heading up and to the right? And finally, step 3, make a call. Is this company worth more of your valuable time, or do you just say, nope, and move on to the next one? It's that simple. Look, this test, this filter of predictable earnings, it's the gateway. It's what makes sure you're only spending your brain power on the kinds of high-quality, understandable businesses that are worth analyzing in the first place. It is absolutely the critical first step. Which, of course, leads to the big question. Once a company passes this test, what in the world is step 2? All right, today we're cracking open the playbook of one of the greatest investors of all time, Warren Buffett. We're going to uncover a simple yet incredibly powerful tool he uses to make billion-dollar decisions. This is a test that just cuts right through all the market noise and gets to the very heart of what makes an investment a good one. So just imagine you're about to put your money into a company. What's the very first thing you look at? You know, for a lot of people, it's the brand, maybe the cool new product, or whatever the latest headline is. But for Warren Buffett, a multi-billion-dollar decision often kicks off with a much simpler question. For the price I'm paying, what am I actually getting? Okay, let's dive right into this because every single investor, I don't care if you're managing $100 or $100 million, you face the exact same challenge. what is the right price to pay for a piece of a business? Because if you get this part wrong, well, the rest doesn't really matter, does it? But if you get it right, you're already halfway home. And look, this isn't just some casual observation. This is the bedrock. Warren Buffett and his mentor, the legendary Benjamin Graham, they built their entire investment philosophy on this one deceptively simple idea. It separates disciplined investors from speculators. The price you pay isn't just a factor in your potential profit. It is the single most important factor, period. So, how do you actually figure out if a price is right? How do you put a number on it? Well, Buffett uses this quick little calculation, a test to figure out what he calls the initial rate of return. It's a calculation that gives him an immediate, clear-eyed snapshot of an investment's potential right from the get-go. Let's break that down. The easiest way to think about it is to compare it to buying a bond. When you buy a bond, you know its yield. That's the interest you're going to get in the first year. Well, the initial rate of return is kind of the stock market's version of that. It's your baseline profit on the price you paid, assuming the business just keeps chugging along doing exactly what it did last year. And the best part? The math is so simple. You don't need some crazy complex financial model. All you need are two numbers that you can find for pretty much any public company. It's earnings per share, that's just the company's profit divided by all its shares, and the current price for one of those shares. That's it. Okay, now for the fun part. Let's move this from theory to reality, because this isn't just some textbook formula. It's a real tool that Buffett has used for decades. Let's actually look at how he applied this very test to some of his most famous investments. So let's hop in the time machine. We're going back to 1979. Buffett is looking at a media company called Capital Cities. It's a business he knew inside and out. The stock was trading for $3.80 a share, and for that year, the company was earning 46 cents for every single one of those shares. So he does the quick math, 46 cents in earnings divided by that $3.80 price, and boom, the result? A very, very attractive initial rate of return of over 12%. I mean, to him, that's like finding a bond yielding 12% in the stock market. An absolutely fantastic starting point. Okay, now let's jump forward a bit to 1988 and to one of his most iconic investments ever, Coca-Cola. He paid $5.22 a share, and at the time, Coke was earning 36 cents per share. He runs the exact same simple calculation, 36 cents divided by that $5.22 price. The numbers told him his initial return would be just under 7%. Now, sure, that's a lower starting yield than Capital Cities, but for a global powerhouse like Coke, that was still a very solid number. Now, let's fast forward just 6 years, to 1994. Buffett is buying more Coca-Cola stock. But look at what happened to the price. The rest of the world had caught on to Coke's greatness, and the price had shot up to almost $22 a share. Now, to be fair, the earnings had also grown nicely, up to 98 cents per share. He runs the calculation again. But because that price was so much higher, his initial rate of return on this new purchase dropped a lot, all the way down to just 4.5%. The business was better than ever, but the price tag was much, much higher. And when you lay it all out like this in a table, the pattern just jumps right out at you. For Capital Cities, a low price gave him a high initial return. For Coke back in '88, a moderate price gave a moderate return. And for that same exact company, Coke, in '94, a much higher price gave him a much lower initial return. It's a perfect real-world example of that inverse relationship between price and return. So this is the big question, right? Why on earth would he buy more? If that initial return was all the way down at 4.5%, why was that still a brilliant move? This is where you realize the initial return test is really just part one of a two-part story. And this is where Buffett's genius really shines through. See, he doesn't view a great stock like a typical bond, which just pays you the same fixed coupon year in, year out. No, he sees it as what he calls an equity bond. It's a special kind of bond where the payout, the earnings, is designed to grow over time. He paired that 4.5% initial return with another crucial number. Back in 1994, Coca-Cola's earnings were projected to grow at a massive 17 to 19% a year. So he wasn't just buying a 4.5% yield. He was buying a 4.5% yield that was about to get a huge raise every single year. So you see, his effective return wasn't fixed at all. That 4.5% was never the whole story. It was just the launch pad. As Coke's earnings grew by 17, 18, 19%, his return on his original investment would just explode and compound year after year. That is the secret ingredient. And this brings us right back full circle to the single most important lesson from Benjamin Graham and Warren Buffett. It's the law that governs everything we've just talked about. It's the fundamental law of price and return. Just let that sink in for a second. It is so simple, but it is so profound. The lower the price you pay for a stream of earnings, the higher your return is going to be. And the higher the price you pay for that exact same stream of earnings, the lower your return is going to be. It is an unbreakable law of investing. And you know, the best part is, this isn't some secret formula reserved for billionaires. It's a practical, simple lens that you can now use to evaluate any investment for yourself. So the next time you look at a stock price, don't just see a number. See it in relation to what that business actually earns. Now that you have this tool, how are you going to look at prices differently? Welcome to The Explainer. You know, with all the noise in the market every day, it's easy to get lost. So today, we're going to cut right through it. We're going to unlock a really simple but incredibly powerful calculation that the best investors use to find what really drives a stock's value over the long haul. A company's true compounded growth rate. So, how are we going to tackle this? Well, first, we're going to get a solid grasp on the core idea, why this one metric is so darn important. Then, I'm going to introduce you to something called the 10 and 5 test. Don't worry, we'll break down the math step by step, and then we'll put it to the test with a couple of famous companies. You're going to want to stick around because by the end of this, you'll have a brand new lens for looking at any business. All right, let's start at the beginning. Before we even think about touching a calculator, we have to understand the why behind all of this. What's the big idea that makes this whole thing work? Well, it all boils down to one thing: a company's earnings on a per-share basis. This sentence right here is basically the whole game. A management team has one primary job: to take the company's profits, the money that isn't paid out in dividends, and reinvest that cash to make the business even more profitable for each and every share. That's it. That's how real long-term value is actually built. And here is the magic link. A company that can consistently grow its earnings per share is essentially building a powerful magnet. Now, the stock price might bounce around day to day, but over the long run, it's going to get pulled up by the sheer force of those growing earnings. It is the fundamental engine that creates wealth for shareholders. Okay, so we're all on board. Growing per-share earnings is the goal. But how do we measure it? I mean, really measure it. How can we tell if a company is a true compounding machine or if it just got lucky for a year or two? Well, that's where this elegant little tool called the 10 and 5-year test comes into play. Now, the key word here is compounded. This isn't just a simple average. This test calculates how the growth builds on itself year after year after year. It gives you a peek into the true horsepower of a company's earnings engine. And this is just brilliant because we don't look at just one number. The 10-year rate gives us the big picture, right? It's the 30,000-foot view. Is this a business with a long, steady track record? Then the 5-year rate lets us zoom right in. What's been happening lately? Is that growth speeding up or is it slowing down? It tells us if the recent storyline lines up with the long-term one. All right, let's pop the hood and see how this thing actually works. Now, you might be thinking this is going to involve some crazy complex spreadsheet, but it's actually incredibly simple if you have a basic financial calculator. Let me show you the inputs. That's it. It's really just these 4 steps. You're basically telling the calculator 3 things: where the earnings started, where they ended up, and how long it took to get there. Then you just ask it to solve for the annual growth rate. Let's make sure we're crystal clear on what these terms mean. So, present value or PV is easy. Just think of it as your starting line. For the 10-year test, this is the per-share earnings from 10 years ago. It's our baseline. And if PV is the starting line, then future value or FV is the finish line. This is the per-share earnings from the most recent year you're looking at. It shows you exactly how far the company has come. And finally, N is just the length of the race. It's the number of years it took for the company's earnings to get from that present value to the future value. For us, it's just going to be 10 or 5. Simple as that. Okay, theory is great, but let's see this thing in the wild. Let's put this tool into practice. We're going to hop in the time machine and take a look at the performance of General Foods way back in the 1970s. Here's the raw data we need. It's really simple. We just need 3 numbers to run our full test. The per-share earnings from our start year, 1970, our middle year, 1975, and our end year, 1980. All right, let's do the 10-year test first. So our present value is $2.38 from 1970. Our future value is $5.14 from 1980, and our N, of course, is 10 years. We punch those numbers in, we hit compute, and there it is, 8%. So over that entire decade, General Foods was growing its per-share earnings at a compounded rate of 8% a year. You know, not bad. But hold on, that's only half the story. Now this is where it gets interesting. We run the 5-year test. Our PV is now the 1975 number, $3.02. The FV is still that 1980 number. We run the calculation and whoa, look at that. The 5-year growth rate jumps to 11.2%. So the company's growth wasn't just steady, it actually accelerated in a big way during the back half of the decade. And see, that's the real power of this test. It stops you in your tracks and makes you ask the smart questions. What on earth happened between 1975 and 1980? Did they have a blockbuster new product? Were they buying back a ton of stock? The test doesn't give you the answer, but it shines a giant spotlight on exactly where you need to start digging. It makes you a detective. Okay, let's run the test one more time, but on an absolute giant. We're going to analyze one of the most famous investments of all time, Warren Buffett's huge bet on Coca-Cola. So here's the data for Coke during a really critical decade, from 1984 to 1994. We've got our 3 data points, so let's run the numbers and see what that growth engine looked like. Wow. Okay, the 10-year test shows an annual compounded growth rate of a massive 17.2%. I mean, remember General Foods was at 8%? This is more than double that. And then you look at the most recent 5 years, and the rate actually ticks up to 18.4%. This is what a world-class, high-growth machine looks like when it's firing on all cylinders. So you have to put yourself in Buffett's shoes back in 1994. He wasn't just looking at the stock's initial 4.5% earnings yield. He saw this incredibly powerful, proven engine underneath that was growing at over 17% a year. He knew that 4.5% return wasn't static. It was going to get bigger and bigger and bigger every single year. He was buying a rocket ship. So we've walked through the big idea, the how-to, and we've seen it in action on a couple of real-world examples. Let's just wrap this all up and summarize what this tool really adds to your toolkit. So what's the bottom line? Think of this test as your personal filter. It cuts right through the daily market chatter and gives you a cold, hard number on a company's ability to create value. It shows you its true compounding power. But maybe the most important thing is this. It's not the final answer. It's the starting point that helps you ask much smarter, much more insightful questions.
So this tool is yours now, and I'll leave you with a challenge. Pick a company you're interested in, find its last 10 years of earnings data, and run the 10 and 5 test. Find out for yourself what story the numbers are trying to tell you. Thanks for watching The Explainer.
All right, let's jump right into a fascinating little puzzle for any investor. We're going to explore a really clever way to compare two investments that, on the surface, seem like they're from completely different worlds. A super safe government bond and the stock of a growing company. How do you even start to weigh one against the other? Well, it turns out there's a surprisingly simple tool for that.
So you're faced with this choice, right? On one side, you've got the government bond. It's predictable, it's safe, you know exactly what you're going to get. On the other side, you have company stock, which could potentially shoot for the moon, but, it also comes with a lot more uncertainty. It feels like comparing apples and oranges, so how do you make a rational decision?
Exactly. It's a tale of two very different investments. And to figure it out, we can't just look at them in their own little bubbles. We need some way to build a bridge between their two worlds, a mental model that puts them on the same playing field so we can really see what's what.
That's the heart of it, isn't it? We need a common yardstick. Without some shared unit of measurement, it's like trying to compare how many miles long something is with how many pounds it weighs. It just doesn't compute. We need a financial ruler that can measure both.
And here's the cool part. The yardstick we're going to use is the bond itself. I know, it sounds a little strange, but we're going to use the steady, known return of that government bond as a lens, a way to evaluate the true value of what a company is earning.
Now, the official name for this concept is relative value. But don't let the jargon scare you. It's not about finding some magical, absolute number for a company's worth. It's much simpler. It's just about figuring out a company's value relative to the return you could get risk-free from that government bond.
And this is the entire formula. That's it. It's so beautifully simple. You just take what the company earns for each share of its stock and you divide it by the interest rate on the bond. What pops out is what we're calling the relative value. This little equation is the key to everything. So let's put it to the test with a real-world example.
Okay, we're going to hop in the time machine and go all the way back to 1979. We're going to look at an investment in a company called Capital Cities, which gives us a perfect, real-life case study to see this bond yardstick in action.
First thing we need is the first piece of our formula, the company's earnings. So back in 1979, Capital Cities was earning 47 cents for every single share of its stock. That's our starting point, the actual profit the business was cranking out.
Next, we need our yardstick. At that time, if you bought a long-term government bond, you could get a return of about 10%. That was the safe bet. You could hand your money to the government and be pretty darn sure you were getting a 10% return year after year.
All right, let's do the math. It's pretty straightforward. We take the company's 47 cents in earnings per share and we divide that by the 10% bond rate. Remember, to do the math, we write 10% as a decimal 0.10.
And what do we get? $4.70. So this number, $4.70, is the relative value of one share of Capital City stock when you measure it against that 10% government bond. But what does that actually mean?
This is the key insight right here. It means that if you paid exactly $4.70 for a share of that stock, the 47 cents in earnings it produced would give you a 10% return on your money. It would be perfectly equal to the bond. That $4.70 price is our break-even point.
Okay, so our calculation gives us a value of $4.70. Now for the interesting part. Back in 1979, what was the stock actually trading for on the open market? Well, it was bouncing around somewhere between $3.60 and $4.70 a share. And that, right there, is where things get very interesting.
And that's the light bulb moment, because you could actually buy the stock for less than its relative value of $470. Your return was going to be higher than the 10% from the bond. Think about it. You're still getting that same 47 cents of earnings, but you paid less to get it. That's a better deal.
So already, the stock is looking like the smarter move. But honestly, we've left out the single most powerful factor in this whole comparison. There's a secret ingredient that just blows this thing wide open. And that ingredient is growth.
Let's just pretend for a second. Let's say you did buy the stock at exactly $4.70, so your starting yield was exactly 10%, just like the bond. Does that mean it's a toss-up? That the two investments are basically the same? Oh, not even close. Because here's that secret ingredient I was talking about. You see, Capital Cities wasn't just sitting still. For the past decade, it had been growing its earnings per share at a staggering clip, 21% per year. That 47 cents of earnings wasn't a fixed number at all. It was on a rocket ship.
This quote from the source material just frames the whole decision perfectly. I mean, what would you rather have? A bond that pays you a flat, static 10% that will never ever change? Or something that starts at a return of 10%, or even better, and whose underlying earnings engine is growing by more than 20% every single year?
When you lay it out on the table like this, it's not even a contest, is it? The government bond gives you 10%, and that's it. It's static. The stock, which the source cleverly calls an equity bond, gives you 10% plus a massive 21% annual growth kicker. When you see it this way, the choice is pretty obvious. Now, before you get too excited and start plugging numbers into this formula for every stock you can find, we've got to pump the brakes. We need to talk about some really important warnings. This tool is powerful for sure, but you have to understand its limitations.
There are two huge things you have to remember. First, what we found is the relative value, not the intrinsic value. All we did was measure the company against the bond rate at that specific time. We didn't determine its fundamental standalone worth. And second, and this one is a biggie, you've got to think about taxes. Here's the catch. That 10% return you get from a government bond, that's before you pay your personal income tax on it. But a company's earnings, that 47 cents we used, is what's left over after the corporation has already paid its taxes. So you see the problem? You're comparing a pre-tax number with an after-tax number.
And the source material really doesn't pull any punches here. It says that trying to compare these two without accounting for that tax difference is, and I quote, fraught with folly.
That's a pretty serious warning that this is not a perfectly precise apples-to-apples comparison.
But look, even with those big warnings, it absolutely does not mean this idea is useless. Not at all. As a quick mental model, as a way to frame the question and understand the relationship between stocks and bonds, the source puts it perfectly. It's an incredibly valuable method to have in your box of tools.
So I'll leave you with this final thought. We used a government bond as our yardstick to measure a stock. But this whole concept, this idea of using a stable, known thing to measure a more complex, uncertain thing, you can apply that almost anywhere. What else in your world could be a yardstick to help you measure relative value? It's a powerful way of thinking that goes way beyond just stocks and bonds. Thanks for joining me.
So how does Warren Buffett do it? How does he consistently pick these amazing companies that just seem to win decade after decade? You've probably wondered that yourself. Well, it turns out that a massive part of his secret isn't some crazy complex formula. It's actually a pretty simple but really profound shift in how we look at a stock in the first place. Let's dig in.
And this one idea, it just changes everything. See, most of us look at a stock and we see a ticker symbol, a price that bounces around all day. But Buffett, he sees something totally different. He sees it like a special kind of bond, what he calls an equity/bond. And the interest rate on this bond isn't fixed. No, the interest you get is actually the company's profitability. So, what is this all-important interest rate he's looking for?
That interest rate is what we call return on equity, or ROE. And don't let the name intimidate you. It's actually super simple. It's just a number that tells you how much profit a company squeezes out from the money that shareholders, like you, have invested in it. Basically, it shows you how good the managers are at taking a dollar of your money and turning it into more money. This one number, this is the engine that Buffett is looking for.
To really see just how powerful this is, let's look at a tale of two companies. Now, on the surface, they look practically identical, and you'd think the choice between them would be pretty simple. But as we're about to see, this one little number, return on equity, is going to send them on two wildly different paths.
Okay, so take a look here. We've got Company A and Company B, and they're identical right down the line. Same assets, same debt, same $6 million in shareholder equity. But here's where it all changes. Look at the bottom line. Company A is a rock star, earning almost $2 million in profit. That gives it a fantastic 33% return on equity. Meanwhile, Company B, with the exact same resources, well, it only manages to earn about $480,000 for an ROE of just 8%.
So, in a snapshot, Company A is the clear winner, right? I mean, it's 4 times more profitable with the same amount of capital. It's not even a contest. In a one-year race, it laps Company B. But here's the thing about Buffett's mindset. He's not playing a one-year game. This is just the first inning.
All right, now let's make this personal. I want you to imagine you own both of these companies. You're the boss. At the end of the year, all those profits are sitting there, and you've got a really important decision to make, a decision that's going to shape your whole financial future.
So what's the play? Do you take that cash out as a dividend, stick it in your pocket or invest it somewhere else? Or do you trust the management team to put that money right back into the business to grow it even more? The answer to that question comes right back to that ROE number we just saw.
It all comes down to this. If you let Company A keep your profits, you know its top-notch management team is going to go out and earn a massive 33% return on that new money for you. But if you let Company B keep the profits, you're basically saying, yeah, an 8% return is okay with me. So the choice becomes incredibly obvious, doesn't it? With Company A, you're practically yelling, yes, keep it, go, make me rich. A 33% return is just phenomenal. But with Company B, you'd probably say, you know what? Thank you, but I'll just take my cash now. You'd pull that money out because you're confident you could find a better place to invest it yourself. And that right there is the essence of smart capital allocation.
Okay, but this is where we really get to the core of Buffett's genius. He isn't just thinking about next quarter or even next year. He's looking way, way down the road at the 10-year horizon. And this is where the real, almost unbelievable magic of a high ROE business starts to happen.
Wall Street is totally obsessed with what's happening in the next 3 months. They live and die by the quarterly earnings report. Buffett, he's playing an entirely different sport. He knows that the real money is made by letting that compounding work its magic over a long, long time. He's trying to figure out what a business can earn a decade from now.
So let's run the numbers. Let's actually see what happens to our two companies if they just keep reinvesting every single penny of profit year after year for a decade.
The results aren't just a little different. They are absolutely staggering. First up, Company A. Just look at these numbers. Because it's compounding its equity at that incredible 33% clip, the growth is it's exponential. That $6 million it started with, by year 11, it explodes to over $103 million. And the earnings, they go from under $2 million to over $34 million a year. That's compounding on steroids.
Okay, now let's switch gears to Company B. Yeah, it's growing, but at the 8% ROE, it's a much slower ride. That same $6 million in starting equity only crawls up to about $13 million after 10 years. And its earnings barely even crack the $1 million mark. It's like they're living on different financial planets.
So, after a decade, what are these companies actually worth? Well, Company B, chugging along, making about $1 million a year, it's worth roughly its equity, about $13 million. Not bad. But Company A? It's now a financial juggernaut, a money-printing machine earning over $34 million a year. It's valued at an unbelievable $428 million. I mean, just look at that chart. It's not even a fair fight anymore.
Now I get it. You might be sitting there thinking, sure, that's a nice theory, the math works out, but does this stuff actually happen in the real world? Oh, you better believe it does. And we've got the perfect example from one of Buffett's most legendary investments.
You see, back in 1988, there was a real-world Company A out there for the taking, and that company was Coca-Cola. With its powerful brand and global reach, it was an economic machine that consistently generated a return on equity, you guessed it, right around that magical 33% mark. Buffett saw that engine, and he knew exactly what it was capable of.
And the results in the real world were just as spectacular. Let's say you spotted what Buffett saw, and you put $100,000 into Coca-Cola stock back in 1988. Then you just went on with your life. You come back just 8 years later, in 1996, and you check your account. That $100,000 investment would have grown to over $900,000. That works out to an annual return of 31% every single year. And that doesn't even include the dividends. This isn't a textbook example. This is the real-world, life-changing wealth creation that happens when you find one of these amazing businesses and just let it do its thing.
So, after seeing all this, what's the big secret? What's the one profound lesson we need to take away from this whole framework that completely changes how we should think about investing? Here it is. It's this idea right here. A truly great business, a truly excellent business, is often a bargain even when it looks expensive on the surface. The quality of the business is so much more important than a superficially cheap price tag.
Let's go back to our amazing Company A for a second, because the math shows something that's just mind-blowing. Even if you paid what seems like a crazy price for it, say 30 or even 40 times its earnings, a price that would make most value investors run screaming for the hills, you still would have made an incredible 18 to 22% annual return over the next 10 years. And why is that? It's because the business grew so darn fast that it just blew right past that supposedly expensive price tag.
And that really leaves us with one final crucial question you have to ask yourself. What game are you really playing? Are you out there hunting for bargains, for stocks that just look cheap based on some simple metric? Or are you searching for excellent businesses, understanding that their real value lies in their power to compound your money over the long haul? That choice, right there, could make all the difference in the world.
Hello, and welcome to The Explainer. What if I told you there's a way to get a solid estimate of a stock's future return without needing a crystal ball? Today, we're going to toss out those super complex, frankly impossible theories and walk through a really practical, step-by-step method that gives you a realistic range of what your investment could actually earn.
But first, let's start with a hard truth. This quote right here says it all. Trying to predict what a company is going to be earning 50 or 100 years from now, it's just a fool's errand. The world changes too much. And that creates this huge problem for a lot of the classic investment models because they are built on that exact shaky foundation. So how do we get around that?
Well, here's our game plan for this explainer. First, we're going to unpack exactly why those long-term predictions are so futile. Then we'll pivot to a much more pragmatic approach. We're actually going to jump in a time machine, go back to 1986, and run the numbers on a real company. Then we'll fast forward 10 years to see how our little projection held up, and finally run the whole calculation again to see what it tells us.
All right, so what really makes forecasting decades into the future such an impossible task?
Well, the answer lies in the classic, kind of textbook definition of what a company is supposed to be worth.
You've probably heard this before. On paper, it makes perfect sense, right? A business is worth all the cash it's ever going to generate for its owners, from now until the end of time. The problem is, this really elegant theory just completely crashes and burns when it hits messy reality, because there's just no way at all, to know what all those future earnings will actually be. Just take a look at this. I mean, this is a perfect example of how even the most unsinkable businesses can get completely turned upside down. Think about it. Back in the 60s and 70s, the big TV networks were invincible. It was a true monopoly. But by the 90s, new technology, a flood of competition from cable, and that whole game had totally changed. And you know, this story is as old as time. It's not a new phenomenon. History is just littered with the ghosts of these once dominant empires whose competitive advantages, their moats, just dried up. It doesn't matter if it's trade routes, banking, or oil. The only thing that's truly constant is change, which makes any 100-year prediction feel like pure fantasy. Okay, so if trying to predict earnings forever is folly, what's the alternative? Well, this brings us to a much more grounded, much more practical approach to figuring out what an investment might actually be worth. And here it is. This is the crucial shift in thinking. We are throwing out the idea of calculating one single, precise, intrinsic value that's based on a century of pure guesswork. Instead, the goal is to project a company's value over a much more reasonable time frame, like, say, 10 years, and then figure out what our annual return would be based on that projection. And this is what's so brilliant about this whole process. It doesn't give you a single theoretical number that you can't really use. No, it gives you something far more useful, an estimated annual rate of return. And that is a powerful figure you can directly compare to other investments, like a safe government bond, to decide if taking on the risk of owning a stock is actually worth the potential reward. Okay, enough theory. Let me show you exactly how this works with a real example. We're going to analyze Berkshire Hathaway way back in 1986. Let's really get into it. So, step one in the process is to project the company's book value. That's its per-share equity, a decade into the future. Now, how do we do that? It's actually pretty straightforward. We're just going to look at its historical growth rate and make a reasonable assumption that that trend is going to continue. Okay, so here are the three key inputs we need. Back in 1986, Berkshire's per-share equity, its present value, was $2,073. Its historical growth rate was an absolutely phenomenal 23.3% per year. And our time horizon, we're setting that for 10 years. And this is where you really see the awesome power of compounding in action. When you plug those three numbers into a financial calculator, it spits out a projection that by 1996, Berkshire's per-share equity should reach a pretty staggering $16,835. Okay, so we have a potential future value. That's great. But what does that mean for us today, back in 1986? Well, this number lets us answer the most critical question for any investor. What price should I be willing to pay for this thing? So, this is the question you really have to ask yourself. If you're an investor and you want to make at least a 15% return on your money every year, which is a pretty common goal, what is the absolute most you can pay today for that future $16,835 of equity? We just work the same calculation, but we do it in reverse. We know the future value. We set our desired return of 15% as our discount rate. The time period is still 10 years, and now we're just solving for the present value. So the math tells us that to lock in that 15% annual return, the absolute most you should have paid for a share of Berkshire in 1986 was $4,161. But here's the kicker. At the time, the market was only asking about $2,700 a share. And that huge gap between what it's worth to you and what the market is asking, that signals a potential opportunity for an even higher return. Okay, now this is where it gets really exciting because we have the benefit of hindsight. So let's jump forward 10 years to 1996 and see how our little decade-old projection actually compares to what happened in reality. The results are, well, they're absolutely fascinating. The company's actual performance was even slightly better than our pretty optimistic projection. But just look at the market price. The stock was trading at $38,000, more than double its underlying book value.
And what this means is that an investor who bought in at $2,700 didn't get a 20% return. They got an incredible 30.2% annual return. And this right here, this is the absolute key takeaway. Your return as an investor is driven by two different engines. First, the business itself has to perform well. That's the equity growth. But second, and just as important, the market sentiment about that business, what other people are willing to pay for it, can have a massive, massive impact on your final result. So now let's turn the tables. Let's put ourselves in the shoes of an investor in 1996, and we're looking at that $38,000 stock price. Let's apply the exact same method to project our potential return over the next 10 years, out to 2006. The fundamental question is exactly the same, but our starting point is now radically different. We're thinking about buying in at that much, much higher price. So what kind of return can we reasonably expect from this point forward? Okay, so if we run the numbers again, we can project a future book value. Now, here's where it gets interesting. If the market in 2006 has kind of cooled off and only pays for that book value, your return is a very respectable 14.72%. However, if that market enthusiasm continues and investors are still willing to pay double the book value, your return could be as high as 23%. And this brings us right to the most important point of this whole explainer. This method doesn't give you a single magic number because, frankly, no method can, but it does something far more valuable. It gives you a realistic, rational range of potential outcomes based on both the business's performance and the market's mood. And having that range, well, that is an incredibly powerful tool for making smarter, more rational investment decisions. You know, what if I told you that one of the single greatest investment moves in history really just came down to some pretty simple math? Today, we're going to decode Warren Buffett's legendary 1988 purchase of Coca-Cola stock. It is a true masterclass in seeing what other people miss. And I promise you, by the end of this, you'll get the exact financial lens he used to spot a multi-billion-dollar opportunity that was just hiding in plain sight. Just get your head around this for a second. From a starting investment of just under $600 million, his piece of the company was on track to be worth over $5 billion in just 12 years. That's not just a good investment. That's the kind of thing that completely changes the definition of what's possible in the market. So the big question is, how on earth does that even happen, right? A nearly tenfold increase in a little over a decade. But this wasn't some lucky shot in the dark. No way. It was the result of a very specific, repeatable way of thinking. And today, we're going to walk through the exact, and you'll see, deceptively simple math that made this whole thing possible. Okay, so to really understand this, we have to kind of step into a time machine. We need to look at the market the way it was back in 1988, using the exact same numbers that Buffett had right in front of him. Because, believe it or not, the key to this whole multi-billion-dollar insight, it all starts with just 4 little pieces of data. And here they are. These are the raw ingredients. An initial investment of $592.5 million at a price of $5.22 per share. Okay, pretty standard stuff so far. But these last 2 numbers, this is where the magic really starts. For every share he bought, he was getting $1.07 of the company's actual net worth, its equity. And that little piece of the business, it was already kicking off 36 cents in profit that year. These are the building blocks for the entire play. And this brings us to the absolute heart of his genius, a mental model that just completely changes the game. See, Buffett didn't look at Coca-Cola as some flickering stock price on a screen. He looked at its equity as if it were a high-quality bond. And the company's earnings, well, that was the bond's annual interest payment. That was its coupon. And man, what an incredible coupon that was. If you take the 36 cents in earnings and you divide it by the $1.07 in equity, you get this really critical number, return on equity, or ROE. For Coke back then, this was a mind-blowing 33.6%. Just let that sink in for a minute. This was like buying a bond that paid you a 33% yield every single year. That's the powerful business engine that Buffett saw churning away under the surface. Now, here's a really important distinction. That 33.6% coupon doesn't just all show up in your bank account as cash. It gets split in 2. One part is paid out to shareholders, that's your dividend. But the other, bigger part is kept by the company to reinvest and grow. And this retained part, that's the secret fuel for the compounding machine. So this is the insight that changes everything.
Look, the dividend is nice, right? It's cash you can spend. But the retained part, that 19.4%, that's the real engine of wealth creation. It's your share of the profits being expertly reinvested for you by one of the best management teams in the world to make your slice of the company bigger and more valuable. And here is the real kicker. You don't pay any immediate personal taxes on that growth. It's basically a tax-deferred compounding machine working for you 24/7. So what happens next? Well, if you know the company's equity is growing at a predictable rate every single year, you can actually start to project the future. You can literally calculate what the business is going to be worth and what it's going to be earning years from now. Let's see how that works. The math here is actually beautiful in its simplicity. You just take the starting equity, that $1.07, you apply the growth rate, that retained yield of 19.4%, and boom, you get your projected equity for the next year, $1.28. It's just straightforward compounding at work. But look what happens when you run that same simple calculation year after year for 12 years. The results are just staggering. Look at this. That initial $1.07 of equity is projected to balloon to nearly $9. And the annual earnings per share, they rocket up from just 36 cents to over $3. This is the explosive power of a high return on equity, just relentlessly compounding over time. Okay, I know what you're probably thinking. Projections are one thing, but reality is something else entirely, right? I mean, anybody can make a spreadsheet look good. So the real test, the only test that matters, is how did this clean little mathematical model actually stack up against the messy, unpredictable real world? And folks, this is what separates a truly great business from just a good one. This is why the model works for companies with what Buffett calls a durable consumer monopoly. The projections weren't just close, they were jaw-droppingly accurate. I mean, for a couple of years there, they were perfect, zero error. Even 8 years out, the model was only off by about 5%. This wasn't a wild guess, it was a reliable forecast of the company's real earning power. So, we've pretty much proven that we can reliably project the future earnings of this business. Now we're at the final piece of the puzzle. How do we translate those future earnings into a concrete annual rate of return on Buffett's initial $5.22 investment? Okay, let's run the final numbers. First things first, every investment calculation needs a time frame. We're going to measure the performance from the initial purchase in 1988 all the way to our final projection year of 2000. So our N, the number of years in our calculation, is 12. Simple enough. Next up, we need our starting point. In finance speak, that's the present value, or PV. But really, it's just what Buffett paid at the very beginning. This is our cost basis. It's the anchor for the entire calculation, $5.22 a share. All right, now we need our endpoint, the future value, or FV. To get this, we take our projected earnings for the year 2000, which we already calculated was going to be about $302. Then we multiply that by a pretty reasonable price-to-earnings ratio of 15. The PE ratio is just what the market is typically willing to pay for $1 of a company's earnings. And historically, 15 is a fairly conservative number, not some wild optimistic guess. That gives us a very sensible future stock price of $45.30. So you plug those three inputs into the calculator. A 12-year journey starting at $5.22 and ending at a projected $45.30, and you solve for the rate of return. And the result? A projected pre-tax annual compounding rate of nearly 20%. Let me say that again. That means, on average, the investment was expected to grow by 19.7% every single year for 12 straight years. Now, of course, you always got to pay the tax man on the dividends you get along the way and the eventual capital gain if you sell. But even after you factor all that in, the projected after-tax return is a phenomenal 17.8% per year. I mean, to put that in perspective, that kind of consistent long-term return absolutely crushes almost any other investment option out there. So let's just zoom out for a second and really lock in on why this works. We've been through all the numbers, but what's the fundamental principle going on here? What is the actual engine that's generating all of this wealth? You know, this quote from the original source material just nails it. The real secret isn't just that Coke makes a great return on its business. The magic, the real secret sauce, is its ability to take a huge chunk of its profits, those retained earnings, and reinvest that new money back into the business to earn that same high rate of return. And all of that happens while you, the shareholder, get to defer paying personal income taxes on that internal growth.
And that brings us right back to where we started, that idea of equity as a bond. When you look at it this way, Buffett didn't just buy a stock. He effectively created a synthetic bond for himself that paid an incredible tax-deferred coupon of 17.8%. It's a type of financial instrument that you simply cannot go out and buy anywhere else. It doesn't exist.
And that really brings us to the most important question this whole analysis leaves us with. The math, as we've seen, is actually the easy part. The real challenge is finding the right kind of company. So what businesses out there today have that same kind of durable competitive advantage, that consumer monopoly that allows them to become a true compounding machine for their owners? Applying this way of thinking, this lens, to the world around you, that is the real takeaway.
All right, today we're going to dive into one of Warren Buffett's most powerful mental models. It's the concept he used to make one of the greatest investments of all time, his big bet on Coca-Cola. And what's so fascinating is that if you just looked at the surface, the deal looked, well, surprisingly average. And look, this isn't just some old story about a stock, right? It's a masterclass in how to see what everyone else misses.
So that's the big question, isn't it? The central puzzle of this whole thing. The initial return on Buffett's investment wasn't just average. I mean, for the world's greatest investor, it looked, well, pretty lame, honestly. So why on earth did he accept a return that most other people would have just walked away from? The answer? Well, it gets right to the very heart of his genius.
So let's put a number on it. The number that makes you kind of scratch your head is this: 6.89%. That was Buffett's initial return on his money. Now, you have to remember, at that time, you could get a similar totally risk-free return from a government bond. So what on earth was Buffett thinking? What did he see that everybody else was missing?
Okay, so how do we even get to that 6.89%? Well, the math is actually super straightforward. Back then, Coca-Cola earned 36 cents for every share, and Buffett paid about $5.22 a share. You just divide the earnings by the price, and there it is, 6.89%. But here's the real kicker. Coca-Cola itself was earning a much, much higher return on its own money. So the question is, why would Buffett willingly accept a lower return than what the company itself was making? It just doesn't seem to add up.
Well, the whole answer, the secret sauce, it lies in this absolutely brilliant mental model he used. You see, Buffett didn't see Coke as just a simple stock. He saw it as a special kind of bond, a bond with a superpower. He called it an equity/bond. So let's really dig into what that means.
Okay, so what in the world is an equity/bond? To get this, you gotta picture those really old-school paper bonds, right? The ones that literally had little coupons you'd clip off with scissors and mail in to get your interest payment. It's a great visual. Buffett took that exact idea and applied it to stocks. For him, a company's earnings, that was the coupon. But, and this is the genius part, with a fantastic company like Coke, that coupon isn't fixed. It's designed to get bigger and bigger every single year.
And right there, that's the night and day difference. Think about it. A regular bond, it's predictable. You know exactly what you're going to get. It's safe, sure, but it's also kind of boring. It never grows. But with this equity/bond idea, man, it's a whole different ballgame. Because the earnings, that coupon, is growing. Your return is compounding. And your original investment, your principal, it grows right along with the business. It's a dynamic, living thing.
Okay, so how does this coupon actually get bigger? It's not some kind of financial wizardry. It's all about the powerful economic engine chugging away inside the company. And for Coca-Cola, back in '88, that engine had two absolutely critical parts, and both were just firing on all cylinders. First up, we've got something called return on equity, or ROE for short. And don't let the name intimidate you. All this means is how good a company is at making money with its own money. That's it. A high ROE just means you've got an incredibly efficient profit machine.
And let me tell you, Coke's machine was an absolute beast. Back in 1988, its ROE was a staggering 33.6%. Now just stop and think about that for a second. For every single dollar of its own capital, the company was churning out almost 34 cents in profit. That is just, it's a world-class economic engine, plain and simple.
Okay, but even the best engine in the world is useless without fuel, right? And that brings us to the second critical piece of the puzzle, retained earnings. Again, simple concept. This is just the slice of the profits the company decides to keep and reinvest in itself, instead of handing it all out to shareholders as a dividend. This cash, this is the high-octane fuel for all that future growth.
And this chart here, it shows you exactly what Coke was doing. I mean, look at this. Sure, they paid out a nice chunk as a dividend to keep shareholders happy, but, and this is the absolute key, they kept the majority, 58% of their profits, to pour right back into the business. They were taking all that fuel and just dumping it right back into that incredible 33.6% ROE engine we just talked about.
All right, so the theory sounds fantastic, doesn't it? A high-return engine, plenty of fuel, but now we get to the really cool part. This is where the magic actually happens, in the math. We're going to walk through the numbers step by step to see exactly how Buffett's coupon started growing right from year one.
And look, the whole process is just a simple three-step loop that repeats over and over. First, you take the profits the company kept and add it to your investment cost. Simple enough. Step 2, you figure out how much new profit that reinvested money is going to generate. And finally, step 3, you calculate your new and hopefully higher rate of return. So let's go ahead and run the numbers from 1989.
All right, stick with me on the math here. It's super important. So in 1988, Coke kept 21 cents for every share. That 21 cents gets tacked on to Buffett's original cost, which brings his new investment base up to $5.43. Now, that 21 cents goes to work inside Coke's incredible profit machine, earning that 33.6% return, and boom, it generates an extra 7 cents in new earnings. You add that to the original 36 cents, and suddenly the total earnings for 1989 have jumped to 43 cents a share.
So what does that do to his return on investment? Well, let's see. We take the new 43 cents in earnings, and we divide it by our new, bigger investment base. And the result is 7.5%. Think about that. In just 1 year, Buffett's return jumped by a full percentage point. This expanding coupon thing isn't just a nice idea. It's happening. We can see it right here in the numbers.
So yeah, the engine is definitely working. But you know, the real mind-blowing power of compounding, that comes from running this loop over and over and over again. So let's do it. Let's roll the clock forward to 1990 and see what happens next.
Okay, here we go again. Round 2. In 1989, Coke keeps another 25 cents. That gets added to the pile from last year. So now, the total amount of retained earnings working for Buffett has grown to 46 cents a share. And remember, that entire amount is now earning that fantastic 33.6% return. That generates another 15 cents in new earnings. Add it all up, and the total earnings for 1990 are now 51 cents per share. You see how it's starting to snowball?
And his new rate of return? You know the drill. We take those 51 cents, divide by the new, even bigger investment base, and what do we get? 8.9%. Do you see what's happening here? It's incredible. The return isn't just growing, it's accelerating. The jumps themselves are getting bigger every single year.
I mean, just look at this chart. This tells the whole story. We go from 6.89% to 7.9% to 8.9%, all in just 2 years. This, right here, is the expanding coupon in action. This is that beautiful, accelerating growth that Buffett could see so clearly, while everybody else was just stuck looking at that one static number from the very beginning.
All right, so let's tie all of this together. What's the ultimate payoff here? What's the big lesson we can all take away from this incredible way of thinking? Okay, here it is. This is the absolute core of the whole idea. The money Buffett put in himself, yeah, that was earning 6.89%. But, and this is everything, every single dollar the company kept and reinvested on his behalf was earning a mind-blowing 33.6%. He was basically getting to piggyback on their much, much better rate of return.
And that, my friends, is the whole key to this mental model. That number that looked kind of low at the start, that 6.89%, that wasn't the real story. It was just the price of admission. It was the ticket he had to buy to get his capital inside Coke's unbelievable internal compounding machine, which would then just work its magic for him for decades to come.
There's a quote from the source material that just sums this up perfectly. You pay a steep price to get in the door, but once you get in, it's bliss. And the longer you stay, the better it gets. I mean, that's just the perfect way to think about long-term investing in truly exceptional businesses.
And so, that really leaves us with one last big question to chew on as we wrap this up. If you take this exact mental model and you apply it to the market today, what companies out there have that high price of admission, but they've got an internal compounding engine inside that's so powerful it could create that same kind of bliss for a patient investor? That is a really powerful question to think about.
Hey there. Have you ever looked at the stock market and just wondered, How in the world do people try to figure out what a stock will be worth, say, 10 years from now? Well, today, we're going to dig into a really powerful method that does just that. It's all about using a company's past earnings growth to project its future, a way to cut through all the daily noise and focus on what really matters. So here's our game plan. First, we'll get a handle on the basic tool we're using for this prediction. Then, we're going to get our hands dirty and actually project a company's future earnings and then estimate its stock price. After that, we'll calculate our potential return on investment. And here's the fun part. We'll compare our projection to what really happened. Finally, we'll talk about the bigger picture, the powerful investor mindset behind this whole approach. All right, let's kick things off with the million-dollar question, one that every single long-term investor has to wrestle with. How do you even begin to estimate what a company might be worth, not just today, but way down the road?
I mean, it sounds kind of impossible, right? The market can feel so chaotic. News breaks, prices jump up and down. With all that craziness, is there any signal, anything stable that an investor can latch onto to guide their decisions? Well, it turns out a huge clue is often just hiding in plain sight, the company's own history. And to show you how this works, we're going to use a real-world example, a company called Capital Cities. We'll look at its performance from 1970 to 1980 and use that data to try and see into its future, all the way to 1990. So where do we start? Well, the very first step is to take that historical performance, that track record, and use it as a kind of springboard to project what the company's earnings might look like 10 years from now. Just look at these numbers. In 1970, Capital Cities was earning a measly 8 cents for every share of its stock. But fast forward a decade to 1980, and that number jumped all the way to 53 cents. Now, that's not just a little bit of growth. That is a serious, powerful trend. And you know what? That growth wasn't just a fluke. If you crunch the numbers, it comes out to a remarkably consistent 20% annual compounding growth rate. Think about that. Every year, on average, its earnings grew by 20%, building on the year before. This number, this 20%, is going to be the engine for our entire projection. It's the key. So the actual calculation is pretty straightforward. First, we take our starting point, those 53 cents in earnings from 1980. Then we decide on our time frame, which is 10 years into the future to 1990. And finally, we just apply that historical 20% growth rate year after year for those 10 years. And voila, here's what we get. If, and this is a big if Capital Cities could keep up that same 20% growth, we could reasonably project that by 1990, it would be earning around $3.28 per share. This right here is our first big milestone. We have a target. Okay, so we have a future earnings number. That's great. But, earnings aren't the stock price. So the next logical step is to figure out how to translate that $3.28 into an actual potential value for the stock itself. And to do that, we need a little tool called the price-to-earnings ratio, or PE ratio. All this is a measure of what the market thinks about a company. It tells us how many dollars investors are willing to pay for every $1 of that company's earnings. A high PE means the market's really excited. A low PE, not so much. Now, looking back at Capital Cities' history, its PE ratio had been all over the map, sometimes as low as 9, sometimes as high as 25. So to be safe, we're going to be conservative. We'll use the low end of that range, a PE of 9. The math from here is easy. We take our projected earnings of $3.28, we multiply by 9, and that gives us a projected future stock price of $29.52. All right, now we get to the fun part, the part that every investor really cares about. We've got a price we might buy at and a price we might sell at in the future. So what does that actually mean for our return on investment? What could we actually earn? And here is the last piece of the puzzle we need. Back in 1980, you or I could have walked into the market and bought shares of Capital Cities for about $5 a pop. That $5 is our starting line. So let's put it all together. You invest $5 in 1980, 10 years later, you sell at our projected price of $29.52. If that all played out, you would have made an annual compounding return of 19.4%. Let me tell you, for a long-term investor, a potential return like that is absolutely fantastic. But, and this is a big but, that was all just a projection. It was a forecast, an educated guess made from back in 1980. The real test, the moment of truth, is what actually happened.
So let's hop in our time machine, jump forward 10 years, and see how our careful little calculation held up against cold, hard reality. And this is where things get really interesting. Check this out. Our earnings projection was a little too high. The company actually earned $2.77 per share, not our projected $3.28. So we were wrong. But then, look at the stock price. Our conservative guess was just under $30. In reality, the stock traded in a range between $38 and $63. So yeah, our projection was wrong, but it was wrong in the best possible way for the investor. So what did that do to our return? We projected a very respectable 19.4% a year. But in the real world, even if you sold at the lowest price in 1990, you would have made 22.4% a year. And if you happened to sell at the high, you'd have walked away with an incredible 28.8% return year after year. The reality absolutely crushed our conservative projection.
So what happened? How did we get a better result with lower earnings? Simple. The market basically fell in love with the company. Investors decided they were willing to pay a much higher PE ratio for those earnings than our safe, conservative guess of 9. That change in market sentiment, that re-rating, completely supercharged the returns. And that brings us to what I think is the most important lesson of this whole thing. This exercise, it's not really about being a math wizard. It's about a fundamental difference in how some of the greatest investors on the planet think about the market itself. So when you look at all this, from the initial guess to the surprising reality, what's the big takeaway here? What's the real lesson this whole process teaches us about being a smart investor? This right here gets to the heart of it. A classic value investor like Benjamin Graham might say, okay, this stock is worth $10. I can buy it today for $5, so I'll buy it and then I'll sell it when it hits 10. But the approach we just walked through is different. It's more like his famous student, Warren Buffett. It's not about finding a single static price target. It's about asking a totally different question. If I pay $5 for this stock today, what is my projected rate of return going to be over the next 10 years? Just think about the mental freedom that gives you. If your whole strategy is waiting for a stock to hit a certain price, you're basically a slave to the daily stock ticker. You're constantly checking. But if you've done the work and calculated an expected long-term return, you can invest with confidence and then just ignore all that daily noise, trusting that the business's value will eventually win out. So I'll leave you with this one question to think about. When you make an investment, are you investing for a specific price target, or are you investing for a satisfactory long-term rate of return? Because figuring out the answer to that, well, it might just change your entire approach to the market. Thanks for tuning in.
All right, let's jump right into a fascinating financial puzzle today, one that stars a company we all know, Coca-Cola. We're going back to the 90s to look at a story where all the projections went haywire. It's about a corporate move that, on the surface, just didn't seem to add up, but in the end, it turned out to be pure economic genius.
So here's where the mystery really starts. Just take a look at these numbers. You've got the projected value of a Coca-Cola share on one side and what it was actually worth on the other. And you can see, year after year, that gap between the forecast and reality just gets wider and wider. By 1993, the projections weren't just a little off, they were wildly off. But here's the thing that's going to make you scratch your head. The one thing that drives all those projections, the company's earnings, was predicted with almost scary accuracy. I mean, look at this, a 0% margin of error for 3 years straight. They were nailing their earnings forecasts. So this just makes the whole thing even weirder, doesn't it?
And that brings us to the big question, right? This is the heart of what we're digging into. If the company was making exactly the money everyone expected it to make, how on earth could the value of each individual share be so far off the mark? What was everyone missing?
Okay, here's our game plan to solve this thing. We are going to uncover the multi-billion-dollar answer. Then we'll look at the simple math behind it, see how the stock market just blows that up into something much bigger, watch how that advantage grows over time, and finally, we'll talk about what it all means for an investor.
So, the answer to our puzzle. It's not some boring accounting mistake or a sudden business slump. Nope. It was something Coca-Cola was doing on purpose. A huge, deliberate financial strategy they had been running for almost 10 years.
And it all comes down to this number, $5.8 billion, with a B. That's what Coca-Cola spent of its own cash between 1984 and 1993. And you know, they didn't spend it on new bottling plants or fancy marketing. They did something else entirely.
So what did they buy for almost $6 billion? themselves. They went out into the market and bought their own stock, 570 million shares of it. And then they basically made them disappear. They retired them. Poof, gone.
And look, this wasn't just nibbling around the edges. We are talking about a 21% reduction in the total number of shares available to the public. That is a fundamental change to the very ownership structure of the company.
This whole move has a name. It's called a stock buyback. And that is the secret weapon. That's the key that unlocks this whole puzzle and tells us exactly why those early projections were so wrong.
Okay, so how in the world does a company buying its own stock make your shares worth more? It sounds a little counterintuitive, but the logic behind it is actually incredibly simple once you see it.
I love this quote. It is the perfect way to think about it. The company's total profit for the year? That's the pie. Every share of stock? That's a slice. By buying back shares, Coke didn't bake a bigger pie. No, they just took a whole bunch of slices off the table. Which means, if you still had a slice, it just got a whole lot bigger.
Let's put some real numbers to that. Using the 1993 data, the total profit, the pie, was about $2.17 billion. Now, if they hadn't done any buybacks, you'd divide that profit by about 3.2 billion shares. That gives you 68 cents of earnings for each share. But in the real world, with the buybacks, you divide that same profit by only 2.6 billion shares, and boom, each share now accounts for 84 cents of earnings. Same pie, bigger slice.
Now, I know what you might be thinking. Okay, an extra 16 cents of earnings. Big deal. But this is where the real magic kicks in, because the stock market doesn't just add 16 cents to the stock price. It takes that number and multiplies it.
It all comes down to a concept called the price-to-earnings ratio, or PE. Think of it as the market's hype meter. In 1993, investors were so confident in Coca-Cola, they were willing to pay $25 for every single dollar the company earned. That PE ratio acts like a giant amplifier. So the market's logic is actually pretty straightforward. You take the earnings per share we just figured out, you multiply it by the market sentiment, that amplifier, the PE of 25, and that's how you get the final price of the stock. And here is the payoff. Look at this. Without the buyback, that 68 cents in earnings translates to a $17 stock. But with the buyback, the 84 cents in earnings gives you a $21 stock. So that little 16-cent bump in earnings didn't create a 16-cent gain. No way. It created a $4 gain. That is the multiplier effect in action. And this is exactly why the source material calls this move economic brilliance. It's not obvious at first glance. Spending billions to get what looks like a tiny bump in per-share earnings might seem inefficient. But once you factor in the way the market amplifies those earnings, you realize it was an incredibly powerful way to generate wealth for shareholders.
But hold on, the story doesn't end in 1993. Because the true power of a stock buyback isn't just a one-time boost. No, it's an advantage that keeps growing and compounding year after year after year. So think about the timeline. They made this decision way back in 1984. By 1993, it had already created a $4 difference in the share price. But what happens if we let this play out even longer, say for another 10 years?
Now let's fast forward a decade to a projection for 2003. Assuming the company keeps growing its earnings, that very same reduction in shares now creates a projected difference of $14.50. The benefit didn't just stick around, it magnified over time because the company's overall pie just kept getting bigger. So all of this leads to a really fundamental question for any company with a pile of extra cash and for any investor who owns a piece of it. What's the best way to return profits to the people who own the company?
Let's lay out the two choices side by side. Option A, Coca-Cola could have taken that $5.8 billion and just paid it out as a cash dividend. After the tax man takes his cut, you might have gotten about $1.25 in your pocket for each share. Or option B, they do what they did. They used the money for a buyback, which created $4 in new value per share. The choice is pretty stark. Less cash in your pocket today or significantly more wealth in your investment account for tomorrow. And that is the powerful question this whole story leaves us with. Now that you've seen the mechanics of the buyback, the market's multiplier effect, the compounding power of time, if you were the shareholder, what would you want the company to do with its extra cash? It really is a choice between immediate cash and long-term value creation. And as the Coca-Cola case shows us, the difference between those two choices can be absolutely enormous.
You ever see one of those headlines, the ones screaming about a company's fantastic earnings, and you just get this feeling in your gut that you're not getting the whole story? Well, today, we're giving you the investor's X-ray. We are going to pull back that curtain and show you exactly how to see the real truth behind a company's performance, way beyond the numbers they want you to see. When a company reports its earnings, this quote right here, this is often the subtext, isn't it? It's this simple, clean statement of success. It's designed to make you feel good and, honestly, to get you to stop asking questions. But the smartest investors out there, they know the real work only begins after that big announcement.
And that really brings us to the main event today, the central illusion we're going to tackle, the earnings per share, or EPS figure. When you see that number pop up, when you see it's gone up, what is actually causing that? I mean, is the company genuinely making more money, or is there something else going on behind the scenes?
This is the fundamental question you have to ask yourself. Is that company's economic engine just firing on all cylinders, truly generating more profit? Or is management just playing with the financial mechanics, a kind of clever accounting, really, just to make the numbers look a whole lot better than they are? Figuring this out is absolutely the key to seeing a company's true health. So let's turn on our investor's X-ray.
Okay, so let's dive right into this. The secret to telling the difference between real growth and, well, financial engineering, it isn't some complex formula locked away in a Wall Street vault. Nope. It's actually incredibly simple. It all comes down to comparing just two key numbers that every single public company has to report. So the first number is the big one, actual net earnings. You can think of this as the bottom line profit. I mean, after every single expense, every tax, every cost is paid, this is the total amount of money the company actually made. For our purposes, let's think of this as the entire pie. The bigger the pie, the more successful the business. Pretty simple, right?
The second number, well, that's the one you always hear about in the headlines, per share earnings. All this is the total profit, our pie, divided by the number of ownership shares that are out there. So EPS, it just represents the size of each slice of that pie. And here's the crucial insight. This is the whole game right here. You can make a slice of pie bigger in two ways. You can bake a bigger pie, or you can just take the same pie and cut it into fewer, bigger slices. And that, right there, is the secret. It's the entire tool you need. To see the real story, all you have to do is compare the growth rate of the actual net earnings, the pie, with the growth rate of the per share earnings, the slice. The gap between those two numbers, that tells you everything you need to know.
All right. Enough with the theory. Let's see how this actually works in practice. Because it's one thing to talk about pies and slices, but the real power here becomes crystal clear when you start looking at the actual numbers. So let's travel back in time a bit. Let's take the Washington Post company, way back in 1986. That year, their actual net earnings, the total size of their pie, was a very respectable $100.2 million. That's our starting point. That's the pie. Now watch the magic trick. With that $100.2 million in profit and about 12.8 million shares out there, their EPS was $7.80. But look what happens if they shrink that share count down to just 10 million. The profit is identical, not a penny more, but the EPS magically jumps to over $10 a share. It's the exact same pie, just cut into fewer and therefore bigger slices. And this just shows how this trick isn't just some hypothetical thing. It can be used to completely mask some really poor results. Just imagine this company X. Its actual profits, the pie, are shrinking by almost 3% every single year. I mean, that's a failing business, right? But by aggressively buying back its own stock, it can go out and report that its per-share earnings, the slices, are growing by over 4% a year. It's a story of growth that completely hides a reality of decline. Now, you're probably thinking, okay, that's a neat theory, but surely the big, famous companies, they don't actually do this. Oh, but they do. Let's just look at the record and see how this plays out with some very, very well-known names. Let's take the defense contractor Raytheon. Over a 10-year stretch, management could go out and proudly report a fantastic 11.2% annual growth in per-share earnings. What a great story. But our X-ray shows that the actual pie, their net earnings, well, that only grew by 7.8% a year. So where did that extra growth come from? They bridged that gap by buying back and retiring nearly a quarter of the entire company's stock. But listen, share buybacks aren't always about hiding mediocrity. Sometimes they're used to make a truly great performance look absolutely spectacular. Look at Coca-Cola during that same period. They grew their actual net earnings at a phenomenal 15.2% per year. I mean, that is a rapidly growing pie. But by also reducing its share count, it boosted its per-share earnings growth to a jaw-dropping 19.5%. And Philip Morris is another classic example. Their actual business was just on fire, growing profits at 16% annually. I mean, that's a fantastic result all on its own. But by cutting their share count by 13%, they gave their per-share earnings growth an extra kick, pushing it to over 18%. Now, in this case, it's not hiding a problem. It's just management using its capital really effectively to boost returns for the shareholders who decided to stick around.
So up to now, we've only been looking at companies that are buying back their shares, cutting the pie into fewer slices. But what happens when they do the complete opposite? What happens when they issue more shares, adding more and more slices to the pie?
General Motors is a perfect example of this. Over 10 years, their actual net earnings grew at nearly 5% a year. Not incredible, but hey, the pie was getting bigger, so you'd expect your slice to get bigger too, right? Nope, wrong. Their per-share earnings grew at only 2.68%. So why the disconnect? Because they kept issuing more and more shares, cutting that growing pie into more and more and smaller slices. As a shareholder, your personal growth was just diluted away.
Now, sometimes this makes perfect sense. Banks, for example, often grow by issuing new stock and then using that stock as a kind of currency to buy other banks. Look at Norwest. Their actual net earnings grew at a staggering 28% a year, but their per-share earnings only grew at 21%. They were just constantly issuing new shares to fuel all of their acquisitions, and that understated their per-share growth relative to their incredible business growth.
So the crucial point in all of this is, how do you actually use this? This isn't just some interesting financial factoid. It's a powerful tool. It's your own personal financial X-ray for seeing the real story that's hiding behind the headlines. And using it could not be simpler. It's a two-step analysis. Step 1, find the number they're always bragging about, the annual growth rate for per-share earnings. Step 2, find the number they don't talk about quite as much, the annual growth rate for their actual total net earnings. That's it. Seriously, the gap between those two growth rates reveals the truth. If the slice is growing much faster than the pie, you know that share buybacks are doing the heavy lifting. If the pie is growing faster than the slice, you know they're issuing new shares and diluting your stake. That gap tells you the real story of whether value is truly being created or if it's just being rearranged. So from now on, whenever you see a headline celebrating some big jump in earnings per share, you'll know exactly what to do. You'll have your X-ray vision ready to go, and you'll ask the one simple, powerful question that gets right to the truth. Is the pie actually getting bigger, or are they just cutting it into fewer slices? The answer to that? Well, that's going to tell you everything you need to know.
You know, when you're looking at a company, it's so easy to get lost in the headlines, the flashy product launches, the CEO interviews. But how do you really know if the person in the corner office is doing a good job with your money? What if I told you there's a simple test, a kind of CEO report card that cuts right through all that noise? Well, that's exactly what we're going to break down today, a really powerful tool that any investor can use to grade a company's leadership.
So let's start with the most basic question of all. A company has a good year. They make a profit. What happens next? What should the management team do with that cash? It sounds simple, but this one question, this fork in the road, is probably the most important decision a company will ever make.
And believe me, this isn't just some business school thought experiment. How management answers that question, what they do with those profits, is probably the #1 thing that determines whether your investment is going to grow and compound over the years or just, well, fizzle out. It's that important.
Okay, so to really dig into this, we have to understand that not all profit is the same. You got to split it into two different buckets. We'll start with the first one, which is something called restricted earnings. So what are restricted earnings? Well, think of this as the money that's already spoken for. It's the cash a company absolutely has to spend just to keep the business running as is. We're talking about replacing old machines on the factory floor, upgrading critical software, just keeping the lights on. This isn't money they get to play with. It's non-negotiable.
Let me give you a really simple example. Let's say a company makes $1 million in profit. Awesome. But they know their main power generator is on its last legs, and a new one costs $400,000. If they don't buy that generator, the whole operation shuts down. So that $400 grand isn't really profit they can spend, is it? It's already earmarked. It's restricted.
And this is where it gets interesting. The money that's left after you've taken care of all that essential stuff, that's the good stuff. That's the unrestricted earnings. In our example, that's the other $600,000. Now, management has a real choice. They can hand that money back to the owners of the company, that's you, the shareholders, or they can keep it and reinvest it, hoping to grow the business. This decision right here is where a CEO really proves their worth.
So, if it all comes down to how they use that extra cash, you'd think it would be easy to tell the good managers from the bad ones, right? Well, not so fast. It's actually incredibly hard for us on the outside to figure out if they're making smart choices. And that's the big dilemma for investors.
There are two big things that really muddy the waters. First, sometimes a company just has an amazing business that's like a money printing machine. It gushes so much cash that even if management makes a bunch of terrible decisions with the profits, the core business is so strong that it covers up the mistakes. The second problem is inflation. Yeah, that old chestnut. It can create this total illusion of growth. A company's revenues might be up 10%, but if prices everywhere went up 10%, they haven't actually sold a single extra item. It looks like progress, but it's really not.
So, how do we see through all that fog? How do we get a true, clear picture of how management is performing? Well, this brings us to the hero of our story today, a beautifully simple tool called the Retained Earnings Test.
Now, don't let the name intimidate you. It is dead simple. It's just 3 steps, and you do it over a nice long time frame, say 10 years. Step 1. Add up all the profits the company kept in the business, the money they didn't give you in dividends. Step 2. Figure out how much the company's annual profit has grown over that same decade. And finally, step 3. You just divide the growth in profit by the pile of money they kept. What you get is the golden number, the actual return management earned on your reinvested capital.
All right, enough with the theory. The best way to understand this is to see it in action. So let's take a couple of really famous companies and run the numbers for a classic 10-year stretch, from 1983 all the way to 1993.
First up, the giant Coca-Cola. So over this decade, after they paid out all their dividends, the management team at Coke decided to keep and reinvest a total of $2.55 for every share of stock. That was the pile of money they had to work with.
So what did they do with that $2.55? Well, by the end of that 10-year period, their yearly profit for each share had grown by 67 cents. That 67 cents is the direct result of them reinvesting that money. It's the fruit of their labor.
And now for the big reveal. We take that 67 cents in new profit, and we divide it by the $2.55 they kept. The result? An incredible 26.2% return. Now let that sink in for a minute. For every single dollar of shareholder money they held onto, they managed to generate over 26 cents in new, ongoing profit, year after year. That is just phenomenal, world-class capital allocation.
Okay, now let's look at another giant from that same era, General Motors. Now, GM's management, they kept a whole lot more money, over $15 a share, $15.49 to be exact. That's more than 6 times what Coke kept. They had a mountain of cash to work with.
So, they had all that cash. What happened? Well, this is pretty shocking. After keeping over $15 of their shareholders' money, their annual earnings didn't just grow a little bit, they actually fell by $3.79 a share. They reinvested a fortune and ended up with less profit than when they started. It's just breathtakingly bad.
When you put them side by side like this, it's stark. It's not even a competition. Coke kept a little bit of money and created a gusher of new profits. GM kept a ton of money and somehow managed to go backwards. This one simple test tells you pretty much everything you needed to know about who you wanted running your company back then.
And if a table of numbers doesn't do it for you, this chart makes it crystal clear. You've got Coca-Cola shooting for the stars over here, turning every dollar they kept into a powerful engine for growth. And then you have GM, just a complete non-starter, a negative return.
Now, just to show you this wasn't some kind of fluke, let's look at another pair. On one side, we have Gannett, a big newspaper company. On the other, Cray Research, a high-tech supercomputer maker. Now look at this. Cray kept a massive amount of cash, over $31 a share. That's 3 times what Gannett kept. But guess what? Gannett actually grew its profits more than Cray did.
And the bar chart tells the story perfectly. Gannett generated a really solid 15% return on the capital it retained. Cray, despite being this cutting-edge tech company, only eked out a 4.5% return. It just proves, again, it's not about how much money you keep. It's about how smart you are with it.
So, what is the big takeaway from all of this? What does it all mean for you?
Well, you now have a surprisingly powerful yet simple tool in your back pocket. A way to do a quick gut check on the management of any company you might be thinking about investing in.
And I want to be clear, this isn't just an interesting academic exercise. It has very real consequences for your wallet. The companies that were great at this, the Cokes and the Gannett's, their stock prices did incredibly well over that decade. And the ones who were terrible at it, the GMs and the Crays, their stock prices went absolutely nowhere for 10 years, even though they plowed billions of dollars back into the business.
The source material we're looking at today sums it up perfectly. It says this test gives you, the investor, a really fast way to figure out if a management team actually knows how to make you wealthier. It cuts through the PR, it cuts through the excuses, and it gets right to the heart of what matters.
So that brings us to the final and most important question. This isn't about what happened in the 1980s. This is about right now. Take a look at the companies you own, the ones in your portfolio. Do you have any idea which ones would pass this test with flying colors? And which ones might look a little more like General Motors? It's a test worth running. Thanks for tuning in.
You know, when you hear the name Warren Buffett, your mind probably goes straight to one thing: buy and hold investing. You know, picking these amazing companies and just sticking with them for decades. But what if I told you that one of his most powerful strategies, the one that literally saved him during market crashes, has almost nothing to do with that? Well, today, we're going to pull back the curtain on a secret chapter of his playbook.
Take a look at this number, 25%. For over 30 years, this was the average annual pre-tax return Warren Buffett was making with a very specific short-term strategy. It's a part of his game most people don't even know exists, but man, it has been an absolute profit machine for him, especially when good long-term deals were hard to find.
And this brings us to what I like to call the other Warren Buffett. Yeah, not the patient, folksy grandpa from Omaha we all know and love, but our razor-sharp, calculating investor with a secret talent for these quick turnaround plays. He calls them workouts, and they show a side of his genius that's every bit as brilliant as his famous long-term picks.
So what exactly is arbitrage, or a workout, anyway? Well, it's a special situation that just sort of pops up whenever a company announces it's being sold or merging or even liquidating. For a little window of time, you get this gap between the stock's price on the market and what the final deal price is going to be. Buffett saw these as way more profitable than just letting his cash sit around doing nothing.
And we're not talking about a little extra pocket change here. This strategy was a complete lifesaver. I mean, take 1962. It was a terrible year. The Dow dropped over 7%. Buffett's long-term stocks actually lost money. But because of his arbitrage profits, his partnership ended the year up 13.9%. That's just incredible. It turned what should have been a disaster into the stuff of legend.
All right, so here's our game plan. We've just gotten a peek at his hidden talent. Next, we're going to dive into how the arbitrage game is actually played. Then we'll uncover the secret formula he learned from his mentor, the one and only Benjamin Graham. See it in action with a real case study, and finally, boil it all down to one simple rule that guides his entire approach.
Okay, so let's get into the mechanics of this thing. How does an investor actually grab that profit that's sitting between the market price and the final deal price? It's actually a lot simpler than you might think.
It all really comes down to 3 basic steps. First, you get an official announcement. Let's say Company X says it's being bought by Company Y for $120 a share. Step 2, the arbitrageur, that's our investor, spots the opportunity. The stock's still only trading for $100. That gap is called the spread. So they buy the shares. And finally, step 3, the deal closes, they get the full $120, and they pocket a nice clean $20 profit on every share.
Seems pretty straightforward, right? A guaranteed $20. But it's not quite that simple. There is one absolutely critical question that decides whether this is a fantastic investment or just a mediocre one. Any guesses what that might be?
It all comes down to time. When is that deal going to close? See, the profit amount is fixed, right? It's $20. But your rate of return, what you're making on an annual basis, that depends completely on how long you have to wait to get your money.
And just think about what that does to your return. If that $20 profit on your $100 investment comes through in just 6 months, well, your annualized return is an amazing 40%. If it takes a full year, it's still a very solid 20%. But if that deal gets delayed and drags out for 2 years, that same $20 now only represents a 10% annual return. Time really is everything.
And that, of course, brings us to the risks, because these deals can and absolutely do go sideways. The whole thing might take way longer than you planned, which just kills your return. Maybe the shareholders get cold feet and vote it down, or government regulators step in and block it. And in the absolute worst-case scenario, the deal just completely falls apart, which, as the source material puts it, is a major bummer.
So how does Buffett deal with all these risks and still manage to hit that 25% average year after year? Well, he doesn't guess. He uses a system, a tool that he learned from the master himself, his mentor, Benjamin Graham. Yep, it all comes back to Graham. Now, we all know Graham as the father of value investing, but he was also a master of these special situations. He actually developed a very precise mathematical way to size them up, and he passed that knowledge straight on to his star pupil.
And this right here, this is it. This is the secret tool. I know, at first glance it might look a little intimidating with all the letters, but it's really just a beautiful, logical way to weigh the potential upside against the potential downside while factoring in the odds and, of course, time.
Let's just break it down really quick. G is your potential gain if it all works out. L is your potential loss if the whole thing blows up. C is the big one, your best guess at the chance of success as a percentage. Y is the time, how many years you think your money will be tied up. And P is just the price you're paying for the stock today. See? It's basically a checklist for smart, disciplined thinking. Okay, so theory is one thing, but let's see how the master actually put this formula to work in the real world. We're going to walk through a real arbitrage deal that Buffett made way back in 1982 with a company called Bayeux Cigars.
All right, let's plug in the real numbers. Bayeux had announced it was liquidating and was going to pay out about $7.87 a share. Buffett was able to get in at $5.44. So that gives us our P, the price, and our potential gain G of $2.43. Now, if the deal failed, he figured the stock would fall to about $4.50, giving him a potential loss L of 94 cents. Since the deal was already announced and approved, he gave it a 90% chance of success, that's our C, and he expected it to be done within 1 year, our Y. Now, we just take all those numbers and plug them right into Graham's formula. I know it looks complicated, but the logic is actually really simple. First, you figure out the probable gain. That's your potential gain times the chance it succeeds. Then you subtract the probable loss, your potential loss times the chance it fails. You take that final expected profit and you divide it by what you paid, factoring in that 1-year timeline. It's a method, not magic. And what was the result? An expected annual return of 38%. 38% for a short-term deal that had a very high probability of success. Now you can see why this was so appealing to him. That is an incredible, disciplined return.
So all of this brings us to the real core philosophy, the simple but powerful rule that makes this whole system work so well. It's not just about doing the math, it's about the mindset. It's about deciding when you're even going to play the game. Just look at the difference here. On Wall Street, everybody loves to gamble. They trade on rumors, whispers of a potential takeover, hoping to hit a 100% home run. It is pure speculation. Buffett's way is the total opposite. He only gets involved after a deal is officially on the table. He isn't chasing some lottery ticket. He is laser-focused on a nearly certain 25% return using a disciplined, formula-based approach. He picks high probability over high-risk speculation every single time.
And that, right there, is the real genius of it all. You know, the biggest headache in value investing is usually not knowing if you're right, but when the market will finally catch on. It could take years. Arbitrage solves that problem. You have a specific event, the deal closing, that's going to unlock the value on a pretty specific timeline. It adds this crucial layer of certainty you just don't get anywhere else.
So you see, the real lesson here isn't just about arbitrage. It's about a way of thinking. Buffett took what looks like a complex, risky situation and applied a simple, logical formula to turn it into a consistent moneymaker. And that leaves us with one final thought. Where in our own lives, in our own decisions, could applying a clear, disciplined formula help us better evaluate our opportunities?
Hello and welcome. Today we're going to crack open the playbook of, well, one of the greatest investors of all time, Warren Buffett. And we're not just going to talk about his ideas in some abstract way. Nope, we're going to become detectives. We're going to use original source material to really break down 3 of his classic investments from back in the 1990s. So, you ready to put on your detective hat? All right, let's dive in.
It's a pretty interesting question, isn't it? I mean, on the surface, these seem like ordinary, almost kind of boring businesses. But you see, Buffett saw something that almost everybody else missed. He saw this hidden pattern, a consistent logic that connected a local newspaper, a mortgage giant, and a fast food chain. And our job today? It's to uncover that exact logic. And that right there is the key. This isn't about some crystal ball or a secret stock-picking algorithm. It's about a repeatable, understandable framework for thinking about businesses, a playbook that gave him the confidence to put nearly $2 billion, which is just a massive sum of money, into just these 3 companies. And I promise you, by the end of this, you'll understand exactly how it works. All right, so the first half of the playbook, our first line of investigation, it has absolutely nothing to do with stock prices. It's all about the business itself. You see, before he even thinks about the price, Buffett has to be totally convinced he's looking at a truly exceptional company. So how does he do it? Well, he follows a pretty clear checklist. First, he hunts for a very special kind of monopoly. Second, he verifies its financial muscle. And third, he judges the quality of the people running the show. So let's break down each one of these clues, shall we? So the whole thing really hinges on this idea of a consumer monopoly. Now, this isn't the kind of monopoly you're thinking of, the government-granted kind. No. This is a business that is so dominant in its own little world, so powerful in the consumer's mind, that it can basically write its own rules. It's the business that customers just keep coming back to year after year, almost without thinking. Think about the search engine you use every day or the brand of smartphone in your pocket. That's the kind of power we're talking about here. Our first case study, Gannett, back in 1994, is a perfect example of this. Buffett understood that in dozens and dozens of cities, Gannett's local paper was quite literally the only game in town. I mean, if you were a car dealership, a supermarket, or a movie theater, you had to advertise with them. There was no other choice. They owned the local information highway. That is a powerful monopoly. Next up, we've got Freddie Mac. So in 1992, they weren't the only game in town, but they were one of only 2 major players, along with their sibling, Fannie Mae. Together, they formed this government-sanctioned duopoly in the absolutely massive market of buying and packaging home mortgages. This quasi-monopoly gave them incredible scale and a structural advantage that very few other financial companies could ever even hope to achieve. And then you have McDonald's in 1996. Now, its monopoly wasn't about a physical location or some government charter. No, its monopoly was a monopoly of the mind. Those golden arches were and still are one of the most recognized symbols on the entire planet. They took a simple commodity, the hamburger, and they turned it into a global brand name product that stood for consistency and value to literally billions of people. Now, what's really fascinating is how this monopoly power shows up in the actual numbers. If you look at the slide, you can see a really clear pattern of just incredible financial strength. Let's focus on that middle column, return on equity. To give you some perspective, the average for most American corporations is somewhere around 12%. Well, Gannett was averaging over 20%, Freddie Mac over 22%, and McDonald's over 18%. This just shows you plain as day that these companies weren't just big, they were extraordinarily profitable, consistently turning shareholder money into more money at an absolutely elite rate. The final clue is the management. Buffett saw that these companies were run by really smart, disciplined people. They didn't waste money on flashy, unrelated acquisitions. They stuck to what they knew, and they reinvested profits right back into their main business. They also bought back their own stock, which is a great way to increase each shareholder's slice of the pie. And really importantly, these were not capital-intensive businesses. Once a newspaper press or a restaurant was built, it could just crank out cash for years without needing massive, constant upgrades. And what does that mean? It means more cash for the owners. Okay, so the detective work on the business is done. We found 3 fantastic companies. But, that's only half the battle. Now comes the second and just as important part of the playbook, figuring out if the price makes sense. So let's dive into that second part and see how Buffett figures out the right price to pay. This is something you really have to get about how Buffett thinks. You can find the best company in the entire world, but if you pay too much for it, your returns are going to be, pretty lousy. The quality of the business is one thing. The price you pay for that quality is everything. The price is what determines your ultimate rate of return. So how does he decide if the price is right? He uses this beautifully simple mental model. He thinks of a stock not as some flickering symbol on a screen, but as a special kind of bond. The earnings per share of the company, that's like the annual interest payment or the coupon you'd get from that bond. It's a really simple but incredibly powerful shift in perspective. And this right here just perfectly illustrates the whole idea. So back in 1994, Buffett could have put his money in a totally risk-free government bond and earned a 7% return. Or, for the exact same price, he could buy a share of Gannett. Now, its initial earnings yield was a little bit lower at 6.5%. But here's the magic trick. The government bonds payout is fixed. It never changes. But the Gannett bonds payout was set to grow year after year at over 8%. So let me ask you, which one would you rather own? The one that pays you more and more money every single year, right? Of course.
And as you can see on this slide, the pattern holds for all three companies. I mean, look at Freddie Mac. He was getting a higher initial yield and a staggering 17.7% growth rate. Even with McDonald's, where the initial yield of 5.2% was a bit lower than the 7% bond, its coupon was growing at a massive 13.5% per year. In every single case, the choice was obvious. The growing equity/bond was just vastly superior to the static government bond. So we have a great business and we have a great price. Now it's time for the final step, putting it all together to project what the investment could actually be worth down the road. This is the million, or in this case, the billion-dollar question, right? If your earnings are growing every single year, what does that do to the value of your initial investment over, say, a decade? This is where the real power of compounding just kicks into high gear.
Now, let's just take a moment here to appreciate this timeline. This wasn't just a single lucky bet. Over a 4-year period, Buffett systematically identified these opportunities and committed huge amounts of capital to them. He wasn't just dabbling. He was making massive, concentrated bets based on this exact playbook we've been walking through. And here it is, the verdict, the conclusion of our detective story. Based on the historical earnings growth and some pretty conservative assumptions, Buffett could project double-digit annual returns for the next decade on all three investments. Just look at Freddie Mac on this slide. He was looking at a potential return of over 20% per year. I mean, that is truly incredible. These aren't just good returns. These are wealth compounding machines. And that brings us to this number, nearly $2 billion. That's the total capital that Berkshire Hathaway put to work across just these three ideas. This wasn't a small-time operation. This was a master at work, using a clear, powerful framework to make enormous, high-conviction investments. So after all that detective work, what's the big takeaway here? What can we all learn from this and maybe apply to our own thinking? Well, here it is, boiled down to 4 key principles. First, be a hunter of monopolies, those durable competitive advantages that protect a business. Second, demand proof of excellence. You want to see consistently high returns on equity. Third, use that brilliant mental model. Think of a great stock as a bond with a growing payout. And finally, and this is maybe the hardest part, be patient and disciplined. Always wait for the price to be right. Now, of course, this isn't foolproof. A monopoly can get weaker, and growth projections are just that, projections. But using a framework like this dramatically stacks the odds in your favor. And hey, if there's one thing you take away from all this, let it be this. Notice we didn't use any complex calculus or fancy algorithms. This whole process is based on business logic and a powerful, rational framework for thinking. It's accessible to anyone who's willing to do the detective work. So I'll leave you with this question to think about. The next time you buy a certain brand of coffee or use a specific piece of software or visit a particular store, without even thinking about it, just ask yourself, is this an everyday monopoly hiding in plain sight? You might be surprised at what you find. Thanks for joining me today. All right, welcome back to The Explainer. Today, we're going to break down the exact blueprint Warren Buffett used to launch his empire. And we're not just talking high-level theory here. We're getting into the ground-level strategy that started it all. It's really a masterclass in building wealth. And you know what? It all begins with a single, kind of surprising math problem. Okay, so here's the game plan. First, we're going to look at this math problem that shows why just getting great returns, well, it isn't enough to make you a billionaire. Then we'll dive into the clever investment vehicle Buffett shows, see how he got its first backers, and then, this is the good part, we'll analyze the big strategic pivot that unlocked his secret weapon, the float. And finally, we'll wrap it all up into a playbook that makes perfect sense. All right, first up, the billionaire's math problem. This is a really fascinating, almost counterintuitive piece of arithmetic that totally sets the stage for everything that Buffett did next. It's the core reason he figured out that being a brilliant stock picker, that just wasn't going to cut it on its own. So let's just do a little thought experiment. Imagine you're an absolutely phenomenal investor.
You start with a cool $1,000,000, and you somehow manage to get a staggering 25% return, compounded every single year for 30 years straight. That's got to make you a billionaire, right? Easy.
Well, you'd think so, but the math says, nope. You'd end up with about $807 million. I mean, that's an incredible fortune for sure, but it's not a billion. And that gap, that missing $193 million, that's where the real secret is hiding. It proves that amazing returns are only one part of the puzzle. And that brings us to the whole point of this. To get to that truly massive next level of wealth, you need leverage. And I don't just mean debt. I mean leveraging your talent with other people's money. If you want to build a bigger empire, you need a bigger foundation to start with. And that means you got to bring on partners. So that leads us right to the second piece of this puzzle, finding the perfect investment vehicle. Now, choosing how to structure his business wasn't just some minor detail. It was a huge strategic decision that gave him a powerful edge right from day one. He went with something called a limited partnership, and it's just a beautifully simple setup. He, as the general partner, made all the calls, all the investment decisions. His investors, the limited partners, well, they just provided the cash and trusted his genius. It was lean, clean, and had some seriously powerful advantages built right in. And this is why that choice was so brilliant. I mean, look at this. On the right, you've got the typical mutual fund path. It's a maze of SEC regulations, red tape, legally restricted fees. But by choosing the limited partnership model on the left, Buffett stayed under 100 investors and basically sidestepped that entire bureaucracy. It gave him total freedom to be nimble, to invest how he wanted, and, crucially, to set up his fees for maximum profit. It's like he chose the open highway instead of the labyrinth. Okay, so he's got the right legal structure. The next piece of the puzzle, finding the money. So in 1956, a 26-year-old Warren Buffett packs his bags, moves back to his hometown of Omaha, and gets ready to find his very first investors. And look at this. This is the actual beginning, right from the Certificate of Limited Partnership. May 1st, 1956, Buffett Associates Limited is officially born. This simple piece of paper, this was the acorn that the giant oak tree of Berkshire Hathaway would grow from. It's incredible. So who were these first brave souls? It was his inner circle. We're talking family and close friends. His Aunt Alice, she was the biggest believer, put in 35 grand. All told, he scraped together an initial stake of $105,000 from these 7 people. The empire didn't start on Wall Street, It started right there in the living rooms of Omaha. But he didn't stop with just one partnership, not at all. He basically treated that first one like a prototype. Once he proved the model worked, he just scaled it up, launching 9 more partnerships over the next 6 years for different groups of investors. Then, in 1962, to make things simpler, he just merged all 10 of them into one bigger entity, Buffett Partnership Limited. And just look at what happened. By 1962, that initial 105 grand from just 7 partners had exploded by 100 times. He was now managing over $10.5 million from almost 100 different partners. He had proven 2 huge things. 1, he could deliver incredible returns, and 2, he could attract serious capital. But, with all that success came a brand new problem. By the late 1960s, the stock market was starting to get, frothy. The kinds of cheap bargains that Buffett loved to buy were just vanishing. And this forced his hand. It pushed him to make what would become the single most important strategic pivot of his entire career. This is where you really see the discipline of the man. He looked at this ridiculously expensive market and basically refused to play the game. He wasn't about to start chasing overpriced stocks for lousy returns. So he did something that probably shocked everyone. In 1969, he closed the partnership, gave all the profits back to his investors, and decided to just sit on the sidelines with his own cash, patiently waiting for the storm he knew was coming. And when that market finally did crash, boy, was he ready. But instead of just buying stocks this time, he started buying whole companies. He took control of this struggling old textile mill called Berkshire Hathaway. Now, let's be clear, the textile business itself, it was toast, and he knew it. But what it did have was cash flow and assets. And here's the absolute stroke of genius. Instead of plowing that cash back into new textile machines, he started siphoning it off to buy something totally different, insurance companies. So, why insurance? Of all things, why go from a successful fund to a dying textile mill just to buy insurance companies?
The answer lies in this powerful, almost magical concept that would become the true engine of Berkshire Hathaway's growth machine. He was hunting for this one magical thing called the float. Here's how it works. You and I, we pay our insurance premiums up front, right? The insurance company gets to hold on to all that cash and invest it for its own profit before it might someday have to pay out any claims. That giant pool of money, all the premiums they've collected but haven't paid out yet, that's the float. It's basically a massive interest-free loan from millions of people, and now Buffett could invest it however he saw fit. In this number, this just shows you the sheer power of that move. By 1996, Berkshire's float had swelled to $6.7 billion. Just let that sink in for a second. Warren Buffett now had access to nearly $7 billion of other people's money that he could invest for the long haul. This was the ultimate form of leverage. It's just brilliant.
Okay, so when you piece this whole journey together, from that tiny partnership in Omaha to that multi-billion-dollar float, a really clear playbook starts to emerge. So let's just lay it all out step by step. So here it is, the whole playbook in 5 steps. Step 1, you got to prove you have the skill. Generate exceptional returns. Then step 2, you build a simple, flexible vehicle, like that limited partnership, to bring in other people's money. Step 3 is you scale that thing up, starting with the people who trust you the most. Now step 4, this is the big one, the pivot. You use that capital to buy control of a business that generates its own cash. For him, it was insurance. And that leads right to the final, beautiful step, step 5. You masterfully invest the massive float that business kicks off. And that really leaves us with one last big question, doesn't it? Buffett used a dying, overlooked, boring old textile mill as the corporate shell to build his entire empire. So what's the modern equivalent of that? What unloved, boring, but cash-gushing industry could a really savvy investor use today as the launchpad for the next Berkshire Hathaway? That is definitely something to think about. Thanks for joining us.
You know that feeling, right? You look at the stock market, and there are just thousands of companies, all of them shouting for your attention. It can feel completely overwhelming, almost impossible to sort through the noise. But what if I told you there's a simple, incredibly powerful filter to find the real gems? Well, one of the greatest investors ever, Warren Buffett, he came up with just that blueprint. And today, we're going to tear it down and see how it works.
So here's our game plan. First, we'll talk about the big problem every investor runs into. Then, we'll dive into Buffett's 2 simple categories for spotting great businesses. We're going to look at plenty of real examples for each one. And finally, we'll wrap it all up with the one timeless lesson that pulls this entire strategy together.
All right, so let's jump right in. We're starting with a challenge that, let's be honest, every single one of us has faced. You're basically floating in a giant sea of choices.
Yeah, this is the big question, isn't it? We're not just looking for a decent company or a company that's doing okay. We're looking for an excellent one. The kind of business that has a deep, durable advantage that will last for years and years. So how in the world do you go from thousands of options down to just a small handful of potential superstars?
And this is where the simple genius of Buffett's approach really shines. Instead of getting bogged down in complicated spreadsheets and analysis, he just cuts right through the noise. He created a simple mental filter, and he figured out that the most profitable, most durable businesses almost always fall into one of 2 buckets. So, what are those 2 buckets? Well, that brings us right to Section 2, Buffett's 2 business types. This is the heart of his simple and unbelievably powerful framework.
Okay, so on one hand, you've got the consumer monopoly. The easiest way to think about this is a product you ask for by its brand, not what it is. That's its power. And on the other hand, you have the toll bridge. This is a company that basically owns the only road into town. If other businesses want to get to their customers, they have to pay the toll. Both are incredibly strong business models, just for different reasons.
All right, let's really dig into that first category. Section 3, the consumer monopoly. This is all about the pure, raw power of a brand name. I love this quote. It's so simple, but it says everything you need to know. It's the perfect test. Just think about it for a second. You walk up to a bar, you don't say, "I'll have a light lager, please." No way. You ask for a Bud Light, a Miller, a Coors. That automatic top-of-mind brand recognition, that is an economic fortress, and it's worth billions.
And you see this pattern everywhere you look. It's not just beer. When you think soda, you think Coca-Cola. It's the soda. Shaving? Gillette. A quick meal? McDonald's. Chocolate? Hershey's.
These brands are so deeply embedded in our brains that they've essentially created a monopoly inside the consumer's head, and that lets them charge a little more, and we happily pay it year after year.
So, what does this mental monopoly actually mean for the business? Well, it means staggering profits. Let's just take Gillette. For over a decade, its return on equity, which is a key way to measure how profitable a company is, was consistently above 25%. Some years it was over 40%. That is an absolute economic machine.
And Gillette wasn't some kind of fluke. This kind of financial power is what these consumer monopolies are all about. You look at Bristol-Myers Squibb with brands people knew like Bufferin, boom, returns over 30%. Warner Lambert with Listerine and Trident Gum, same story. Ralston Purina, which dominated pet food, they had returns over 40% for 5 years straight. The numbers are just undeniable.
Okay, so that's the consumer monopoly. Pretty powerful stuff. But there's a completely different way to build an economic fortress. And that brings us to the second type, the toll bridge business, which is all about providing a service people have to use.
The concept here is just beautifully simple. Just picture it in your head. There's one bridge that crosses a huge river. And if you want to get your stuff to the market on the other side, you have no choice. You have to pay the toll to the guy who owns the bridge. That's exactly how a toll bridge business works, just in the world of commerce. American Express is probably the most classic example of this. Just think about what happens every single time somebody uses an Amex card. First, Amex charges the store a small fee for the transaction. That's toll number one. But then, they also charge you, the cardholder, an annual fee just for having the card in your wallet. That's toll number two. They're sitting in the middle, getting paid from both sides. It's an incredible business model.
And these toll bridges pop up in all kinds of different industries. Back in the day, if you wanted to do a massive junk mail campaign, you pretty much had to pay the toll to a company like Advo. If you're a big company, you need advertising, so you pay a toll to an agency like Interpublic. And Walmart? That's a fascinating one. Their toll bridge is their massive size. They can basically dictate prices to manufacturers. That's a kind of toll just to get on their shelves.
You know, this idea about advertising agencies is so clever. Buffett called it earning a royalty on the growth of others. Think about that for a second. The ad agency doesn't have to invent anything new. As its clients, like Coca-Cola or Procter & Gamble, grow and spend more money on ads, the agency's revenue just goes up automatically. It's like having a small piece of the success of hundreds of other amazing companies. Now, of course, the real world is messy. It's not always so clean and simple, and some of the absolute best businesses are actually a hybrid of the two. A company like the New York Times, for example. It's a consumer monopoly, right? People trust that brand name. But it's also a toll bridge. If you're an advertiser and you want to reach their specific, valuable audience, you have to pay them the toll. When you find a company that has both of these things going for it, well, that's when you've found something really special. Which brings us to our final and honestly our most important section, because you can learn how to spot the best business on the planet, but if you forget this one thing, none of it matters. Section 5, the timeless lesson. And it's that price is everything. Now, you've probably noticed that a lot of the company examples we've used are, well, they're kind of old news. And that's exactly the point. The specific names on the list will always change, but the thinking, the framework for identifying them, that's forever. The categories of consumer monopoly and toll bridge are timeless mental models you can use to analyze any business in any decade. And it all boils down to this single idea. If you only take one thing away from this whole explainer, let it be this. Finding a wonderful business is only half the job. The part that actually determines whether you make money or not is the price you pay for it. Your success isn't just about the company's quality. It's about the relationship between that quality and the price you paid to own a piece of it. This is where discipline and patience come in. Look, the market will have moments where it falls in love with these great companies and it bids the prices up to the moon. Those are not the days you should be interested. The real opportunity, the time to get excited, is when the market gets gloomy, when there's fear in the air, and when a truly excellent business goes on sale for some silly, short-term reason. That's your moment.
And that really leaves us with one final thought. This framework isn't a history lesson, it's a lens. It's a tool you can use to look at the world right now. So I'll leave you with a challenge. As you look at the giant companies that dominate our lives today, in technology, in finance, everywhere, what are the new toll bridges? What are the modern consumer monopolies? The blueprint is yours. Now go see what you can find.
All right, today we're going to dive into one of the most powerful and maybe one of the hardest investment ideas from the master himself, Warren Buffett. It's a whole philosophy that's built on a pretty radical idea. knowing when not to do anything. It sounds so simple, but as you'll see, it's one of the toughest disciplines to actually master. To really get Buffett, you have to start with his mentor, the great Benjamin Graham. And Graham absolutely loved this quote from the ancient Roman poet Horace. It just perfectly nails a timeless truth about markets, doesn't it? Things move in cycles. The stock that's on top of the world today could be in the bargain bin tomorrow, and the other way around. This idea is the foundation for everything we're about to talk about. And let's be real, this is the world we all live in every single day. You're just bombarded with it. There's always a story, always a headline, always some hot tip about a company that's defying gravity. It creates this constant nagging pressure, a noise machine that's always telling you, hey, you're missing out. You've got to get in on this right now. So what's the result of all that noise? Well, it leads to the central problem we're talking about today. Most people, and I'm talking even professional fund managers, they just get lost. They end up ditching their plans, jumping from one hot trend to the next, chasing last year's winners, and pretty soon the only things guiding their decisions are the two absolute worst emotions you can have in finance: fear and greed. So what's the antidote to all this chaos? Well, it's a philosophy that Warren Buffett lives and breathes. He calls it waiting for the perfect pitch. And it's just this simple, really elegant metaphor for a discipline that is profoundly difficult to stick with. Okay, so what in the world does a perfect pitch actually look like when you're investing? Well, for Buffett, it's not just a good company or a decent stock. It's the whole shebang. It has to be this perfect trifecta. First, the business needs a powerful, almost unshakable position in its market, what he calls a consumer monopoly. Second, it has to be run by smart, honest people. And third, and this is the big one, you have to be able to buy it at a fantastic price. If it's missing any one of those things, it's just not the perfect pitch. You let it go by. And this is where the analogy just clicks into place so perfectly. Think about baseball. The pitcher throws the ball, and if you let 3 good pitches go by, 3 strikes, you're out. Game over. But here's the kicker. Investing is a game with way more forgiving rules. The market can throw thousands and thousands of opportunities at you every single day. Tech stocks, meme stocks, crypto, you name it. But here's the thing. In investing, there are no called strikes. You can stand there, bat on your shoulder, for weeks, months, even years. The only way you can possibly strike out, the only way you can lose your money for good, is by swinging at bad pitches. So the process itself is just beautiful in its simplicity. Step 1, you get in the game. You step up to the plate, you're ready to invest. Step 2, you just watch. You analyze, you study, but you do nothing. You let all those pitches, all those so-called can't-miss opportunities just fly right by. Step 3, you wait. You wait with an almost insane amount of patience for that one rare pitch that checks all of your boxes. And then step 4, when that perfect pitch finally arrives, you don't just tap at it. You swing for the fences. You go big. Now, if the strategy is really that simple, you have to ask, right? Why doesn't everybody do it? Well, it's because this simple idea goes against some of our deepest, most hardwired human instincts. The real fight here isn't with the numbers or the analysis. It's with our own psychology. Let's dig into why this is so dang hard. Let's make this really tangible. Imagine, just for a second, you get $1 million. Maybe you inherited it. It's just sitting there, cold hard cash in your bank account. For most people, that money doesn't feel like a pool of opportunity. It feels like an urgent problem that has to be solved right now. It feels like it is literally burning a hole in your pocket. And be really honest with yourself here. If that money showed up tomorrow, would your first instincts be to get on the phone with a broker and say, what's hot? Where should I put this? Or could you really, truly just sit on that cash for a year, maybe even 2 years, waiting for that perfect moment? That internal pressure to put the money to work is just immense. What's funny is this kind of impatience looks completely absurd when we apply it to any other important part of life. Would you seriously give yourself 1 week to find the person you're going to marry? No way. Would you switch your career path every couple of years from medicine to law to engineering? Of course not. You'd never get good at anything. We understand that big, important decisions take time and focus. But for some reason, with investing, we demand instant gratification. Every investment strategy, value, growth, you name it, it's like its own subject. It has its own rules, its own subtleties. It takes years to really learn it. So chasing whatever is hot this month is basically like deciding to show up for the first day of first grade over and over and over again. You never learn enough to graduate and actually get ahead. Okay,
So this all sounds great in theory, right? But did Buffett actually live by this? Did he practice what he preached? Oh, you better believe it. Let's look at a real-world example where he put this entire philosophy and his whole reputation on the line.
This story is just incredible. So it's 1971, the market is roaring, everyone's euphoric. And what does Warren Buffett do? He does the unthinkable. He actually closes his investment partnership and gives the money back to his investors, basically saying, sorry folks, there's just nothing out there that's worth buying at these crazy prices. And for 2 more years, he sits on the sidelines while other people are making a fortune. Can you just imagine the discipline that took to watch everyone else get rich while you just wait? Then, in '73, the crash he saw coming finally hit, and while everyone else was panicking and selling, Buffett was ready to go shopping.
And this is the glorious payoff for all that patience. When the market was collapsing, when fear was absolutely everywhere, his calm, business-like perspective told him that the perfect pitches were finally coming over the plate. In his own words, he said that suddenly Wall Street was basically giving things away. They were practically begging him to buy these incredible businesses for pennies on the dollar. And what was one of the most famous home runs he hit during that period of extreme pessimism? His investment in the Washington Post. Think about it. A legendary company, a true consumer monopoly, run by great people, and suddenly, because of all the fear in the market, it was on sale at a fantastic price. That, my friends, is a perfect pitch. So, how do we take this masterclass from one of the greatest investors ever and actually apply it to our own lives, our own thinking? Let's try to boil it all down into a few core actionable rules. Okay, it really comes down to these 3 things. First, pick a strategy you truly understand and believe in, and then have the discipline to stick with it. Don't keep repeating the first grade. Second, your decisions have to be based on your own sound judgment on business principles, not on what the crowd is screaming about. And third, and you have to burn this into your brain, your absolute best opportunities, the most profitable pitches you will ever see, will come when everyone else is deeply, deeply pessimistic. If you're going to remember one thing from all of this, let it be this. Investing is not a game about being active. It's a game of disciplined inactivity, punctuated by these rare, brief moments of decisive, high-conviction action. And that leaves us with the final and, frankly, the most important question of all. We know what Buffett's perfect pitch looks like, but what about you? Before you swing at the next hot idea that comes your way, you owe it to yourself to stop and define with crystal clarity what your perfect pitch actually is. Because let's face it, waiting is impossible if you don't even know what you're waiting for.